is indicating. So we'll see where that's going to be headed, whether we see a bit of a recovery today in the markets or maybe a muted day again for the Nifty 50 and the Indian markets is something that we should watch out for. But a lot that's happened on the global market front. How is all that going to be impacting our Indian markets? We have a team of research as always here to set you up for trade, tell you which are the important stocks to watch out for, what's going to be happening in the world of F&O as well. First up, let's go across to Hormaz, who's here to tell us the important market cues that we need to be keeping an eye out on today. Good morning, Hormaz.
Good morning, Winnie. And it's promising to be a dull start as of now, but 3 days of losses now for the Nifty, and we're already off 300 points from those record high levels. So the Nifty Bank, it's a little worse. So almost over 800 points now off those record high levels, and everything that could possibly have gone wrong for the bulls yesterday happened. So we had the expiry related volatility, the index heavyweights that were down with ICICI, HDFC, Reliance, all of them contributing to the Nifty downside in yesterday's session. The rupee, which has been the major factor behind the fall in the last 2 trading sessions, that tested levels of 90. That remains a key monitorable today as well. And of course the broader markets, which were fairly okay all through the trading session, but then they succumbed to the selling pressure as well. And although the indices are flat in absolute terms, this advanced decline presents the actual picture of the pain in the broader markets. Now, you levels to watch out for, we briefly slipped below the 26,000 mark yesterday, so that remains the first important level on the downside. Analysts who we spoke to believe that if 26,000 goes, it opens a 150 to 200 point gap on the downside, which opens up 25,850, and that is the last week low, 25,842 to 25,847. That's the important level to watch on the downside if 26,000 goes. On the upside, of course, with 26,100, 26,150, which was a support, that becomes the first important hurdle on the upside now, and then we take it 50 points at a time. For the Nifty Bank, 59,500 gone yesterday, so now comes down to 59,000, and that goes, then that will be important to watch out for. You watch out in today's session if there is any further fall in HDFC and ICICI as the street begins to price in the lower weightage for them in the index. Any further depreciation in the rupee, because analysts that we spoke to are projecting ranges of anywhere between 90.5 to even 92 on the downside, so keep an eye out there as well. 3 IPOs including Meesho, they open for subscription today, so that will be a key monitorable as well. And watch out for PSU banks today after the FinMin clarification on the FDI limit. So as of now, it promises to be it's a subdued start is what the GIFT Nifty is indicating, but the bulls would be hoping that the trend this time goes in their favor.
Absolutely hoping for the trend to be in their favor. That's the word maybe that would come in from the bulls by the end of the trading session. That's what we'll be keeping an eye out on. But important stocks to watch out for in today's trading session. Upasana is here to give us that list. Good morning, Upasana.
Good morning, Winnie. First up, let me start with Sun Pharma. Company's unit has approved proposal of investment of 3,000 crores for setting up a greenfield formulation manufacturing facility in Madhya Pradesh. Next up is Canara Bank. It raises funds worth 3,500 crore via debentures, which includes a green shoe option of 2,500 crore. Seat also in focus as the board meeting is scheduled on 5th of December to explore proposal for issuance of NCD on private placement basis. IRFC is the next one as it signs pact with Sumitomo Mitsui Banking Corporation to raise $300 million external commercial borrowing loan. Next up is India Cements. The company is armed to sell entire equity in PD Adcoal Energindo, which is an Indonesian company, for nearly about 5.4 crores. Hindustan Copper also in focus as it executes MOU with NTPC Mining to collaborate on copper and critical mineral projects. Quality Power is also in focus on the back of the order win. The company receives order worth 14 crores for supply of coil products. Next up is Cohance Life Sciences. Board has approved fund infusion by way of compulsory convertible preferred stock of NJ Bio Inc. USA, a subsidiary of the company, up to USD $10 million. So all in all, we'll be watching out for all these stocks in today's trading session.
Okay, Upasana, thank you so much for that list there. But let's move on to the final update today for the trade setup, and that is going to be on the F&O front. So, Darshan, what are we keeping an eye out on? What should we watch out for in terms of individual names in the F&O world as well?
So yesterday it was weekly expiry for Nifty, and we saw that market has fallen for third straight day. So the question would be, will this would be a fourth day that will fall? Well, I won't be surprised if there is any recovery at the lower levels, because last hour, just ahead of the expiry, we saw big uptick in the market, at least 40 to 50 points from the lower level. At one point, Nifty had slipped below 26,000, but at the end, it closed above that. So 25,900 to 26,000 would be very important range for Nifty to protect. As far as flows are concerned, yesterday we have seen that FI is selling the index futures of almost 2,500 crore. Also, they have added short positions more, and also they have reduced long positions. So in the longs, they have reduced positions by almost 3,100 contracts. On the short side, they have added positions of more than 9,600 contracts. And now their longs exposure has reduced to 16% from the earlier level of 18 to 9%. On the short side, the exposure is around 84%. If you take a look at the options data on the call side, 26,100 and 26,300 have seen maximum increase in the open interest, but premium for both these options has seen a fall. On a similar line, even on the put side, for 26,000 and 25,900 put options, premium too has fallen. Now support for Nifty 25,900, resistance remains around record high of 26,300. For Nifty Bank, support would be 58,800, that is 20-day moving average, and resistance would be around 59,900, that is also the record high. So the stock that will be in the focus in the band is Saman Capital. Apart from them, keep an eye on Asian Paints and SBI Card. These two stocks have been seeing fresh longs. On the fresh short side, keep an eye on from PSU Bank's back, Indian Bank. After a long time, this stock has been seeing fresh shorts. Also, from the mutual fund space, CAMS and HDFC AMC have been seeing fresh shorts.
Okay, thank you so much for that, Sudarshan, for the update in the world of F&O. But let's move on and talk about Meesho, because their IPO of around 5,421 crores opens for subscription today, with the price band for the offer set at 105 to 111 rupees per equity share. Now, ahead of the issue opening, the company last evening has raised 2,439 crore rupees from 60 anchor investors, including global funds like GIC, Fidelity, BlackRock, and also tech investor Dragnea. SBI Mutual Fund among the mutual fund side, Access Mutual Fund, Birla Mutual Fund are some of the anchor investors as well that came in from the top mutual fund anchor book side of Meesho. Now, we also spoke to the top management of the company earlier to understand their valuations, growth prospects, and a lot more. Listen in to some of the excerpts of that conversation.
We have been a private company. Now, when we are turning public, I think the foremost objective that, let's say, with it, Sanjeev, the board had was that how do we get the most high quality long-term shareholders into the mix, be it domestic investors, foreign investors, sovereign wealth funds, etc. And at what value are they, attracted to the offering? And that's been the defining function. So when our bankers kind of presented to our board saying at this valuation level, most people are comfortable, and then the board kind of took that on as advice and agreed on this valuation. So we believe it's an attractive one, and we'll see it play out.
I think in terms of profitability, the most important metric that we optimize for is free cash flow. Like if you look at any company that's actually valued at the net present values of the free cash flow it generates over the long term. So instead of any other operating profit metric, the most important thing for us is free cash flow. If you look at the last 2 years, we've been free cash flow positive.
Right.
And I think that will continue to be a focus area even going forward. We are actually, and I would say we've been a very, very customer-focused company from the beginning. And we believe it takes a lot of effort to earn the trust of your customers. And anything which basically goes against some of those principles, we'll not do.
Okay, on that note, we're actually going to slip into a very short break. We'll get you updates from the White House in our next segment after the break. That's the Trump Watch segment. Stay tuned in. Welcome back. Thanks for staying tuned to Power Breakfast on CNBC-TV18. Now let's get the update on what happened on Wall Street, because Wall Street rebounded to end Tuesday's trading session higher as tech stocks started seeing a recovery. The Bitcoin bounced back as well, above the $90,000 mark. We have CNBC's Julia Boostin, who's here to give us a wrap on what happened on Wall Street.
U.S. markets were up across the major indexes in Tuesday trading, boosted by a surge in tech names. The Dow gained 185 points, the S&P 500 added 17, and the tech-heavy Nasdaq was up 138 points. Billionaire Michael Dell and his wife Susan announced Tuesday that they have committed to donating $6.25 billion to fund investment accounts for 25 million American children. That works out to $250 per child. According to the nonprofit partnering with the Dells, it's the largest ever donation devoted to kids. The money will go hand in hand with a new administration program dubbed Trump Accounts that allows parents to open investment accounts for children under age 18. Agriculture Secretary Brooke Rollins on Tuesday threatened to cut off federal funding next week to states run by Democrats over their alleged refusal to share personal information from SNAP program data with the Trump administration. Rollins says it will apply to 22 states, including New York and California, and that it's necessary to root out fraud and abuse. Democratic state officials have argued the demand is unlawful and part of an administration effort to collect personal data for other purposes, including immigration. The SNAP program provides food benefits to more than 40 million Americans. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that, Julia. But let's move on, and all eyes are on who the next Fed chair would be, even as Federal Reserve's final rate decision for this year takes place next week. On that note, listen into Mohammad Al-Arian of Alliance giving his view on the elements of potential candidates should focus on and what his outlook for the Fed is.
One is, do we continue making progress on AI, life sciences, and robotics? Two, do we focus not just on who's working on AI, but who's working with AI, meaning on adoption? That's going to be clear. We need an adoption policy. Otherwise, we don't get the productivity gains. And third is the mindset of companies. You have a few companies like Accenture that are thinking of AI as labor enhancing. The probability of a December cut, the implied probability of a cut on December 10th is about 92%. Look for January and the next two, it's around 30%. So the market thinks you'll get the cut. They think it's going to be what they call a hawkish cut. And the Fed is more likely to be paralyzed until a new chair comes in.
Okay, now let's move on to our special segment, Trump Watch, and getting you those latest developments, starting with U.S. President Donald Trump, who has announced plans to reveal his choice for Federal Reserve chairperson in early 2026. He hinted National Economic Council Director Kevin Hassett as a potential candidate, calling him a respected person and signaling that Hassett could be in the running. Listen in.
I want to thank you all for being here. It's a great group. And I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin.
Now, moving on, shares of American Bitcoin Corp plunged in Tuesday's trading session after the locked-up shares of the companies co-founded by U.S. President Donald Trump's son, Eric Trump, became eligible to be traded. The stock plunged as much as 50% in just the first 30 minutes of the trading session, triggering multiple trading halts during the course of the day. Let's move on to some more updates that came in on the healthcare front. Now, President Trump claimed that the prescription drug prices have significantly decreased, attributing this to the implementation of the favored nation status. Now, he described this as a revolutionary change in U.S. healthcare system. To more updates, meanwhile, President Trump also weighed in terms on the immigration front, expressing strong opposition to Somali immigrants, labeling some who enter the U.S. as garbage and critiquing Somalia's reliance on U.S. social safety nets while adding little to the country. To more updates and turning to some bit on the trade front, Trump revisited his tariff policies, targeting allied nations without naming specific countries, but notably refusing to mention Japan or South Korea. He reiterated that the tariff revenues would be redistributed to Americans as dividend checks, and even floated the idea of abolishing a federal income tax because of the tariff imposed and the revenue that they could get in over the next few years. Moving on to some more updates on what President Trump said, and he's added that the U.S. is no longer financially involved in Ukrainian conflict, criticizing current, Biden administration's financial support as excessive, which had happened in the past, describing it as handing out $350 billion like candy, mostly in cash and equipment. And in the final update that we have for you all today for the day, that is Russia and Ukraine peace deal talks. What's happening on that front? These talks were going on in Moscow, involving the US envoy Steve Witkoff, as well as the Russian President Vladimir Putin and Trump's advisor Jared Kushner, where they described it as constructive but incomplete. Russian advisor Yuri also said that no compromise were reached regarding Ukraine's territorial demands. Putin rejected Europe's peace deal demand and declared Europe should be ready for conflict if it chooses to engage. Now, that's all the update that we have for you all today. We'll get you all more in tomorrow's edition as well. But on that note, we're going to actually step into a very short break. On the other side, we're going to be focusing on commodities. Stay tuned for that. Welcome back to Power Breakfast on CNBC-TV18. Now let's move on. The Telecom Minister Scindia defended the decision ordering smartphone makers to preload the state-owned Sanchar Sathi cyber security app. Union Minister of the State for Communication also says that there has been a working group formed to raise their concerns on this front as well. Listen in.
We requested all the original equipment manufacturers, and there has been a working group formed to raise their concerns. And Apple is the only company, as far as I know, did not participate in that working group. But all the rest of them have participated. They asked their, whatever the clarifications, and DOT has given. And then the notice was given. But even now, this is just like any other Facebook app or Google Maps, that kind of app. If you don't want to use it, you can delete it. Unless you have a login and you really register and want to open, then only it will work. Otherwise, it would not have any access. It would not take any of your personal information, your contact information, your email, or anything whatsoever.
Okay, now let's get the updates coming in the world of commodity. As always, we have Manisha Gupta joining in with us this morning to talk to us about what we should be keeping an eye out on. Manisha, what's on your list? Gold, silver, crude? What are we keeping an eye out on today?
Well, thank you for that. I'll start with the crude oil prices because we've seen them slip slightly below $63 a barrel. One, the U.S. president held a meeting on Venezuela as tensions escalate there, so that's something that the markets will keep an eye on. The other is that the Ukraine has carried repeated strikes on Russia's energy facilities. So even as there is a conversation about a peace talk there, on ground, is what is keeping the markets choppy there. What has seen gains in the overnight market has been metals as a sector. While we may have seen some profit taking in the base metal prices, but the ferrous metals, which have been underperforming this year, overnight have seen some gains come back. So you have the Chinese iron ore prices trading at a 1-month highs. The steel rebar is trading at a 3-month highs as well. This is after the Chinese government says that they will impose new measures to support property market. They may lower taxes on home buying, mortgage subsidies, etc. And that clearly seems to be supporting the ferrous metals in the morning today.
Okay, Manisha, thank you so much for that. We'll keep an eye out on crude as well as iron ore. But after weeks of turmoil over a US-backed peace plan, the high-stakes Kremlin meeting has now concluded. Russian President Vladimir Putin held nearly 5 hours of closed-door talks with US President Donald Trump's special envoy Steve Witkoff and presidential advisor Jared Kushner. Washington is pushing to salvage a potential deal to end the almost 4-year war in Ukraine, and the completion of these talks marks one of the most significant US-Russia engagements since the conflict began. The meeting wraps up amid fresh warnings from Moscow to European nations, deepening concerns in Kyiv and across Europe about where negotiations are headed. Kremlin foreign policy aide Yuri briefed reporters after the talks, calling it a useful discussion, but acknowledging that they are no closer to resolving the crisis in Ukraine and that there is much work to be done. Okay, and with that, we're absolutely out of time on this edition of Power Breakfast on CNBC-TV18. Nifty implied indicating a muted start for the Indian market. Soon go anywhere. Up next, your Pasar Morning Call.
morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, Wednesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. This morning, it's all about reading in between the lines. Do we have the new Fed chief announcement or not? What do you guys think?
Anyone's guess, huh? But it looks like directionally. I think he's given the hint.
I mean, he said it.
Yeah.
In almost as many words.
What did he say? I think we'll play the soundbite in a bit. I think Hassett was in the room and he said, well, I think the next Fed chair is in the room. So I think, what else, right? But, that's Donald Trump for you. But, as always, let's start from the beginning in terms of what you need to know as we begin this new session. 20 days to go for the end of the year. I just want to sort of look at that and kind of somehow just feels that you're sort of finishing something and you're going to start something new as you begin this new year. But, seasonally, by the way, end of the year is a strong period for global markets, for equities, etc. So far it's not been, at least here in India. When we started, actually a couple of months earlier, and the mood started at least, what people were writing and the sell side view, etc. All of that changed about a month and a half back, but it's yet to reflect on the screen in any significant way as we roll into the end of the year. US equities, they rallied overnight and I dare say led by an 8% rebound in Bitcoin. It's like the tail wagging the dog. Basically, it's got, there was an 8% crash in Bitcoin, there's an 8% rebound, equities sold off and equities have rebounded. That's the short story. S&P about 0.25% higher, NASDAQ 0.6%. And by the way, Bitcoin prices briefly topped $92,000 once again. They'd come down to about $83,000 at the lows that we saw in the last 48 hours. Now, Trump has signaled publicly that his longtime advisor, Kevin Hassett, will be the next Federal Reserve chairman. The Fed Chair Powell, current Chair Powell, essentially steps away and his term ends in May of 2026. Kevin Hassett, the agenda and what Trump has, of course, publicly demanded of the current Fed and, of course, the new Fed under Kevin Hassett is going to be lower rates. A lot more focus on inflation and lesser on labor markets. And I think, one mandate over the other. Will Kevin Hassett be able to swing this for President Trump is the question. As we've seen over the last 2 months now, it's not been so easy. People have voted both ways, depending on what data they've got and not got because of the shutdown, etc. Now, the 10-year yield was unchanged, 4.08%. Oil prices came off about 1%, but not going anywhere, 62.5 on Brent oil prices. There wasn't too much data last night, but tonight we've got data coming in from, we got US ADP, that's a private payrolls number, and you've got the ISM services data, which will come in as well. And we've got the manufacturing numbers, which came out earlier. I just want to mention 2 or 3 stocks because they've been such outsized movers. So Boeing was up 10% last night after it said deliveries of 737 and 787 jets will rise in 2026. These are large stocks, and they moved in a pretty significant way. Intel was up 9%. Intel said they're investing $200 million to put up an installation and testing center in Malaysia. It's like an OSAT facility in Malaysia. Tesla fell. Michael Burry, the famous, big short investor, essentially calling the shares ridiculously overvalued. We will talk more about that one. Here in India, it's been slow, it's been grinding, and it's, of course, been sideways to lower. That's been the price action. The primary market remains hot. There are 2 issues opening. Both are pretty interesting. Meesho is the one which I think will garner a fair bit of interest. It's a near 5,500 crore IPO. They're looking for a market cap of about 50,000 plus crores. It's a mix of OFS and primary offering. And the other one is Aecus, which is a company in the defense aerospace field. And that again is, I guess going to be hotly bid for. It's a unique company, which we will talk more about a little later. Both companies, by the way, coming up in the next 2-3 hours here on CNBC TV18 for a chat with the promoter and management. Now, I'll just tie in with the levels. The Nifty support stands at 25,924, which is the 20-day moving average. We, by the way, closed pretty, I think, 80-90 points away from that level. And the Nifty Bank support is the 20-day moving average, which is 58,775. Again, with the fall yesterday, those gaps between the current last close and the 20-day has narrowed quite a bit. So that's the overall picture as we begin another session. GIFT Nifty, I think, is flattish, slightly lower, 22 points. Lower is the implied open. F&O stats, positioning, how's it looking? Nigel has walked across to the wall. Nigel, over to you.
Well, if we get that GIFT Nifty downtick of around 20-30 points odd and putting together yesterday's weekly expiry close, which normally you see a big move in the final hour of trade, I think the Nifty should bounce back. It should undo some of what we saw yesterday and add to that the negative close, negative opening that we're likely to see. So yesterday's downtick of around 140 points, and today if we get 20-50 points lower, maybe we see a bit of a recovery. And yesterday it clearly had expiry that played out in trade yesterday. But there were a couple of positives actually. One being that the Nifty was down, but after a while, the Nifty Next 50 actually outperformed. And you had the mid and the small cap indices as well that outperformed, though the Nifty was down 140 points. Portfolios haven't been feeling too good, and you like to see more of a broader market participation, though the Nifty is holding on to its ground. In terms of institutional flows, well, the FIs were sellers, the DIs were buyers, but net-net, the DIs were buyers to the tune of close to around 1,000 crores. Moving to, the Nifty as well as the India VIX, that should come up for you on the screen because the Nifty ended lower, but the VIX as well was lower. That's normally a good sign from a bullish perspective. Not too much concern in the system, at least as of now. Well, in terms of what did the FIs do on index futures? They went ahead and they added some short positions, they unwound some long positionings, and now the total net short positioning is at around 1 lakh contracts from the FIs itself. And that was perfectly depicted, right? Because in yesterday's trade, you had some addition on the Nifty, so there were some mild shorts that got added out there. While on the Nifty Bank, there was some unwinding that we saw on this particular index. Moving to the options data then, the PCR, as we have mentioned, it's cooled off from the recent peak of around 1.5 because the call writers are getting very aggressive. 26,000 call, 26,200 call. Just take a look at the open interest addition on both those two strikes. While on the downside, this 26,000 put has seen a fair bit of open interest addition and the premium is around 90 rupees. So you plug in this 90 rupees and you look at the 20 DMA and you get that support zone. This 25,900 mark is the extremely important mark that you want to defend on the downside because that's where the 20 DMA is at. And in terms of a range, the upside range is at the recent high that we're looking at. The Nifty Bank, well, that's been pulling back for the last couple of days. I think it's pulled back close to around 800 points or thereabouts. But you want the 20 DMA to get defended, which is around 500 points away from current levels. And the Nifty Bank actually will have to lead the way. Another cue that we'll be tracking is the Indian rupee. That's been showing some sort of weakness. You want some stability on that front. You know, let it find its level and then stabilize around that mark because that makes things a little bit uncomfortable. On a macro perspective, you'll see our exports become more competitive, but you'll want some stability on the Indian rupee. That's something that traders will track as well.
Oh, absolutely. And we need to see if today is that 90 mark or if there's a bit of a cool off from these really heated levels for the dollar. By the way, do keep a track of the other development and the very important development in the AI space, the whole race for AI. Yesterday, Amazon, unveiled its latest chip. It's called the Trainium 3 chip, and it could take the fight straight to the heart of the incumbent, which is NVIDIA. They also put out a roadmap for the Trainium 4 chip. And these chips are promising AWS, Amazon Web Services, promises that they will have better compute capacity, they'll be cheaper. Very interesting developments over there. Yesterday, of course, most of these stocks were up and about, including Amazon and NVIDIA. Very quickly, let's actually play out the soundbite, which got everybody sitting up to take notice. And yes, I'm referring to what the US president has to say on the new Fed chair. Now, Mr. Trump has announced plans to reveal his choice for the Federal Reserve chairperson in early 2026. He hinted that National Economic Council Director Kevin Hassett as a potential candidate, calling him a respected person and signaling that Hassett could be in the running.
I want to thank you all for being here. It's a great group. And I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin.
He's a respected person. Does that mean he makes the cut? Well, it's still a cliffhanger. we will await the final announcement from the US president. By the way, this morning, Asian markets are slightly mixed in texture. You've got markets like Japan and South Korea, which are doing really well. Both are up, but then there's some profit taking in the Hong Kong market. Taiwan's holding higher. So fairly mixed. Now, where does this leave us? Let's quickly check the GIFT Nifty and the implied open, because the bulls have been slipping in the second half of the session, and that's become a bit of a trend last couple of days. The start is going to be fairly cautious. Remember, yesterday in the afternoon session, we actually slipped below the 26,000 mark as well. So we'll see how it plays out. Right now, a cautious opening is expected. Let's move on and welcome our first guest on the show. Herald van der Linde, Head of Asia Equity Strategy at HSBC, is with us. Herald, great to have you in. You know, that's the real question that I think we've all been asking ourselves as well as most of our guests. So I'll start right there. Whether you think we will see more of a diversification away from the big US AI trade, US or China AI trade. If you see that happening, and if you do, then what could the implications be for India?
Well, actually, I'm quite positive on India in that regard. So I do think that we move away from the big AI trade. That doesn't mean that I don't believe that AI has come to an end. It is just that everybody has invested in it. And if you look at the positionings in some of these markets, to think about Taiwan and Korea, they are pretty heavy. Hynix is in Korea is now the second most overweight stock in Asian or emerging market portfolios globally. And TSMC, most Asian funds have about 10% of their portfolio in TSMC already. So I think the AI story can continue, but I think the way people have invested in it is that they're coming to how much more can you really buy? And that comes maybe at a time whereby people say, well, is there anything else then in Asia that they can look at? The China recovery this year in the China market has been really a domestic story. So foreigners could go there. But I think also we see now encouraging sort of data coming out of India. And my suspicion is that as we go into 2026, that foreign investors increasingly going to put India back onto their radar screens.
Harold, hi, morning. I hope that is true. And if they decide to do it, they're going to get to buy at an attractive dollar rupee rate, right? That's the silver lining of this sharp depreciation of the currency. Would you see it like that? And what's your view, if you have a view on the rupee itself?
No, I think this is absolutely right. If you look at the valuations of China, for example, or Korea, you can take it as well, versus India, India's stock market has come off in the last, say, 18 months. The other markets have rallied, and in US dollar terms, that's even more so the case. So India is clearly starting to offer good value as against some of the other markets in the region, which is why I think they come back. The dollar rate is very important, very important here. And what might help India to a certain extent, India's in a cutting rates sort of mood, but the US has not. And this is one of the reasons why some of these currencies, including the Indian rupee, have been a little bit under pressure. But if the US is going to cut interest rates into 2026, or maybe this December, it would probably mean that, you don't see that much further weakness in this particular currency. So then you think about, from a foreign point of view, hey, maybe it's not too bad to go back into India and have that rupee exposure, and you can buy some of these stocks at pretty good valuations now.
All right. Hi, Harold. Good to see you in as always. And good to hear you're sounding far more optimistic about India post the recent underperformance. Harold, I wanted to ask you about the Fed chair, right? Since you briefly mentioned in terms of central bank action. Mr. Trump has stopped short of, saying that Kevin Hassett is the next central bank chief, the Fed chief. What is your view on it? I mean, initial reaction suggests that he is more bullish. I think he's leaning towards cryptocurrencies. He could be a little bit more dovish as well. Do you echo that sort of sentiment? And in that case, the dollar continues to weaken a little bit, which is good news for emerging markets like India.
Yeah, I think on cryptocurrency it's very difficult to say anything. I mean, I look at the current crypto, it's actually come off quite a lot right over the last couple of weeks. It's an industry that eventually will need to be regulated or will go through some sort of regulation. So we'll see how that's going to work out. But more importantly is what is he going to do on the interest rate front. Now, if he were to be appointed, he comes in, of course, at a time when the Fed is cutting interest rates. It already done so, it's waited. The feeling now is that they go in December again. and maybe we'll see a little bit further into 2026. That in itself could well be warranted. We'll have to see how the data is going to work out. What we, of course, also have to be cognizant about is that if any Fed chair comes in but is too aggressive in cutting interest rates, and we saw this in the early 70s and the late 70s, it only spirals inflation at a later stage. And then, you'll find yourself mopping up all that excess liquidity at a later stage by raising interest rates again. And that happened very dramatically in the 1970s. So let's see what he's going to do. But at the moment, any Fed that comes in probably has some tailwinds behind him in terms of cuts have already taken place, and maybe still some of that needs to further take place, depending how the data comes out. But that's the direction.
Yeah, absolutely. Harold, 30 seconds, if you will, weigh in, right? The other story which is developing is, I mean, you look at the JGBs, right? The Japanese government bond yields, which are back at 2008 highs. You know, the old question, you know, people borrow in yen and then buy everything else, US stocks included. If the yen were to appreciate significantly, and first of all, do you think it will? By the way, what's the risk? Is the risk that the governor of Bank of Japan sounded a little hawkish, but did he sound hawkish, or the market feared that he did not sound hawkish enough, given where inflation picture, etc. is, and what the new Prime Minister is saying she wants to do? What's going on, briefly?
Yeah, very briefly. Japan is the only country that is really looking at raising interest rates around the world, as far as I can think. It's got to do, of course, with the labor market being very tight and these sort of things. We think they need to raise these rates. So I think this talk of him saying this is the direction we're going is probably good. We think that they've probably been on hold for a little bit too long. But a stronger yen is not so good for the equity markets. And you saw this earlier this week, the Japanese equity market initially coming a little bit under pressure because it's mostly exporters there. And a stronger yen, that doesn't really work. So you have the yen rates going up just when the US dollar rates are coming down. That might not be over.
But Herald, does it really impact global markets to that extent? I mean, back in the day, yen carried trade was the big global trade, but a lot of that started getting unwound as well over the course of the last 2-3 years. So if the yen keeps appreciating and if Japanese bond yields keep appreciating as Japan hikes rates, does it really mean volatility? What does it mean for rest of the world equities?
It could mean that within Asia, you see a redirection of flows. A lot of money has gone into actually has been repatriated over time. The Japanese savers, but also the Korean savers, are really important sort of forces of investments in the region. So it could be having major implications in that regard.
Okay.
For them, if the stock market comes off, they might be wanting to look somewhere else.
Okay, so another watch point as we enter 2026, not just who's the next Fed chief, but as usual, the ongoings in Japan have a big bearing on global markets as well. Thank you so much, Herald, for joining in.
The lady in Japan has shaken things up. Right?
Oh, yeah?
New Prime Minister, picking a fight with China, wants to spend her way out of a lot of the sluggish economy, and so lots of changes. Although there was this article which said that Trump has called her and said, "Well, pipe down, don't pick up a fight with China." So
you can say I'm taking a leaf out of your book, so I like to keep it interesting.
Harold, thanks very much. Great speaking with you. Appreciate it, and good speaking on CNBC-TV18. Let me just quickly run you through what the interactions are here over the next 2.5 hours. So the Misho management will be joining us in just a bit. So 8:35, you'll hear from them. So we have Vidit Atre and Dhiresh Bansal of Misho. So quite a bit of interest there. 9 o'clock, we get you a special conversation with Asian Paint CEO Amit Single in a brand new edition of CEO Centimeter. 9:20, Kotak Institutional Equities is Pratik Gupta. Does he still believe markets are in a bit of a liquid oxygen state? 9:35, Bajaj Auto joins us, post reporting an inline November sales number. Management of Blue Star speaks with us at 9:45 to talk about their outlook for the second half. And it's the economy at 10:15. Lata in conversation on the falling rupee and soaring GDP. And, what's the interplay? She's going to be speaking with former MPC member Ashima Goyal and Neeraj Gambhir of Axis Bank.
All right, time to slip into a short break. But when you come back, we'll be focusing on our top 10 stocks that we're going to be tracking for you. Stay tuned.
Welcome back. So as we've been telling you, Qs are sort of flat across global markets. We didn't have a very big directional move on Wall Street overnight. Markets put on small gains here and there. And the Asian picture is mixed right now. You've got Hong Kong, which is selling off a little bit. China is down a little bit. But then other markets like Japan, South Korea, all of them are up and about. Where does it leave us in terms of the implied open right now? Last time we checked, GIFT Nifty was indicating a start which is about 20 points lower. Yeah, so 23 points lower. Cautious start is what we seem to be in for. Now let's focus on the stocks that should be on our radar, and our team is standing by with a list of top stocks to watch. Guys, morning to all of you. Let's start with Sudarshan. What's on your radar, sir?
So I'm tracking Maruti. For Maruti, it's a time for E for me. That's the name that the company has given for its app for EV ecosystem. They have made two announcements. First, they have unveiled electric vehicle, that is e-Vitara. And second, they have launched EV ecosystem. So first talk about e-Vitara. So now they are yet to announce the prices, but bookings are expected to start the next month. And the range for this car would be 543 kilometers. Now talking about the EV ecosystem, company has signed agreements with 13 charging point operators and aggregators, and they have established 2,000 charging stations. Target is to increase to more than 1 lakh by 2030, and also they're planning to have charging stations at the distance of 5 to 10 kilometers in top 100 cities by 2030. So overall, after a strong set of numbers, company reported for the month of November, and this is the positive development. I'm going with green.
Okay, all right. Thanks a lot for that, Sir. Well, let's hop across to Upasana. She's here to tell us about some stocks that are in the news. Morning, Upasana.
Good morning, Nigel. First up, let me start with Bank of Maharashtra. Now, bank to exercise green shoe option for the OFS. Mind you that the government is selling up to 6% stake via OFS, including 1% green shoe option. Now, non-retail portion of the entire OFS gets subscribed more than 3x times. Hence, this stock will remain in focus today. Now, PSU banks also in focus as Finance Minister responds to a query related to increasing FDI in PSU banks to 49%, to which the Finance Minister has clarified that no such proposal is approved. Next up is Oil India. FM approves upgradation of Numaligarh refinery to Navratna status, and with this it becomes 27 Navratna amongst the various other CPSEs. Canara Bank will also be in focus as company raises fund worth 3,500 via Basel III compliant Tier 1 bonds, and it includes base size of 1,000 crores and green shoe option of 2,500 crore. And lastly, coming to APJ Surendra Park Hotels, company has executed a lease deed here with Katzen Hotels for taking a lease of a fully furnished and operational hotel property known as Casa di Katzen in Goa, which includes 42 rooms, and the lease period is nearly about 12 years is what the company has indicated. So all in all, we'll be looking out for all these stocks in today's trading session.
Okay, all right. Thank you for that, Upasana. Back to Sud then. He's also watching out for a few other names beyond Maruti. Which ones are these, Sudarshan?
So I'm tracking Angel One and Rally. So first about Angel One, I'm going with red because the company has given the updates for the month of November, and except client base, all the other metrics have seen a decline both on a monthly basis as well as YOY. So gross client acquisition is down 11% month on month and down 16% YOY. Client base though has increased by almost 2% month on month and has increased by almost 22% YOY. Even number of orders has fallen 12% month on month and it's down almost 10.4% YOY. Even average daily orders have seen a fall of 8% month on month and down 15% month on month. Talking about rallies, Ask Investment Managers has bought more than 11 lakh shares, and that was done via block days, and price for the same was rupees 266.70 per share.
All right. So thanks very much for that. Well, some positive news flow as far as Sun Pharma, Dr. Reddy's, maybe even companies like OneSource, etc. Ekta is here with what's happened. Ekta, morning. Winnie is going to take us through what's happened here in terms of developments. Winnie, take it away.
Yes, so in terms of Sun Pharma, obviously they've announced a 3,000 crore investment that is going to be mainly a greenfield project for formulation facility that they will be setting up in Madhya Pradesh. So increase in terms of the formulation side is a positive that comes in for Sun Pharma. Now, Dr. Reddy's OneSource, we'll keep an eye out on that. Why? Because the Delhi High Court has allowed manufacturing of diabetes as well as anti-obesity drugs, that's a semaglutide in India, and to export it as well. Now, do not forget that this came in. Why? because Novo Nordisk had actually said previously and had filed a complaint with the High Court saying that they should not allow other companies to sell these drugs here. Now, obviously, Delhi High Court has allowed this. So, from March 2026 and onwards, once the expiry comes in for Novo Nordisk drugs on this front, there will be sales that will come in for Sun Pharma and, beg your pardon, Dr. Reddy's, as well as OneSource. That will also be in focus on the back of this.
Okay, so there's some respite coming in after March 26. Thanks to that Delhi High Court order. Got it. Vinny, thank you so much for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them this morning would be Maruti, Bank of Maharashtra, Oil India, Canara Bank, APJ Surendra Park Hotels, Sun Pharma and Dr. Reddy's Laboratories. Stocks with negative news flow would be PSU Banks, Angel One and Rallis India. Okay, let's figure out what's happening in the world of commodities. Manisha is joining in with a roundup. Before we get to commodities, Manisha, crypto dancing away. Yesterday was swinging to the other side. I think some 6-7% up on the Bitcoin, right?
Oh, yes. It's a new story every single day. Yeah. But, that really tells you with all the markets actually are now slightly downplaying the Japanese threat and is the reason you've seen all of them come back. So it's not just about crypto, but you've seen some of those equities do well as well. So it seems to be moving in tandem. And we've really done and realized as well that crypto and the S&P 500 or NASDAQ in that sense correlates or moves together in tandem most of the times, which is 48 to 52%. So that's exactly what seems to be happening at this point in time as well. But commodities then, and well, we have seen a bit of a profit taking happen in case of gold and silver prices, still trading on the higher side of the range because the markets are working with an 88% probability of a 25 basis point rate cut in the Fed December meeting. Having said that, you also have seen the US dollar index regain ground versus Japanese yen. The US 10-year Treasury yields are trading at a 2-week highs, is the reason you've seen this pause coming for the precious metal prices. But what is doing very well today is the ferrous metals. After underperforming most of this year, we are looking at steel now trading at a 3-month highs. Iron ore prices in China are at a 1-month highs. This is after Chinese government has said that they will impose new measures to support property market. There has been a conversation about lowering taxes on home buying, mortgage subsidies, and that is something that the markets absolutely like and is supporting the metal prices.
Okay, all right, Manisha. Thanks a lot for joining in, giving us that quick update. Well, for the time being, we slip in a short break. On the other side, we have the management of Meesho, who will be waiting by to talk about their issue, which opens up today. Stay tuned.
Welcome back. 25 minutes to go for the pre-open session to kick off. 20 points lower is what we have right now. Now, e-commerce platform Meesho's 5,421 crore IPO opens today. We have the management joining us, but we want to set this up with what Meesho does, a little bit about how it's different in terms of how it makes its money compared to other platforms and more. Mangalam is standing by with the details. Mangalam, over to you.
That's right. So the IPO opens today. It's a 5,400 crore IPO, of which fresh issue is close to 4,250 crores. And at the upper end of the price band, the company is actually seeking a valuation of almost 50,096 crores or 50,100 crores. And there had been a strong demand from the anchor investors as well. Yesterday, they raised about 2,400 crores from the anchor investors. The book was subscribed 32 times, so 80,000 crore worth bids coming in from the anchor investors. And SBI Mutual Fund was the key out there, which picked up 25% of the allotted stake for anchor investors. The others were GIC, BlackRock, Fidelity, and the others. Now, Meesho is obviously India's largest e-commerce platform, and the moat is that they do not charge sellers any commission or platform fees to consumers. How is it that they make money? They monetize their platform via services to sellers such as fulfillment, which is logistics, advertising, and data insights. The important part, it's a pure Bharat app where 87% of its transacting users actually come from outside of top 8 cities. And in the first half of this year itself, they had around 234 million transacting users. That's about 23 crore or 1 in 6 Indians. The opportunity, India has nearly 700 million smartphone users, and online shoppers are just around 250 to 270 million. So that's the headroom out there. As far as their financials are concerned, last year they did about 10,000 crores on the top line, but on a reported basis, they are still loss-making on EBITDA as well as the net loss. The first half of this year as well, the adjusted EBITDA loss was close to around 700 crores, and the net loss was also 700 crores on a 5,600 crore top line. The company looks at free cash flow as a growth metric, profitable metric for them, and their contribution margins are 3.8% for the first half of this year versus 4.9% last year. For all of this, what are they valued at? Now, because it's a loss-making company on a reported basis on EBITDA and net profit, we're looking at price to sales. It's much lower than Eternal, Lenskart, and Trend. But remember, the profitability is nowhere close to the others as well. At around 5.3, it's pegged closer to Avenue Supermarts, with the news that their profitability is not very close to Avenue Supermarts or the others that we're talking about right now. So what we need to know from here on is the growth path and the path to profitability for the company. They've been talking about growing at free cash flow level, and at the same time looking at increased share of revenue coming in from advertising. That would be a margin lever for them.
Absolutely. And thanks very much, Mangalam. Really sets the ground for us to quiz the management. We have Vidit Atre, CMD and CEO at Meesho. We also have Dhiresh Bansal, Chief Financial Officer at Meesho. Gentlemen, great to have both of you here. Thanks very much for joining us. Prashant this side. Vidit, before we get into asking you about the path to profitability, and I think that's what's relevant for our investors, but I just want to tackle one issue which Bloomberg put out a story yesterday. Essentially, and it's a good problem to have. Too many people want your stock in the anchor book. Not everybody could grab or get their hands on what they wanted. And apparently, a bunch of funds like Capital Group, Aberdeen, etc. stayed away. I know it's not your fault. I mean, I think it's people who are managing the issue and bankers, etc. But just a quick. I don't know if you have any thoughts at all with it.
Yeah. First of all, thanks, Prashant, for having us here. So I think, as you said, there was a lot of demand for our stock, and not just in India, but outside of India as well. I think people have seen very similar stories in many other geographies in China, Southeast Asia, Latin America. So there's a lot of excitement about Meesho, I think, everywhere. And as you said, like, not everyone could kind of get the kind of allocation they wanted. And most of this was kind of handled by the bankers. So I don't have much to say over that point. I would also say that, like, our goal is to have the right long-term shareholders. So some of them who could not kind of come now, we'll keep engaging with these investors even in the future, and make sure at the right time they come into the company and basically capture value over the long run.
Okay, fair enough. And we'll try and get the bankers on as well. It's an important issue away from, of course, the Meesho IPO, which we are focused on now. With it, as Mangalam said, I mean, key to understand, of course, now is how you're thinking about being sort of consistently profitable and path to profitability. Just give us the outline of your thinking there. I know that we won't be able to push you to get some numbers out. Maybe we'll do that on the day of the listing. But give us a sense of how you're thinking about this question.
Yeah, I think we've been very consistent about this. We as a company look at free cash flow as the right bottom line metric. Any company textbook definition of valuation is the net present value of all your future cash flows. And as a company, we've been the most capital efficient asset light company, right? Like to kind of reach a lot of milestones in our business, we've actually spent the least amount of money as compared to many other e-commerce companies in India. And we take pride in that. We continue to kind of optimize for free cash flow. If you look at the last 2 financial years, we have been positive on free cash flow. For the last financial year 25, we generated almost 1,000 crores of cash. And even forward, I think we will continue to kind of keep looking at that while doing capital allocation within the company. I think as the business keeps growing, all the other accounting metrics around bottom line will obviously keep getting better. But we take a very long-term view to this problem. If the business is generating cash consistently, getting bigger and bigger, there's no chance that the shareholders get diluted again. We create more value for the investors in the long run. So we believe that's the right way to think about this.
No, absolutely. No taking away from that at all, Vidit. Free cash flow is always a very promising sign for public market investors. But we want to understand the way you're thinking about the path to profitability a little more. Maybe Dhiresh can weigh in on this as well. Dhiresh, so out of the money that's coming into the company, a fair amount is going to be spent on building up your tech. It will be tech systems, it's tech talent as well. I think over 400 crores is going to be allocated towards these brilliant tech brains that you want to have on board or already have on board. And I think about 1,000 odd crores, 1,020 is going to marketing and brand building, but almost 1,400 crores is going into cloud infrastructure. So my question really is, for how long will you be in the build out stage? And how much will the spends on tech be? Because tech is very, very intrinsic to the platform, time to delivery, the way the algorithms work, pricing and so on and so forth. So just give us some idea of how much spends on tech and then therefore what is the roadmap to profitability? Because while the free cash flow generation is there that Vidit spoke about, this cash is going to be constantly deployed into the business as well. So we need to just understand some of those details.
Sure. No, thank you for that question. And like you said, we are a technology platform. Most of our investments actually go into building out this technology. Actually, all of these investments that we make are expensed out in our P&L already. So it is not that we are capitalizing these expenses or they're going into the balance sheet. When you look at the net profitability metrics or EBITDA metrics, it captures the server cost that we spend, for instance, the people cost that we have on technology. All of those are captured in our P&L. So there is no capitalization of those expenses which is happening. If you look at the use of proceeds, we are raising these for the next 3 years. I think that is our estimate of, what is the spend going to be in some of these headers for the next 3 years. And if you look at the historical trends, as we have grown consistently, some of our fixed cost base, such as our server infrastructure and other kind of fixed cost line items, including employee cost as well, have not grown at the same path or at the same pace as our overall top line growth has been. So operating leverage is a key metric that we would kind of keep tracking. Our fixed cost base, let's say historically, the server cost grew by only 4.5% when we grew at about 35%. And we'll keep maintaining that going forward as well.
So Dhiresh, this spend of about, I think 30-90 crores is the exact spend on, your cloud, etc. And about 400 odd crores is the spend on people, specifically the engineers who are enabling this kind of, tech adoption. These are spends for how many years? I'm just trying to arrive at, if we look at the EBITDA level, the first half loss is about 700 crores right now. So you keep investing this money for what, 2-3 years? And then would it be fair to extrapolate that at least for the next 3 years, investors may still have to look at losses at an EBITDA level?
So the 700 crores, I think the number is slightly different. It's, I think, closer to 500 crores of...
Adjusted EBITDA is closer to 500 crores, correct? Yes. So we can talk adjusted EBITDA, fair enough.
That already includes these expenses of server cost, of the people cost that we have for this period. I think the estimate that we have, which is in part of the use of proceeds, is for the next 3 years. so the 1390 plus the 480 crores of technology-related spends that you see, are part of already our adjusted EBITDA for the current period. And for the next 3 years, we are saying that this is the spend, not in addition to the current adjusted EBITDA, but as part of the adjusted EBITDA that we have, the trajectory that we forecast for the next 3 years.
Okay, all right. Hi, Vidit and Dinesh, and good to have you all on the show. Welcome to the stock market, and hopefully we'll be chatting more often from here on. Well, let's focus on the growth prospect. All that adjustments and all, let's keep it aside. When your list will push you a little bit more. But let's focus on growth. So tell us, what will be the key growth drivers going forward? Will it be led by monthly transacting users expansion? Or will it be led by high order frequency? If you could give us some clarity on that front. And if you look at your core business, order growth has been good, but the AOV has declined. And you're expanding in new categories as well. So what's the steady state AOV you're looking at? Will it decline further or will it hold around these levels?
So if you look at...
So I think, yeah, go on, Dinesh.
Yeah. So I think if you look at the growth composition for the last 3 years, we have been consistently accelerating our NMV growth, which takes into account both our user growth as well as frequency growth in the business.
Okay.
If you look at our annual transacting user base, that increased from about 14% growth rate in FY24 to about 28% growth in FY25. And even in the first half of this year, as we crossed 23 crore annual transacting users, we grew even faster at about 35% growth year on year. Even in terms of frequency, our growth has been consistently there. The frequency used to be about 7.5 times 2 years ago, which is now inching closer to 10 times.
Okay.
So I think as we go deeper and deeper into India, we'll keep expanding the number of users who transact with us. And as our proposition becomes more affordable with the efficiencies that we are bringing in, the frequency of the users also continues to grow on the platform. And that will be the growth formula for the next few years to come. India is still very low when it comes to e-commerce adoption versus even other emerging markets. And a big way to kind of drive that adoption going forward is going to be affordability-led, where we are kind of leading the path.
All right. And AOV, you want to give us an outlook out there?
Yeah, so I think AOV might decline. We don't have a sense of kind of gauging that right away, but it'll come with more and more frequency unlock. So overall, from a GMV and an MV perspective, that is actually a beneficial thing to have, because that means that people are transacting in a lot many more price points than they were before.
Okay. Vidit, very small last question to you. Sorry, I'm going to come back to that path to profitability question. So Dinesh made it very, very clear that the investments in tech and people, all that's coming through the IPO proceeds, right? So next 3 years, you're absolutely fine. You're saying your operating cash flow has been getting better. Give us a sense of how much. And will it be better enough to take care of the adjusted EBITDA losses over what, 2 years, 3 years? Just trying to make sense of how this improving operating cash flow will plow back into profitability. Even a rough range in terms of how you're expecting it to grow, that would help.
Yes, I think before I even come to the calculation around cash flow, today we have two streams of revenue. One is around logistics and the second is around advertising. And by the way, both of these metrics, if you look at global e-commerce companies, tend to go non-linearly as the platform gets larger and larger. So the opportunity there is still quite large as we continue to expand our own logistics platform, keep growing our volumes. We have a large opportunity kind of make more revenue there. Advertising, we see our sellers, as we have more sellers on a platform, there is more competition and willingness for sellers to kind of use our ad products to get more visibility on the platform gets higher and higher. So both of these revenue streams will kind of see like exponential growth over the next coming years. Again, we cannot share projections. Now, even after this, we are adding new revenue streams to our business. So for example, we have an option of making money in a content commerce platform. Today, we are very, very focused on growth, so not capturing any take rate there. But our sellers basically take advantage of the influencer network and grow their business. There is an opportunity to make money there. We are recently starting our own financial services platform. That is a large opportunity. If you see some of the largest value commerce platforms in China, Southeast Asia, Latin America,
right
now they make a lot of like bottom line from financial services. So I think we're also investing in new revenue streams. So again, just in terms of growing revenue, there's a lot of potential there, and all of that should flow into bottom line, because all of these are very high margin revenue streams. And I think in terms of cash flow, as you see, like for the last 2 years, we've been improving consistently our bottom line around EBITDA, but we have been positive on free cash flow. So I think that will continue to be even going forward. I don't expect that to kind of change.
Got it. More questions when you list, but you've got a large captive user base and you can sort of provide a lot many more things in terms of those revenue streams you spoke about. Good luck to you guys and the team at Meesho as you come to the markets. Vidit and Dhiresh, thanks for joining us here this morning on CNBC TV18. Appreciate it.
Thank you.
Okay, well, we'll take a quick commercial break here. We're going to come back. We connect with Devin Chokshi. We talk some stocks, some markets. 11 minutes to go for the pre-open session that's coming up.
Welcome back. You're tuned in to Bazaar Morning Call. As promised, let's get in our fundamental expert. We have Devin Chokshi, Managing Director at DR Chokshi FinServ, who joins us on the show. Hi, Devin. Good morning. Good to see you, Ben. Another IPO hits the markets today. Meesho, any view on this one? Valuation-wise, debatable whether it's expensive or not, depending from which angle you're looking at it. But we just heard the management, so what would your view be?
Yeah, Nigel, good morning. Well, I think unable to understand the kind of value and the valuation that is being asked for on a 50,000 crore plus market cap with around 9,000, 10,000 crore kind of a top line and 4,000 crore of EBITDA of last year EBITDA loss of last year. I think the equations are not gelling well to me. Yes, do agree that there is a huge scope for the entire space as a whole and different verticals that they talked about, including financing verticals that they have got in. I would think that yes, they will have relatively better opportunity going forward. But the kind of numbers that they have to produce to justify this market cap would be quite steep, quite tall. I'm not too sure whether I think one should immediately give this kind of a valuation to this company. So we'll probably stay away for the time.
Stay away from Misho. Okay, got that, Devin. Let's talk about some old economy businesses like auto, Maruti. Now, Maruti, let's pull up the one-year performance on the stock. I mean, what a year it's been for the Maruti stock, right? 50% higher. And a lot of those gains came in after the GST cuts were announced. But the question is, what next from here, Devin? Can someone still buy Maruti? Should you buy Maruti? Now they're announcing their EV platform. The e-Vitara is launching. Do you think it will move the needle further?
Yes, sir. Very good morning. Well, I believe that it should. Given the fact that as a family of four today, suppose if you are earning a 50 lakh rupee worth of income, with 10 lakh rupees income, I think exempted from the income tax, I think you are having virtually tax-free income in your hand. And that's a purchasing power that we are talking about for any discretionary spending they could have. Along with that, the interest costs expected to remain low, and that is where probably I think higher amount of EMI-based purchases would start emerging. So, in my viewpoint, I think the auto sector per se should remain in a quite a strong hold, right? I think from the current levels as well. Even if we count around 10% nominal GDP, I think auto should be, I think, clocking it around 15% kind of a growth overall, as I see the sector. And the leaders like Maruti, with the launch of new vehicles, definitely attracts more customers. In my viewpoint, yes, I think as a structural move on the subject, I think the industry as a whole, we feel that I think the situation looks quite conducive. Maybe Maruti has had its role, I think, in the recent past as well. Some cooling off may be justified, I think, given the kind of situation in which we are in the market. But I think that correction would be a buy opportunity, as I see it. Likes of Maruti, likes of Tata Motors, even Mahindra and Mahindra. Good stocks, I think, I believe in.
Okay. All right. Devin, just stay on. We'll have more questions for you in a bit. Need to take a very quick break. We'll come back. We'll have the pre-opening rates, and also we'll get you today's trading setup with Sudarshan and Mitesh.
Okay, well, 14 minutes to go for the market open, which is going to come up in just a bit from now. And look at the pre-open rates, which are coming up. Should not be 200 lower. I think it'll settle in just a bit from now, as it always does. Sudarshan is with us, so is Mitesh, with what they'd want you to do as far as specific trades go and index and stock views. Gentlemen, great to have both of you here. Thanks very much for joining us. Mitesh, you go first. What's the view and what's the trade? Yesterday, of course, market ended, 70, 80 points away from the 20-day.
Yeah. Morning, Prashant. So I think, a couple of observations. One is that, again, we have kind of tapered off, failed to get past 26,300, and therefore, now that will be taken as a pivot in the short term, and a failure to get past 26,300, which is also very close to the earlier all-time highs, means that some consolidation is required. So most likely, to my understanding, I think it could be a range of around 850, 880 on the downside, to about 26,300 broadly on the upside. And therefore, I think the next buying should be attempted around or just below 25,900. That's the view on the index, the Nifty. Similarly, for the bank Nifty, I think, it's given a minor signs of profit booking on the hourly and 2 hourly charts. Therefore, some kind of pullback to about 58,800 is what I'm expecting. So in the short term, I think the markets will be slightly choppy, but broadly ranged.
Okay, all right. Got that, Mitesh. Coming to you for your stock calls. By the way, the rupee has hit the 90 mark. That was the mark that it was flirting around with in the last few days. And now it's gone ahead and it's breached that crucial 90 mark or thereabouts. Let's see whether or not there is some kind of support that comes in there to protect it from, drifting away further. Because the last few days it moved very, very swiftly from around that 88.5 closer to around that 90 odd mark. And as we speak, that's got breached. We'll wait by to see whether or not there is some intervention that comes in there to stabilize the rupee. But as of now, that's the big headline that's coming in there. Rupee moving to around that 90 odd mark. Very, very close yesterday. Today, it's breached that mark. We'll try to get you a couple of reactions. But for starters, the rupee is at a fresh all-time low. Well, going back to Mitesh. Mitesh, run us through your stock calls.
Yesterday, Nigel, we had 3 sells to a buy. Today, I think the ratio is even 2 sells to buys. Cyient was a call yesterday as well. It's still looking good to me. Now can be bought afresh with a stop at 11.55 for targets of 12.25. And the other buy call is on Siemens, which I would recommend buying with a stop at 33.20 or just below it for targets of 34.40. On the sell side is LIC with a stop at 900 for targets of 850. And Dower, I think, is a sell with a stop at 5 3/2 for a target of around 495.
Okay, all right. Sudarshan, your stocks, specific trades?
Let me talk about the Nifty first.
Yes, please.
Okay. See, yesterday was a disappointment. The Nifty breached that significant support level of 26,100 where our exits were placed for the long positions. And that means that the market trend is now unknown or choppy. So as far as the Nifty is concerned, there is no trade till new patterns emerge. We just have to leave it aside. For stocks also, suddenly there is a mix of buys and sells. Exide is a buy with a stop under 370. JSW Energy is an intraday short with a stop above 495. ITC is an intraday short with a stop above 406. And Union Bank is a buying opportunity with a stop under 150. So the Nifty is an avoid and stocks are a mix.
Okay, gentlemen, thank you both for joining us with that. We want to focus on the rupee as well in just a bit. And we have someone joining us to comment. Last 3 days, the pattern has been clear. The market, the rupee makes newer lows and then intraday it kind of pulls back a little bit. And I think what is today also something similar has happened. Abhishek Goenka is with us, founder and CEO at IFA Global. Abhishek, good to have you with us here. Good morning. So, what are you seeing on the screen? If you're watching what's happening, and what should we expect from here, Abhishek?
Hi. So, of course, we all know that the rupee is weakening because we don't have any clarity from the trade deal. And I think this point of time, that is the main thing which is driving the rupee. I don't think that only because of a poor trade deficit numbers, which has come recently because of gold imports, this is happening. I think also Putin is going to visit India. And I think there could be some trade deal announcement post that. And I think everybody's watching on India's stance on importing crude.
Abhishek, we know the reasons, but my question was more about what you're seeing on the screen now and whether people will be emboldened to short rupee from here, with the assumption that the RBI is not going to defend it beyond a point. Anandya Banerjee is also with us, and we also have Dheeraj Nim, who's with ANZ Research. Anandya, of course, is with Kotak. Anandya, welcome back. Come in with a quick comment. My question is more immediate. With 90 gone, is 90 something which, you're past 90 now, so what from here? You think this continued depreciation will be the case from here on, or will the RBI step in a more aggressive way, which they've not done so far?
Right. Very good morning. Thank you for having me. Yes, 90 is a very important psychologically. As I said yesterday, what happens is a lot of these option traders, especially in the offshore, they watch these large handles, 80, 90. So today is, right now is the day when the RBI is supposed to come in aggressively. Because if it closes above or it's trying to sustain above 90, we could see a more speculative move. Because, see, when speculators get in, they become emboldened. It creates a fundamental of its own. It's very then hard to put a macro perspective to it. Right now, it's pure speculative move, which is happening.
Absolutely, Anindya. In fact, I remember you said exactly the same, that if 90 goes, then we need to watch for 91 perhaps, if the speculators are not checked. And that's what we need to watch, whether the RBI comes in and stops excessive speculation. Usually when interventions happen, and this has been a bit of a free fall on the currency, 5% in a matter of weeks, you'd expect it at what time of the day, Anindya?
Generally, they come in before the fix, and the fix is around the noon. So that's when they come in. But I think with 90 gone now and it's trying to push higher, we could see the intervention soon. A heavy one. It has to be quite a heavy one.
Anandya, can I ask you, now at this rate, to push the rupee back, is there any, how much do you need to spend to move to push the currency pair back? Any broad number calculation? Any way to think about this question?
Generally, in the past, when RBI had tried to push it down by a rupee or more down, so let's say if they want to push it down to 89, then generally the interventions has been as high as $2 to $3 billion. But they have the option of using both the spot as well as the forward. They can even use the NDF. But the spot intervention is always the most effective because it creates a bigger panic with the speculators.
But does the cost keep going up? If you let it move like this?
Yes, because more speculators will join the party. And then it creates a self-fulfilling trend. So that's why the RBI tends to break such things. Because if you look at the RBI data that itself has shown that how their intervention or rather the gross activity has gone down, the buy and sell over the last 6-7 months. But this is a time when they have to intervene and try to check the volatility.
So, by the way, the first couple of trades were interesting because after hitting 90, the rupee, I think, straight away went to 90.14. That's been the low. And then it has pulled back a bit from there. And we need to see how it happens. And as Anandya is saying, the intervention might happen earlier, much before noon this time around. Dheeraj Nim is also with us. Dheeraj, what would your immediate expectations be? Would you expect heavy intervention? Of what nature, what magnitude? And give us a sense of, if you're looking at current positions, give us a sense of the rupee shorts and the dollar longs in the system as well.
So look, I think, of course, 90 is an important psychological level. And once it's broken, I agree that there could be some speculative interest that could come into the market. This is an RBI that, one, does not like speculation very much. And second, has been preventing an overshooting of the exchange rate. Despite the adjustments it's allowed. So I think that pattern is going to remain. They will not allow a runaway depreciation from the current level, so to speak, over a few sessions. But I do believe that over at least the next few months, until we have a clarity on trade deal, the rupee should remain on a modest depreciation path. Now, in terms of, how the flows are happening, look, we are seeing at the current levels because expectations have moved in a one-sided manner. There's a significant amount of importer hedging interest, and rightly so, because the expectations are going for a weaker rupee in the months to come. So I would imagine that, at the moment, from an economic configuration perspective, a weaker rupee is an adjustment that we require for the economy. And I don't want to overplay the script as in it's not really a bad thing that's happening for the exchange rate, but something good perhaps for the economy. So I think the RBI will control it. But of course, the recent action shows that they're open to further rupee weakness.
So adjusting to fundamentals in that sense, but where will that now level be, in your opinion? Not where it'll finally settle, but what do you think is the fair level given, the current account deficit, low capital inflows, etc.?
Look, we have rupee going up to 91.5 by the end of 2026. The risk is that it could be there sooner, but our view is also juxtaposed to our dollar view, which is that we expect the dollar would weaken by about 4 to 5% over 2026. So you can imagine the latitude along which we're expecting the rupee to depreciate.
Anandya, same question to you.
Yeah, see, currently the Indian rupee appears quite undervalued at this point in time. But again, when there is a speculative move, the market can stretch further. Because with the macroeconomic stability and the low inflation, yes, there is scope for the rupee to depreciate and stimulate the economy from the external sector without hurting consumption. But I think a point will come when somebody taking a 12 to 18-month view on the Indian assets as well as the Indian rupee will find it quite compelling to go long on the rupee. It might sound very crazy at this point in time to say that, but I think the rupee is getting quite undervalued.
Okay, just very quick last 30 seconds to Dheeraj, to you. I mean, that point on exporters benefiting is very well taken, but the risks of a very rapid move to beyond 90, what would the prime risk be? I mean, obviously, from a flows perspective, it's not been a great year. And then we're looking at a current account deficit situation as well.
Right. So I think from an economic data perspective, it's important to watch how growth evolves from here on. So any incremental data on growth which seems to suggest that we are losing ground could be problematic. We are also heading into the budget. Look, we have been fiscally comfortable the last few years. So any news flow that could perhaps indicate fiscal stress, and I think that's the risk that we are running with currently, could also be a problem for flows further. Current account deficit, yes, I mean, it's on the course to widen, but the broader expectation is that it will remain contained and manageable, so to speak. And if there's any news flow that suggests that that's not the case, that could also be a problem. So look, at this moment, market would be watching all economic data, all news flows very, very closely to understand what pace of rupee depreciation can the RBI tolerate. But that said, they have enough firepower to restrain the moves.
Got it. Gentlemen, thanks very much. All of you, Dheeraj, Anandya and Abhishek for joining us. Let's get the 9-10 calls out of the way. So, Darshan, what do you have?
It's JSW Energy, intraday short with a stop above 495.
Okay, Mitesh?
Buy on Cyient on the long side.
Okay, JSW and Cyient are the two calls coming through at this point in time. Just want to take a quick look at the stocks which are coming up and how they're settled in the pre-open the pre-open session. Will we have time to get a quick brokerage corner with Sudarshan as well? We'll try and do that. But for now, it's on your screen. Maruti, Bank of Maharashtra, Oil India. There's Canara Bank. You've got Sun Pharma, Dr. Reddy's. One Source is something you should pay attention to. PSU Banks is another pack. Angel One, Rallis India, etc. Sur is here now with what are the brokers saying in terms of calls this morning. Sur, over to you.
So Citi has written on Indus Towers mainly after Telecom Minister's statement regarding the relief package that is expected the month and believes that for Indus Towers it's a compelling buying opportunity and maintains high conviction buy with a target price of 500 per share. And Citi also has written on Reliance Industries. It has maintained buy call target is increased to 1805 per share. It says it has recently raised target for FY27 expected EV to EBITDA multiple for Bharti, and now it is reflecting for Geo2, which leads to an increase in enterprise value for Geo2, $145 billion, and now it has added rupees 65 per share as the contribution to the target price for Reliance Industries as because of the Reliance Consumer Products recent announcement, and now it has Reliance Industries remains the top pick in the oil and gas space. And Citi has also upgraded HDFC AMC to neutral from sell and target is increased to 28.50 per share and upgraded on
Indus Tower, Reliance and HDFC AMC. So more later. Apologies to cut you off, but markets have opened 25 points higher on the Nifty. The Sensex is starting in the green. but barely so. It's actually more or less flat. Nifty Bank is unchanged. The small cap index is unchanged. The mid cap index will come up. It's 35, 40 points on a 60, 61,000 index. Nothing at all. So it's neither here nor there. Absolutely flat rates coming through. You know, some of the stocks which Sud was talking about, we'll have them up as we go down the list. Nifty heat map should come up on your screen. Nifty 50 will do a quick check and move on to individual names. Up on your screen, more down than up. Sun and Wipro on one end, Tata Motors passenger vehicle and Indigo on the other end. Surabhi.
We've turned negative. I mean, this currency headline simply cannot be ignored by the equity market either. Yesterday also we had a sizable FPI sell number and the color has turned negative for all the indices now. The Nifty, the Sensex, mid-cap index, Bank Nifty, just caution everywhere. Okay, so what's lower on the Nifty? HDFC Life, Max Healthcare, Shriram Finance, BEL. It's across the board really. I mean, it's not really too sector specific, just a wide spread of red. The upside is largely pharma and very little IT. So Dr. Reddy's and Sun Pharma are up. Dr. Reddy's, as Vinny was explaining to us earlier, that after March 26, they can go about selling semaglutide. That's when Novo Nordisk's patent expires. So that's working well for the counter. Wipro, Infosys, TCS, there's some IT buying going on. That's it. Everything else is very, very flat. The banks are at the flat line and they will have a very decisive role in how the next couple of hours shape up. So watch for SBI, watch for ICICI Bank, watch for HDFC Bank. They're absolutely flat now. We'll see the directional moves in the next few minutes. Nigel?
Well, that's right. To keep an eye on a few stocks, Spark continues its good run. Yesterday we had news that the US court has granted a summary judgment in favor of Spark, in favor of that PRV on drug CZ buy, I think so. So because of that favorable news flow that came in yesterday, it's continuing its good run. Stock up close to around 6%. Silver continues to chug along, and that's why you have the ETFs that are doing well. Nippon Silver ETF, Tata Silver ETF, both of them are higher. Jaiswal Nico, it's corrected from around 80 rupees to around 70 rupees. They put on the exchanges that they're going to be looking at refinancing. Remember, they were, doing their financing at around 18-19% approximately. But since they'll be having their meeting to, refinance close to around 1,800 crores of their debt, that's why Jaiswal Nico, one of the top gainers, more than 10 lakh shares already traded. Jamna Auto is another stock that's trading in the green. It's a good amount of, volume on that particular name. On the flip side, HCC has come in for some profit taking and Websol Energy as well. Both of them did well yesterday. They've come in for some mild profit taking.
Okay, well, it's like a traffic light, right? Blinking red and green, the Nifty up on your screen, 6 up, 2 down. So nothing to show for, what we basically unchanged from where we left off yesterday. Angel, I think Nigel pointed out, is down 4%. Of course, the data, the monthly data coming through. Newland Laboratories is up 4%. It's got very large volumes in it. Vernova, 2% higher there. DOMS, the stationery company, 5% on DOMS. Chalet Hotels is coming up with about a 3.5% pop. KPI Green, ripped yesterday. It's up another 1.5% this morning. So that's the picture as we start in terms of the broader market, mid-cap, small caps, etc. Pratik Gupta is with us, CEO and co-head Kotak Institutional Equities. Pratik, liquid oxygen comes to mind. Is that still liquid oxygen or oxygen liquid? And does that make a difference?
Yeah, unfortunately, Prashant, we're still in a range-bound market. Basically, as you've been seeing, the earnings growth outlook is still pretty tepid for this year. At Kotak, we're projecting about barely 9%, 8.5% earnings growth for the Nifty this year. And also the foreign sentiment still remains very, very weak. That's one big factor that's keeping a lid on the markets over here. We're seeing continuous selling by the foreigners. And frankly, that's partly, we're not an AI play. The other markets are doing much better. Growth in India versus the valuations over here are not so attractive. So valuations in Nifty is still trading at about 21.5 times FY27 earnings, which is still expensive. So despite this pretty severe underperformance of India in the last 1 year, we are still trading at a 60% premium to the MSCI EM index PE. So investors are, it's okay. It's not like investors are looking at India and saying, okay, India has become cheap. We're still sort of just about reasonable valuations, if even that, and when many stocks in the markets are still somewhat expensive. So we're still sort of range bound. We have to go through probably another couple of quarters of an earnings catch up, and we'll stay in this liquid oxygen mode, I guess.
Pratik, this AI business, actually, we can go on about AI. Let me ask you the more pressing question first before we run out of time. Rupee, is that come up in conversations with clients?
Yes, of course, especially with foreign investors who are benchmarked in dollar terms. Just to put some numbers in perspective, the rupee has depreciated by almost 5% year to date. And the Indian, the Nifty's performance, if you take that as a benchmark, we are up about 10%. But 5% has been taken away by the rupee. And so in dollar terms, India has delivered only about 5% dollar terms. Now, you put that in the context of the MSCI EM index, which is up some 24, 25%. There are markets like Korea, which is up almost 70%. Brazil and Mexico are up 30-odd%. Taiwan is up very sharply, 40-50%. Even China has done quite well. So we're really standing out, not just in terms of the absolute performance in local currency terms, but also the rupee. And the rupee is also leading investors to hold back on any incremental investments. As it is, the crib is valuations are not particularly expensive. And is the rupee a tool which is being used by the authorities to try and stimulate the economy? So is there more downside? Can the rupee slide by another 1 or 2%? So that's sort of, there's no rush to sort of buy India. And especially as we get into the year-end sort of month as well, that's also impacting overall flows into India.
Pratik, morning. Forget buy India. I had the other question. I mean, don't call me a bear, but I'm just wondering if this becomes a new risk because of 90 and then people are calling 91. If these kind of levels happen, then anyway, you're not making returns in India. Your dollar-denominated returns diminish that much more. So my worry is this year we've seen about 1.5 billion, last count 1,45,000 crores of FPI sales this year. And the whole premise is that next year the FPIs will come. Is that premise itself at risk, or should we not be so worried, at least right now?
I think the rupee in itself will not be the main driver of whether FPIs come back or not. That would be a sort of side argument. In fact, our estimates suggest that, frankly, this week's, the last 10, 15 days, the decline in the rupee is more driven by sentiment. We had the trade deficit data that came out. The FPI selling continues, and it looks like the RBI is the one which is sort of stepped aside from supplying dollars into the market. That's what's causing the decline. I think that's lesser of a concern. We think the rupee there's not that much more downside. Current account deficit is still projected to be about 1.3%. We still have a fairly healthy forex reserves and so on. The bigger issue is, one, what's happening with the trade deal? How much longer, if at all, and also at what kind of terms will we get the trade deal? So that's the bigger issue in the minds of investors.
Yeah.
The second is the AI issue, which is anyone's guess. This thing can go on for another 6 to 9 months, in which case India will continue to underperform, and in that case, you will continue to see foreigners selling India and also, like I said, we are still not a cheap market. 21.5 times 1 year forward for 9% earnings growth this year. And yes, next year we get slightly better earnings growth, FY27. By our projections, we're estimating about 16-17% earnings growth, but still not as exciting as what's happening in some of the other markets.
Yeah.
So you need a lot more growth coming back into the economy before foreigners come back.
No, absolutely no. I completely take your point, and the only reason I asked that was exactly what you said. If the currency is going to be used as an instrument to provide a cushion against the lack of a trade deal, to cushion the exporters, it's a very strategic move. Then it's no longer, a question of one speculator here or there. Then maybe it's more than that, but we don't know. I think the coming days will tell us and give us the answers. So given all of these challenges, Pratik, the question is what to do in this market. You can't be all bleak, right? Also have to find out some cheerful notes here and there. So where's the cheer?
No, unfortunately, not too many pockets. This is a time when you sort of have to protect your capital, not worry about the return on capital as much. So that's why I've been saying you're now sort of the upper end of what I call the liquid oxygen range, the range bond market we're in. So you're sort of at the upper end right now. At this stage, you'll be slightly more cautious. Stick with the somewhat companies where you have greater earnings visibility, relatively more valuation comfort, companies which can withstand the slow growth patch a lot better compared to their peers. So it's one is sectors, and second is by size. So sector-wise, we generally still like the domestic-oriented players than the export-oriented players, whether it's the IT companies, IT services companies, or the generic global pharma exporters, or the auto ancillaries, which are heavily dependent on exports. So stay away from those. Focus more on the domestic plays. And second is the relatively large caps or larger players within each industry versus the smaller players, where again they will probably go through a tougher time in an economic slow growth period, in a slow growing economy. And the larger players would be somewhat better positioned. So again, brings us back to some of the banks, some of the NBFCs, some of the airline company. There's only one which is really worth investing, Indigo. The hotels, healthcare space, pharmaceuticals, more the domestic-oriented farmers, and so on, telecom. So that's sort of have a somewhat of a defensive tilt at the upper end of the range, is what we're saying.
All right. Hi, Prateek. Good to see you, Ben. And you've said this in the past, large private sector banks, large PSUs and NBFCs, that's something that you've liked. And, though I think you're not very positive on the tech space for the time being, I think what the street is catching on to is that the rupee weakness could in turn be good for them. And as we know, the tech index has been a big underperformer. So that's one of the indices that are actually at the high point of the day. Well, Prateek, before we let you go, just leading up to our next conversation, we have an auto name, OEM, that's going to be joining in, Bajaj Auto. But auto ancillaries is something I think that you're a little bit skittish on. How are you all positioned currently on auto as well as on auto ancillary?
So autos have done very well. I think obviously helped by the GST cuts, which was a big factor for many of the auto OEMs in particular. And but most of them have already played out. In fact, we're already seeing signs of demand weakening post the initial GST bump up, and the post-festive demand is also sort of beginning to soften a bit. And keep in mind, auto demand is going to be a function of the overall consumption growth in the economy, which is still very weak. We don't have enough jobs being created, or income growth is being somewhat weak. So therefore, in that context, it's tough to be very positive on the auto stocks, especially after the rally. We frankly, at this point in time, amongst the OEMs, we like only M&M. We prefer the four-wheelers to two-wheelers. Two-wheelers, we think there is the other challenge of the EVs and more competitive intensity and so on. There are some companies which are somewhat better positioned from an export perspective, and the rupee depreciation does help. But bear in mind, it's when the overall global growth economic environment is quite weak, tough to be very bullish on the exporters, especially if those who have exposure to the US. So as far as the auto ancillaries are concerned, I think it's time to be very, very selective. There are some who have huge exposure to the US, and given the uncertainty over the trade deal, we'd be a bit cautious. Again, we would prefer the OEMs versus the auto ancillaries.
Got it. Prateek, thank you very much for joining us on AI. I started raising the question in August whether we are seeing a lot of selling because there's no AI plays here. But a lot has happened since then. DeepSeek, for example, I don't know if you saw the news, has released 2 new models recently, which they say is about 25 times cheaper than ChatGPT and as efficient. So who knows where value will finally settle in that, right? In all of that. Maybe the adopters will be the winners. And I'm actually starting to wonder if the Indian guys and not just IT companies, but banks, etc., will be the adopters of AI, will eventually reap the benefits in terms of higher margins at the expense of lower labor costs, etc. But we can have this discussion. Thank you very much for joining us. Really appreciate you being here on CNBC-TV18. Arup Rakshit is with us, Group Head, Treasury at HDFC Bank, for a quick currency perspective at one of the largest treasury desks in the country. Arup, good to have you here. Thanks very much. Your perspective in terms of what flows you're seeing, and now that 890 is gone, it's an important psychological level. What next?
Hi. So 90 is actually a psychological barrier only. I don't think that 90 has any other meaning other than the psychology which the market had played up. Yes, it went up to 90.13 if I'm not wrong, and it then came down also. What next? I think the next level would be somewhere around 92 to watch out for. It will be a scenario. See, there is a supply issue at the moment, and with the overhang of the deal not going through yet, there is a problem which is happening. So this will be there will be pressure on the rupee. It will continue. The current account deficit is also not looking in the brightest.
Arup, has the mood soured a little bit? I mean, especially after that break of, that 88.80 level, a couple of Fridays back. I mean, since then, the mood seems to have soured generally. Is that correct?
Yes, in the sense, there was that initial euphoria of a rumor that there will be the trade deal very shortly, and that was what was supporting it. But once that went out of the window, I mean, we didn't see any positive discussion happening on the trade deal front with the US. Obviously, there has been a challenges which has come in, and there is a demand which is getting fulfilled only by the weakening of the rupee. The supply is constrained.
The move, Arup, that we've seen from
RBI is trying to moderate the volatility, but beyond the point, there is a genuine issue with the.
But maybe they're also stepping away, right, to kind of let the currency adjust.
That's what I said. See, RBI has always held the belief that the volatility should be managed and it should not be a one-way street in a too volatile condition. So they have done that. I mean, they are there in the market on and off. So it will not be that they will try to protect any level. They have never tried to protect any level, and that's been the philosophy of it. So there is that issue which is cropping up.
Arup, absolutely, which is why, like you're saying, I think that's what we've also been hearing, that whenever there has been intervention, it's been measured and limited, not very aggressive. So from here on, that's exactly the point. Do you get the sense that there is a lot of speculative element? Because there was one view that we got which suggested that the speculators could now take it all the way to 91 or make a charge towards 91. If that's the case, then would you expect more aggressive RBI intervention?
See, if there is too much speculation comes in, then obviously that has to be controlled, and there will be a lot more, typically expected lot more intervention to bring it down. So the movement should be more on genuine demand supply rather than a speculation.
And what is it right now? What's your sense? I mean, I know that's a hard question. It's tough to call a market as large as the rupee, but do you get the sense that the moves right now are more speculative in nature, or this is, natural hedging perhaps that's going on?
See, if you look at the way the equity market has behaved, if you look at the fact that even the bond flows have not really picked up in that sense, so there seems to be some amount of genuine demand also, or rather, should I say, the constraint on the supply side. Supply is not really there too much at this juncture.
Okay, Arup, we'll leave it there. Thank you very much for joining us. Good speaking with you, and really appreciate it. Here on CNBC-TV18. We have Bajaj Auto Surabhi, and I guess, I don't know if you want to start with the currency question. Big 50% is exports.
And they're large exporters. I'm sure that would, that would be interesting and beneficial, but then there are hedges at play as well. We also have to talk about, of course, November sales numbers largely in line with expectations. There's a question mark on the domestic two-wheeler growth, and we'll get to that as well. Three-wheelers have done really well for Bajaj Auto. We've got Mr. Rakesh Sharma, Executive Director of the company, joining in. So much to ask, Mr. Sharma. Where do I start? Okay, I'll take Prashant's cue. Let's talk about currency, because that's the hottest thing this morning, right? So for you, a company that has such a large export portfolio as well, what does all of this mean? What are your hedges like? What does it mean for Bajaj Auto, rupee at 90?
Well, good morning. It means party time. Yeah, the softly devaluing rupee is very beneficial, as you said, to a company like ours, which has got almost 50% of its revenue coming from international sources. So it's very, very helpful to being also competitive in our retail markets.
Okay, so party time as far as the currency tailwinds are concerned. But then let's talk about that domestic retail market, right? Now I have to, ask the slightly tougher question on, specifically on two-wheeler sales, because I mean, the growth has been...
Sorry,
sorry.
just to complete that rupee point, good morning, Prashant here. What's the sensitivity, if you can tell us, with, say, rupee, rupee depreciating, say, 1%, 100 basis points? I mean, what's the sensitivity to margins, Mr. Sharma, if you have that number?
Well, on an annualized basis, every 1 rupee creates a EBITDA impact of 200 crores plus, because our exports are over $2 billion. So, like I said, 50% of it coming from international means there is a very good level of sensitivity.
So these are straightforward translation gains. So that's 200 crores on one rupee move, 1% move.
Yeah, in general. But of course, we have hedges in place because it's always more important to achieve certainty. We are not sort of gambling on the dollar rupee because we have always felt that it's more important for us to maintain retail price certainty in our destination markets. And that's why we have a approach which is biased towards hedging and towards achieving certainty.
Yes, and so
all of it cannot be grabbed. But this whole the trajectory of the rupee has been such that one has let it be and sort of ride along with how the rupee's trajectory is unfolding. So therefore, a lot of that devaluation benefit is accruing to us.
Just to close the loop on this, sir, from when on does it start benefiting you? Because you'll have some hedges in place, right? So do you start seeing this benefit from January, 1 month down the line, 15 days? I mean, if you could give us a timeline, with what sort of a lag? Or it's packed, spot rate is what you go with. In the next 5 days or so, you start gaining from this rupee depreciation.
No, it's not like that. The thing is that you always hedge a certain percentage of your thing. So it is immediately, whatever spot we are achieving right now for our unhedged portion is accruing to us. And that is...
What is your hedge portion then, sir, on your export?
I would not sort of venture forward that number, but we are hedged for almost, with certain percentages, for almost 12 months down the line, So, but...
the entire $2 billion, just trying to get a sense. But you also said that most of this depreciation benefits accrue. So... but then the hedges should eat into some of those benefits, right? The translation gains.
Let me just clarify. So, because there have been multiple questions, and just if you can listen. Like I said, our approach is towards certainty. The trajectory of the Indian rupee's movement opposite the dollar has been, softening. So obviously, recognizing that, you roll back the amount of hedging which you do. And therefore, the amount which is hedged is much less, let's say, than what we would have done 2 years ago when there was a little bit of an up and down. And therefore, what happens is that most of the devaluation through the spot achievement is getting accrued.
Yeah, absolutely. I mean, sounds absolutely rational because the trajectory of the currency in the last many years has been gentle depreciation. Very rarely do we see instances of sharp appreciation, which would make you want to hold very large hedges. So that explains that number of 200 crores positive EBITDA impact every time the rupee falls by 1 rupee, that is, against the dollar. Got it, sir. So that's helpful explanation. Now coming to the bread and butter business, which is auto sales and what's really going on in the domestic market. Starting with two-wheelers, now, it seems slightly tepid compared to how the industry is doing. And Sudarshan was telling us, even if we, leave aside the anomalies, festive up and down, April to, November, the sales are down, I think about 5%. So what's really going on with the two-wheeler space, sir?
Well, if you're asking about the industry, I am not at all surprised about the November outcomes because, Diwali has a very big impact. And last year, Diwali was in November. And therefore, comparing equivalent to equivalent is a better method. And actually, the right way now, once the dust has actually settled, is to look at September, October, and November, to really understand which way the industry is headed. Because September was an up and down month with the GST being announced very early on and then implemented from 22nd, and October was full festive, and November was only one first week festive, and then after that was post-festive. So when we put September, October, November together, there is certainly a very good impact we are noticing of GST. It's made at least I would say 6 to 8 percentage point difference, not only in two-wheelers, but I would say also in three-wheelers. In fact, a much better impact on three-wheelers. That's why you're seeing really handsome numbers coming out from our side, because being 75% market share, a lot of that uptick is disproportionately captured in our favor. So certainly, if you look at September, October, November, from a -1% which the motorcycle industry was delivering, it has gone into, swung to 6-7 percentage positive.
Absolutely. I mean, the question was only because in November, other automakers, two-wheeler makers, have managed to show some growth, while obviously everybody deals with that base issue of which month Diwali actually fell in. Anyway, going forward, when we look at December, turn of the calendar year, look at January onwards, what is your estimation for domestic two-wheeler sales for Bajaj Auto?
I would say December is going to be again tepid, but again, we are not worried about that. It'll be better than last December, but December is always a low month with very few degrees of freedom. But we are optimistic about January, February, March, that quarter, because what is happening is that not only has growth returned to the industry, but the better segments are doing far better. And within those, where we have captured the growth is on our higher variants. Our growth has been completely driven by the higher variants. Yes, we have in the 100cc segment lost share, but there has been a bit of a reversal in our trajectory for the last 3-4 months. As you know, our market shares were slightly going soft. I'm talking about 1 to 2 percentage points. And that recovery got a real boost with this GST cut, because we found that the customer behavior has sort of turned towards our kind of play, which is, try and get the customer through better products and higher variants, rich in features, etc. Now that is getting more and more traction, and that is the basis on which the last 3 months we have seen a clawing back of market share and improvement, particularly in the 125cc plus.
Yeah, can you share exactly that number, the latest numbers as of end November, market share in the 125cc plus, which is what you target?
So we are these are estimates, because you don't get precise numbers. These are our estimates, which are calculated. The absolute is not as important. What is important is the trending. And our estimate, for your information, is about 23% is our market share, which had slipped down to 21%. And that has come back to about 23% as of November in the 125cc plus segment.
All right, Mr. Sharma, thanks very much for joining us, sir. Good luck. And I own the rupee, I own the business as well as we go forward. Thank you. 90 points lower, which basically means that we are almost at the day's lowest level. Are we at the low? Okay, there's a small bit of rebound. The low has been made today at 25,921.
Bang on the 20-day.
Which is the 20-day moving average. So we were about 70-80 points away from it as of yesterday's close. The 20-day basically moved to about 25,924 as of yesterday's close. So at the low point, you broke that by about 3 points, and you're kind of sort of sitting on it now as we speak. The Nifty Bank, maybe just quickly to take a look at this as well. We made a low of 59,062. And here, it's the 20 days at about 58,775 as of yesterday's close. We take a break. Blue Star Management on the other side to talk about the outlook for H2 and beyond. Stay tuned. Coming up.
Welcome back. Markets, at least for now, well, have defended that mark, the 20 DMA, and seeing a bit of a mild bounce from there. And the rupee as well has stabilized a little bit, which is good news. Well, let's focus on another company, Blue Star. And we have Mr. Tyagarajan, who is here with us on the show. Hi, sir. Good morning. Good to see you, Ben. Well, so coming across to you in just a bit, we want to understand whether or not the long-term growth story is intact after a weak summer, the festive growth as well as demand trends in this quarter, and the room AC industry outlook for FY26. We're going to discuss all of this. Mr. Tyagarajan, good morning. Good to see you in. Always a pleasure talking to you, sir. Well, for the industry on the whole, Q2 was tough for a whole host of issues. Could you tell us how things are looking in the second half of this year? And will you be able to make up for the lost ground in the first half of the year? And also in our last conversation, you mentioned that you're expecting 30% growth this festive season. Did it happen? And, what's your rough estimate as of now?
Good morning, Nigel. It's a pleasure interacting with you. All are pertinent questions. First thing is that in the festival season up to Diwali, from September 22nd, when the GST came into effect, we saw in Blue Star around 35% growth for the like-to-like period, but that's not going to convey anything for the simple reason there would have been a pent-up demand during the blackout period when the GST new rate had not come into effect. Now, there is an energy label change that is going to be implemented with effect from 1st of January 2026. Therefore, build up to that, there should be some sales that should be happening coinciding with the Christmas New Year season. Going by November last few days indication, I think there will be growth. After a long time, November was a month where we saw around 10% growth. Now, you have to wait for the energy label implementation period, which is the December 31st. I think it will take off from that particular point. Then you have the other window, February, when the IMD forecasts are available, build up to the summer. Now, on the whole, my estimate is that the industry should be happy if they match last year volumes and revenue. It is going to be anywhere between minus 10% to same level or a flat for FY26 as far as room air conditioner sales is concerned. Now, we are at around minus 10% as of now. We will be very happy if you show a marginal growth over last year. But having said that, even if it is going to be flat, CAGR, if you calculate from FY22, it is still 18% because we are comparing with a huge growth year, which was FY25.
Okay.
That's why we are feeling the pain. Okay. I do not think we will be able to make up for the lost summer season.
Okay. All right. But you're sounding far more optimistic in terms of demand. Give us a sense about inventory levels, sir, if you could give us a sense on that. And what about discounting? Is that, taking center stage now to push through inventory, or that's not happening? Give us some clarity on both inventory as well as discounting.
Our inventory is around 65 days. Ideally, it should be around only 45 days.
Okay.
And hopefully by December end, it comes down to 45-day level. What I gather is the industry inventory is around 90 days. And obviously, it will lead to discounting. There are two aspects. One is inventory level has to be brought down. Then a manufacturer cannot bill the channels beyond 31st of December, the old energy label products. So you have components as well as finished goods, which you will have to liquidate or you have to relabel. So therefore, there will be margin pressure, but that was anticipated, that is being taken care of. It is not going to impact the revised guideline on margins, which I had provided. It was 7.5 to 8%. We revised it down to 7 to 7.5% for the full financial year. So that takes into account this margin pressure, which is inevitable.
So you're sticking to 7 to 7.5% margins
For the segment 2.
For the unitary cooling products
That's right. That's
business.
right.
Got that, Mr. Tyagarajan. It's been a challenging year, sir, right? Bit of a washout year, forgettable year for the room air conditioner industry. But my question is a little deeper. I mean, is this just one of those years, and they happen in businesses? It's a weather-related industry anyway. Or does it give you learnings in terms of whether something needs to change? I mean, do you think that there's a greater need on the industrial cooling business, the commercial cooling business? And give us your expectations from that business for the rest of the year.
Shurbi, good morning. It is not disheartening. It is disappointing. That's about all. If you're a hero acting in many movies. One movie is a flop movie, and so you hope the next movie you work hard to make that movie a successful one. You will not retire because of that, and so therefore.
But sir, to take the analogy forward, it's like if one of your Bollywood movies flops, that's fine. It's life. But you realize that you need to grow bigger in the southern markets, that you need to do a lot of the south movies as well. Therefore, the question on commercial air conditioning.
No, the potential for this industry is great. This is the industry which amongst consumer durables will be growing the fastest. We are fortunate to be in this space during this period. So between now and 2030, there may be one more bad summer, that's fine, but it is going to be a very important segment for Blue Star and for anybody for that matter. That's why the competition is intensifying, the valuations are high, and so I am very, very optimistic about the long-term prospects. Even FY27 should be a great year. Now, coming to the specific question, the long term, what one will have to do, the lessons learned. We keep learning here, despite being 82-year plus company. You have to weather-proof Blue Star. You have to weather-proof the room air conditioner industry itself, which would mean we do have portfolio in commercial air conditioning or commercial refrigeration. You must do that. Even within room air conditioner, the institutional business you should grow. And you should have the cost structure in such a manner you are flexible. Say, for example, we end up spending a huge amount of money in the IPL, assuming that summer season is going to be great. But after having invested that money, if summer is not working, that money is a waste. So you will have to relook at your marketing mix as well. So there are quite a few lessons learned and that will get implemented. But having said that, this business is seasonal.
No, absolutely.
And you can't escape from that.
And you expect a much better FY27. Point taken, sir.
Mr. Tyagarajan, good morning. And we have you on when the so-called Mumbai winter has returned. It got hot in the middle, but I think it's much cooler now. And it's expected to be a cold winter, according to the weather folks. This one particularly, both here and in North India as well. Is there any way to define, because you're on the industrial side, on MEP, you're in data centers, factories, etc. Is there a way you can define market share there?
No, on the commercial air conditioning, we will be close to 30% market share. Or EPC projects addressed segments, we will be close to 30%. But the size of those segments are not going to compensate for the room air conditioners. In India, room air conditioners constitute a very large part of air conditioning market. So for you to grow not only the revenue as well as the profits, the room air conditioner part of it becomes very significant. The commercial air conditioning part of it or the EPC is providing you that relief. That's why you will find our results are not all that bad compared with some of the peers, for the simple reason that B2B part of it is compensating for.
Okay, all right. Mr. Tyagarajan, I just want to ask you this with regard to air purifiers. That segment suddenly seems to be coming to life. And I believe, the demand is very, very high. And we had Eureka Forbes that put out a presentation. If I got my numbers correct, they were talking about less than 300 crores of an industry capacity as of now, which they're expecting to go to more than 1,000 crores. And I think they're upped their guidance. What about you? Do you all have plans to get into this vertical?
Your own article is also well articulated. You have...
my piece on LinkedIn. All right. Yeah. Go ahead, sir.
So it should, but the thing is whether 300 to 1,000 crore, whether the markets are going to take it seriously. It's for this country. This is a very still a small part of it.
Under-penetrated. I think it's less than 1%, if I got that number correct.
In the long run, my view is the air conditioners should be equipped with more and more filters for purification, so that you don't need an air conditioner, air purifier. That's what you have to look at.
Okay. All right, Mr. Tyagarajan, we'll leave it there, sir. Thank you very much for joining us and running us through state of affairs right now and what the future looks like. Of course, I mean, the room AC market is the dominant big one, which in 27 and 28 perhaps looks much better. Now, we're going to shift focus and shift gears to the auto space. Maruti Suzuki has made an entry into the electric mobility with two announcements. My colleague Shivani spoke with Partho Banerjee on the company's preparedness for EV transition and more. Listen into some of that conversation.
With regard to this new EV segment, what the research, it has clearly come out, there are 4 key concerns. One is the range of the product. So in past, many of the OEMs who have launched the product, finally the customer were not getting in line with the expectations which was committed by the OEMs. So we showcased today that in the Bharat Mobility Show, we assured that our vehicle will be going a range of 500 kilometers. And today, we are very happy to announce that the ARI has already given us a certificate that our vehicle is having a range of 543 kilometers.
You have said that around 1 lakh odd charging stations across the country. Give us a sense of, from Delhi onwards, around Delhi, if somebody has to.
In the top 100 cities, on average, between 5 to 10 kilometers, we are going to have our chargers. And if en route you are moving, I need to just give an example that I give an example of Delhi to Chandigarh today because it doesn't need any charger for our product.
And so these 1 lakh charging stations, what is the timeline for them to, be up and running?
We have given, our vision is by 2030 we will be able to do that.
All right, that's Maruti's big EV plan. Well, let's move on to another exclusive conversation. Mangalam caught up with Asian Paints MD and CEO Amit Singhal, where he says that the company can expect 50,000 crore rupees in revenue over the next 4 years and is very confident of growth. Listen in.
Even now, while you are seeing some shoots in terms of the demand, we are not seeing that there is belligerence, there is full exhilaration coming into the market to that extent. We feel that today the rural markets are just coming back, even the urban centers are just trying to show some spark. I feel that possibly it will take some time before we really get onto the parameter of really double digits and so on and so forth.
How long will it take?
It's very difficult to say, but I would say that possibly another 2 quarters is something we need to kind of watch out for sure in terms of what we are looking at. So therefore, right now, I think the whole peg is in terms of saying that we continue to grow higher than the market, and that's the pitch in terms of what we would take.
And you haven't been doing so for the last few quarters, and now you're confident of doing that, right?
The first 2 quarters of this year, we have grown higher than the market to that extent. And as you look at the H1, we have grown much higher than the market overall.
So you will continue to gain market share?
That's absolutely.
50,000 crore revenue on Asian Paints, by when?
Okay, definitely for the next 4 years.
In the next 4 years. Amit Singhal stays in Asian Paints for the next 5-6 years at least?
I think from my mindset, eternally.
One piece of advice that you would like to give some of your competitors?
The advice is that when you kind of operate in the market, okay, operate with a certain value, a certain ethic, and look at possibly differentiating yourselves far more strongly rather than being me too in terms of the market.
And to the investors, what will you say, who've been sitting on 2 years of losses?
I think the investors will see that this is a brand which they will have to watch out for, because there are lots of things which are coming, and we think that possibly we have our clear eyes on the stakeholders and we will give them a good return.
All right, let's get back to the market then and get some trades in. It's 10 o'clock and the market is in a bit of a slippery mode. 90 points lower on the Nifty and we are below 26,000 now. Vinay Rajani is with us. Vinay, this is a dip. Would you buy it? Or would you short at these levels or would you do nothing on the index?
Yeah, good morning. So the problem with the market is the broader markets are not participating. If you were to look at the breadth of the market, percent of stocks above their 20 DMA and 50 DMA are below 40% in NSE 500. That clearly shows that participants, overall participation is not there. Only Nifty stocks have been moving up and rising because of the global market strength. And since we have been falling for last 4 trading session, Nifty is gradually losing strength. Today, Nifty has broken down below its 20 days moving average support, which was placed down 25,964. So gradually it is losing the strength. The only support I can see for the Nifty is the 26th November low, which was at 25,842. If Nifty breaks that level, then definitely the short-term trend will change to bearish from bullish. So that is the only support I see, and below that Nifty can extend its wall. And broader markets are already not participating. That's a weak sign, we can say. So better to remain cautious in this kind of environment. Very few stocks are supporting the index. Otherwise, broader markets are looking very weak on the chart. So we have to be cautious. Should approach the conservative strategy rather than being aggressive.
Okay, and any stocks, Vinay?
Yeah, so capital market theme has been losing strength, and we have seen that many stocks in this particular segment is looking weak on the chart. So one can go short in the CDSL December future around 1571. I would recommend a stop loss at 1600 on the downside. I'm expecting a target of 1525. The second stock I like is on the long side is the Hindustan Zinc. So Hindustan Zinc has been one of the resilient stock, and overall metal theme is looking strong on the charts, and Hindustan Zinc is on the verge of giving fresh breakout. So considering that, one can go long around 500 in Hindustan Zinc. 490 should be the trading stop loss. On the upside, I'm expecting a target of 520.
Yeah, no, absolutely. Well, Vinay, good to get that view. We'll take a break. Manisha on the other side, commodities in focus. Okay, well, equities, of course, under pressure. Now 130 points lower. Started with about not started, but I mean, we were down about 60, 70 points, half hour back. It's now double that in terms of losses. And we are under the 20-day moving average as of yesterday's, the 20-day as of yesterday's close, we are under that level. Manisha is here with what's moving in commodities. Manisha, over to you.
Well, thank you for that, Prashant. I'm looking at rubber prices because a major price movement overnight has come in for this one. We've seen a decline of 4% overnight. And when you look at this year, it's down by 13%. And this is even as we're looking at a deficit in the global markets. Let me take you through numbers there. We did see a 7-month highs in this year itself, but since then the prices have been on a decline there. When you look at the, global rubber market there, and as you can see, the last 4 years, we haven't seen the production in the global markets gain any much. So from 14 to 15 million tons of production is what we haven't been able to achieve. But then you look at the consumption numbers, and they clearly have been rising every single year. 2025, by the way, is the 5th year of deficit when it comes to rubber production and consumption numbers therein. So that in turn should have been supportive for the prices. But that's exactly what we have not seen. Also, when you look at the natural and the synthetic rubber market, well, when you look at that categorization, the synthetic rubber market is higher than the natural rubber market. One, because there's not such availability. And second, because synthetic rubber is more affordable. So when you look at the market dynamics, 52% of market in rubber is synthetic and 48% is natural at right now. Talk about the Indian markets then, and here as well, it's quite a dismal way when you look at the price movements itself. The input costs, remember, have been rising, but it is the cheaper import of rubber that we continue to see within the country. So this is the prices. All-time highs what we saw in 2011 at 243 rupees a kg. That was broken last year in August 2024 when the rubber prices hit a high of 247 rupees a kg. Fast forward it to today, and you have the rubber prices trading lower than what they were in 2011 at around 185 rupees a kg. As I said, 40% of India's rubber requirements are imported, and this is cheap rubber coming into the markets there. And another thing that the industry has been asking for is an import duty, anywhere to the tune of 5 to 25%, because the way the rubber prices have been in the last many years, they actually have seen a decline of 25% in last 10 years. So not a great time to be a rubber producer, clearly.
Okay, all right. Thank you very much, Manisha, for the dynamics of the rubber industry and what's happening with the rubber markets right now. We'll take a very quick break on that note. Coming up on the other side, our special segment, The Economy. Today, Lata discusses how the falling rupee and the soaring GDP can impact RBI's policy decision. Lakshmanan Navi of Federal Bank and former MPC member Ashma Goel will be with her.
Welcome back. Can't remember a more dramatic backdrop for a Reserve Bank policy. Rupee falls 5% in a year when all other comparable currencies are up against the dollar. Also, it is the second consecutive year of current and capital account deficits, or most likely so. Of course, we have one more quarter to go. Now, will this impinge on the MPC when it makes monetary policy on December 5th, or will the huge GDP number of the second quarter, 8.2%, have a bigger impact? Joining me to discuss rupee rates and RBI is a former MPC member, well-known economist, Dr. Ashima Goyal, and V. Lakshmanan, the head of Treasury at Federal Bank. Ashima and Mr. Lakshmanan, thank you very much indeed for joining me. Ashima, the question really is to you. First, you've been through so many rounds of MPC meetings. When something as dramatic as this happens on the currency, it's almost a no-holds-barred fall. Will that get more importance than other variables?
Well, the MPC under flexible inflation targeting is not supposed to look at the rupee, only at inflation and growth. And I think last year there was very little movement in the rupee. And this regime, they have taken the call to let it float with market movements, but preventing the old, for a long time, RBI's policy has been to prevent excess volatility and persistent real misalignments. So I think they still come in when it is getting too far away from equilibrium. So, and this regime is working. They have reserves and other ways of intervention. So the interest rate is not tied to the rupee. The interest rate has to respond to domestic inflation and growth.
Okay, no, I agree that the Reserve Bank and the MPC members have repeatedly said that they are an inflation targeting central bank, and it will be governed by domestic factors of inflation and growth. But this is dramatic enough to upset growth calculations as well. It will impinge on inflation to some extent because imported elements are going to become expensive. So it's not that it doesn't have a macro impact, and it's also a financial stability question now. Given the rapidity, it's a 2% fall almost since November 18th. When the October trade deficit was announced, we realized it is a 1-month high, and since then it's been a near 2% fall. So won't this make the currency take center stage because of financial stability issues?
Right. As I said, they do intervene against excess volatility, and we've seen some recovery from the lows it had reached as the RBI has come in. And, I have been watching the rupee and the economy for a very long time. I remember the 2000s when it first appreciated. Markets they couldn't believe what was happening because through the 90s it had depreciated. But, I have seen always, crises like the global financial or taper tantrum, that it passes. And there is a reversal of the outflows. And most of these outflows are driven by global events. And the reserves are used and other policies are used to smooth rupee volatility. And then whatever loss of reserves there is made up later on.
Okay.
And reserves remain very, very high. In fact, the IMF thinks we have too much of reserves. We should let the rupee move more. So I don't think there is any sort of major financial stability concern here.
Just yet. Okay. Mr. Lakshmanan, what are your treasuries awaiting from the Reserve Bank? Will you all want a statement from the RBI governor on the currency? Will a rate cut make it a little worse? I mean, I know people don't come to us because of the rate differential, but in this year, debt flows are positive, equity flows are negative. Will a rate cut make even debt flows negative? Can that be a fear?
Yeah, so thanks for having me here. Firstly, alluding to the point which Madam Ashima Goyal said, RBI has, of course, never really brought in currency as a core factor in its monetary policy statement dissemination. a side eye would always be there. To which extent the policy will definitely take cognizance of that, and to which extent a rate outcome that's going to come later this week will definitely be looked into. Having said so, in as much as we as bankers may wish a commentary on the currency to be brought out, I would state that yes, the fact that the rupee has weakened above 90 would be noted, but the policy statement would clearly again hinge upon the broader parameters of inflation and growth in the wider statement that's going to come by. And that is, I think, is going to be
the statement. What kind of a statement are you expecting, Mr. Lakshmanan, from the governor on the rupee? What kind of a statement can boost or help the market, you think?
No. So one, again, as I stated, I don't think there's going to be a boosting statement coming in from RBI in any manner on the rupee. Okay. It's just going to record the fact that the rupee is weakened beyond 90 in any fashion, if at all, to the maximum. Nothing beyond that, in my view.
Okay. No, in about 2-3 policies earlier, the governor actually made a very strong statement saying that we will not tolerate speculation or something, and it had a positive impact. I can't remember whether it was the June policy, but there was a very strong policy. Ashima, to come back, wear your economist hat and let us know, not as an MPC member, will we reach a stage where we may have to announce, the kind of extraordinary bonds we announced in during the taper tantrum time in 2013, asking for NRIs and others to invest money, or we did with the Resurgent India bonds after the nuclear test in 1999. Do we need any of these extraordinary capital measures?
That's always a possibility. As I said, intervention, there are many instruments there in the arsenal. But just to come a little bit to the communication point, which you were asking, Lakshmanan, I think that it is very important that the RBI indicates to the market that they are there to prevent excess volatility. Because initially there was a belief that there's much more volatility under this regime. The RBI is hands off, it's all market determined. But markets get, there is a trend following, there is excess volatility. And especially if it crosses 90, then markets start immediately. All of us, I think in psychology, we start thinking of 100. And there can be sort of excess movements in some direction. So a statement that the RBI is very much there in the market in order to prevent excess volatility should be calming for markets. And also they can underline if they want, although it's not the MPC's job and should not be there in the MPC's communique, maybe in the governor's statement, that the RBI has many instruments and this phase is likely to be temporary.
Okay. And now for the original question for which I invited you, the rupee became a sudden news point. We have this extraordinarily low inflation number and probably a FY26 average of 2% for CPI, and yet growth going great guns and not apparently even requiring any help. How would you vote?
Well, at the current juncture, I would vote, and I've been calling for a rate cut for a long time, ever since August. I think 25 BPS rate cut should be there. Because, as you know, I've studied the real rate and its impact on the economy in the past, on an ex-post basis. Whenever the real rate has exceeded 2 for a longish period, it has had a dampening effect on growth. And moreover, in an inflation targeting regime, if inflation, you don't respond to spikes in inflation. Food price spikes you ignore. But this over-forecasting of the inflation rate has been going on since the middle of 24 almost. So it's persisting for a long time. And looking ahead, 9 months ahead, inflation is expected to be low. Therefore, under an inflation targeting regime, the room to cut rates should be utilized because monetary policy acts with a lag. You have to be forward-looking. There can be a dampening effect of high real rates down the road. Already October numbers are showing some slowing in industry, in IIP, core industry, etc. So although the run-up to the festival time, the GST cuts did lead to a boost to demand, now the government cannot sustain it indefinitely if the RBI's monetary policy is restrictive. Okay. No, and markets get worried if the government is fiscal deficit and overall the government is still restrictive because fiscal deficit consolidation is continuing. When markets got worried when the tax cuts were announced and you saw rates tightening, hardening, G6 rates, right? So then it's the RBI and the government at cross purposes.
Okay. Yeah? All right. No, I take your point that inflation is requiring a rate cut and the forward forecast of the RBI, there is a joke in the market that the Reserve Bank decides what policy it wants and then suitably forecasts a forward-looking inflation. So, from 3.7, they have come down to 2.6 and will probably go down to 2. So there is that kind of, a joke going in the market. Lakshmanan, now the more important question is clearly OMO. Reserve Bank has been intervening and supplying dollars, and it is going to supply or will be called upon to supply a lot of dollars. So liquidity tightness is written in the RBI's supplying of dollars. Do you think just a 2 lakh crore OMO, which is what the market is talking about, suffice? Or does the Reserve Bank have to give an indication of a much larger OMO to mollify the market?
I think for starters, having an OMO as an indication, I think will be a good beginning point in my view. And at least that will bring out very clearly to the market that RBI is looking at liquidity as a matter that would require support in more fashion. So even if a specific amount were not to be brought out, an ask or a statement of an OMO support clearly should be beneficial to the market is the way I see it.
Okay. Yeah, I'm sure they will make a statement. It is just that usually OMOs are not part of the governor's statement. Certainly not part of MPC, but it's not even part of the governor's statement. They usually announce it separately after putting out the statement. Maybe this time the governor makes an exception and speaks or at least alludes to government having to buy bonds, RBI having to buy government bonds. But it's going to be a nail-biting Reserve Bank policy for a whole host of reasons. Thank you very much, Ashima Goyal and Lakshmanan, for joining us and helping us parse or helping us understand what to expect. Markets still in a very troubled spot, whether you're looking at Forex or whether you're looking at equities. There is very little relief, 90 rupees and 10 pies to buy a dollar, a level which we didn't think even 1 week ago would be on the cards this quickly. Wrap up on Bazaar on that note. Chartbusters coming up.
Stocks slip as the rupee opens at a record low, breaching the 90 per dollar mark. The Nifty gives up 26,000. In fact, as we speak, it's around 25,900. Except the IT index, all trade with losses. The broader markets fare worse off than the key indices.
Angel One slumps on a very weak business update as the market share and the client acquisition both slip in November.
Indus Towers gains in a weak market following a high conviction buy rating coming in from Citi. The brokerage has set a target of 500 rupees for the stock after telecom ministers encouraging comments on relief for Vodafone Idea.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the markets are trading in the red today, though the Nifty is hovering around the 20 DMA, and the bulls will be optimistic that we can see some sort of support that's coming in from these particular levels. And the big story, Mangalam, today has been the Indian rupee, gone to around 90 odd mark. The hope is that we see some kind of stability in this vicinity of around 90 to around 91 odd. I think the last time I checked the Indian rupee as well, more or less stable at around 90.11 or thereabouts. We have an RBI meet as well, so interesting to see whether or not they've got a plan in terms of curtailment of this and what is their comfort level on the Indian rupee.
We will definitely monitor how that progresses, and the RBI usually, monitors volatility more than the big move on the rupee itself. So we'll track how that goes. Currently at around 90.1, the FII flows, whether they exacerbate because of the weakening rupee or not, is something that we'll be tracking as well. But important technical levels, the market's holding so far, and typically, when all of this happens, there is flight to some safety, and that's something that we're seeing. Obviously, the beneficiary of a weaker rupee is the IT index. So the IT index has actually moved to the high point of trade and is a fair weight on the Nifty as well. So that stems the downtick on the Nifty that we're seeing right now. And the other is the FMCG pack, which opened in the red, but the FMCG index has now moved fairly well from the lows as well. So those are a couple of sectors that we'll be tracking. Good time to get in Chandan Thaparia of Motilal Oswal Financial Services. Chandan, we've corrected about, 400 points from the record high on the Nifty. Do you think this is routine and we will see some support here?
Good morning, Mangalam and Nigel. Thanks for having me. So, market just hit an all-time high of 26,325 just 3 days back. But after that, it fell to cheer the momentum led by weakening rupee, which is now beyond 90.12 marks. FI's flow is still not in back. However, FI's long-short ratio is hovering near 15-18%. VIX is still at lower levels. DIs are continuously buying. But somehow the rupee is changing the stance, and that's why the market is finding some hiccup at its all-time high. So I believe some sort of consolidation could be there. Sector rotation might play an important role. However, the major trend of the market is intact to positive, but on short-term point of view, the structure is slightly turning lower, and index has been making lower top, lower bottom on the daily chart. And however, it formed a bearish belt hold on the weekly chart as of now. So I believe the market can retest the key support near 25,700, 750 before it starts the next leg of rally. And I believe upcoming RBI policy is also an important part. However, the data front, we have seen so many positive trends. GDP data at 8.2%, inflation is at 20 years low of 0.25. But yes, somehow the stability of the rupee is important. So to sum up all, I believe 25,700, 25,750 could provide as a major support in Nifty index. Talking about Bank Nifty index, Bank Nifty has been outperforming, but witnessed some profit booking in last 2-3 trading session. It made an all-time high beyond 60,000 marks, but corrected by more than 1,500 points from high. So as of now, 58,500 is an important support for Bank Nifty index. Now talking about trading ideas, now the sector and the stock specific action has shifted comparatively, looking at the declining market and change in the rupee and the movement in the precious metal. So first trade is buy on Hindustan Zinc. We have seen good momentum in the gold and silver, and Hindustan Zinc is proxy of the silver in terms of equity trading. So stock has been making high tops, high bottom. In fact, the rollovers were better by more than 82% with higher roll cost. We have seen addition of long built up. So Hindustan Zinc will be the first trading idea. With support of 496, we are looking for an upside move towards 525, 528. Second trading idea, that is buy on Wipro. Positive on the selective IT name, and Wipro has seen a consolidation breakout, has been making high tops, high bottom with some put writing activity, so momentum could continue. Delivery volume is also inching upwards, so one can buy with support of 250 for an upside target towards 269. Last trading idea, that is sell on LICI. The stock is given a breakdown. We have seen sustained call writing, huge built up of short position with short rollover, so one can sell with stop loss of 893, and this counter can drip down to us 845, 840 marks.
Got it. Okay. All right. Thanks a lot for that, Chandan. 25,700, 25,750 mark, the important crucial support as per what Chandan says, not ruling out that we go there and revisit that particular level. But let's shift focus to our special segment where we get a few ideas for profit from Money Control Pro. Madhu Chanda De of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about Control Print, which is one of the leading players in the oligopolistic coding and marking business, dominated mostly by MNC players in India. The company came out with a very decent set of numbers in the quarter gone by. While there was a sequential improvement in gross margin on the back of better product mix, what was really surprising was the strong 28% EBITDA margin. Operating leverage benefit clearly appears to be at play. The company's track and trace solution brands also seems to be gaining traction. The company is implementing 2 major projects with pharmaceutical clients, and the outlook seems to be bright. With GST rationalization energizing a lot of user industries, the outlook seems to be improving incrementally. The overseas packaging business appears to be the only drag, and the company has taken several initiatives, and the losses are expected to narrow, and the company could break even by FY27. As a thumb rule, the growth in the industry is almost 1.5 times the growth in GDP. Control Print has a very strong balance sheet and has a reasonable valuation for the secular growth opportunity it offers.
Thanks a lot for that, Madhu. For the time being, we slip into a short break. On the other side, we'll get back with Mr. Arvind Miligiri, the Executive Chairman and Chief Executive Officer at AKIS, who's going to be joining in to explain their IPO that opens up today. Stay tuned.
You're watching us here on Chartbusters. As promised, let's get chatting with the management of precision component manufacturer Aegis. Their 920 crore IPO opens for subscription. Arvind Meligiri, who is the executive chairman and the CEO of the company, joins us now in the studio. Thanks a lot for joining. It's an interesting company. You have two verticals, aerospace and consumer, which you recently started, the consumer segment. Let's start with the objects of your issue first. You are looking to repay debt worth 430 crores and put capex for the 60 crores. If you could give us a sense on what does that do to your balance sheet in terms of debt reduction in interest costs, and the capex that you're putting in, how much additional revenue does that get you?
Today about 530 crore debt, and we'll pay majority of the debt through this fundraising, and that will reduce our interest cost definitely and help our profitability perspective.
By about 30-40 crores?
30-40 crore perspective.
And the 65 crores that you're putting asset on?
You should be able to do it. That's predominantly for aerospace. Historically, we have done 2 times the capital employed, and that should be able to add additional revenue corresponding to that.
All right, just to do some rough math, you're functioning at approximately 44% or thereabouts of capacity utilization, and you're ballpark around 1,000 crores. Now you're going to be getting another 120 crores from this capex that you're putting in. So the revenue potential, I'm not asking for the guidance, the regulators will be happy, your bankers will be happy, no tension on that front. The peak revenue potential with the current gross block will be around 2,000, 2,100 crores. Is that fair to say?
It's fair.
Okay, all right. Let's get a little bit deeper then. As you said, aerospace is bulk of your revenues. Could you tell us how the mix will move? Because consumer segment as a percentage, I think it was around 20% of your total mix, 10 to 20%, 100, 200 crores or thereabouts. So what is your ideal mix you're looking at in terms of contribution coming in from this consumer segment?
Yeah, if you look at it, our utilization perspective, you need to split between aerospace and consumer. Aerospace is already at about 67 to 70%.
Got it.
Okay.
So we are fully utilized the capital, whatever we have. That's why putting more capital. We have invested about 600 crore capital into consumer electronics. So that capital is yet to be generating the revenue, and that's why our utilization is only 22%. So as that utilization happens, that's when the revenue and profitability will shift.
So if we were to look at your potential 2,000 crore revenue, which happens over the next 2 to 3 years basis, your increased utilization and getting clients, etc., 1,000, 1,100 would be coming in from aerospace, and around 900 to 1,000 would be coming in from consumer electronics, making it 50-50. Would that be the ideal?
No, aerospace continues to grow at about 20% because we have a 20% growth last 4 years CAGR. If you look at order book of aerospace industry is booked for next 10 years. So it's a utilization is continue to improve and capex continue to happen. It's a very capex intensive industry what we are in. It's a capex led growth.
Also high barriers to entry.
High barriers to entry. And we are one of the uniquely positioned, vertically integrated, engineering, precision manufacturing capabilities we have built in India.
And the consumer business?
Consumer business also very similar, high precision manufacturing. And we are predominantly in mechanical products of consumer electronics industry. We don't do electronics. We are just qualified for electronic consumer component manufacturing scheme, ECMS scheme, and other mechanics recently. So that's part of the growth story.
All right. What about your EBITDA number? I'm looking at your last number. The margins that we have got out here is you're doing around mid-teens margins. Can you maintain it in this range? Are you satisfied?
Actually, our aerospace does much more. If you look at
give us the margin. Beautiful.
Aerospace is 20% level. Aerospace and consumer is obviously less because of the consumer being not utilized. Our margins are less. Overall.
So there's an upside. The utilization comes in, what does the consumer business margin settle at?
We are directing in the same level of where we are.
So eventually at a 2,000 crore utilization for revenue, your margins will be about 20%. That would be a fair estimate, right?
Estimate, yeah. I mean, that's where we aspiration is to get there.
And this happens by when? As per you, I mean, FY 28, 29?
No, it's a journey. Capex and the utilization and all the utilization and also the qualifications. All these are part of a journey, and we do see in a near term to get there.
Okay. In the near term, what is near term?
Look, utilization is moving every quarter up. So another another 4 quarters we can see some.
Okay, give us a sense on your working capital cycle.
Yeah, typically we are about 120 days on the sales, 120 days net working capital on the sales, and we feel that very similar on both on consumer and aerospace side.
So you're happy, you're comfortable at 120 days.
Yeah, I think that's very, very good for aerospace.
You're come at an opportune time because if I look at your breakup, the exports are a large part of your business, and even the domestic sales, they're deemed exports. So people will say, that y'all are very well placed because the rupee is depreciating. The market is nervous, but they'll say y'all could be a potential winner. Clarify this to us.
Yeah.
Will you all gain if if the rupee depreciates, because your sales numbers will move up, but you'll have a fair bit of imports as well in dollar terms. So that could nullify some part of it. And net, will it be a big benefit or is it a marginal benefit?
I mean, it's a marginal benefit. It's not a big benefit because we do high level of value add. Typically, our material costs are about anywhere between 30 to 50% in our products.
Got it.
And remaining is all value add. So that tends to benefit to a certain extent. But we also have a large capex, which mostly imported. So that offsets to a certain extent.
So about 80% of your expenditure is in dollars and 100% of your revenues are in dollars. So that 20%, any change happens, that would be no more than 3 to 4% back of the envelope calculation. All right. Final question before we let you go. Aerospace, we know there are a few companies in the world that make products for airlines, etc. And those are your clients. When it comes to the consumer electronics business, there are so many clients. Who have you gotten authorizations from? And who are the others that you're in talks with right now? We want to understand your client profile.
Look, I mean, we are predominantly high precision machining kind of activities, metallics products. And we are working on this industry. We have actually, if you look at consumer, we have consumer plastics piece and consumer electronics piece.
Got it.
And we have another piece which is cookware, which is joint venture with Tramontina of Brazil.
Okay.
So it's a 3 pieces of business what we have. And consumer toys we have basically making for Hasbro and Spin Master. Okay. And some of the customers in consumer electronics, at this time, we cannot be in a position to talk about it.
All right, and both Nigel and I,
while one of the large consumer electronic company in the world.
All right, we'll wish you good luck for the IPO. Look forward to your listing. Press you a little more on your numbers, your outlook once the listing happens. But also at the same time, you said you have a tie with people in Brazil. Maybe Nigel and I will probably come down to your Brazil factory as well, and look at all of that while. Talking about your business.
Yeah. Wish you all the best, sir. And on numbers, regulator will be on board, bank will be okay as well. We'll squeeze you a little bit for the near-term outlook. But thanks a lot for joining in.
Thank you.
Explaining your business to us.
Thank you. Thanks for the opportunity.
Well, for the time being, we'll slip into a short break. Come back, continue to focus on markets as well as on stock-specific action. Don't go anywhere.
Welcome back. Among the stocks of the day yesterday was Asian Paints. The top Nifty gainer has actually gained about 40% from its recent lows on improving demand environment, but more importantly, reducing competitive intensity as well, at least as far as the perception is concerned. In an exclusive conversation with CNBC-TV18, the management decoded the events of the last 2 years and more importantly, tells us what the future looks like. Hear it out.
This time was very, very exhilarating because we felt that, there were lots happening in the marketplace. There was lots happening at the competitive ends to that extent, and the market was not very great from a point of view of a demand perspective. So I think there were challenges all across in terms of what came in, and what possibly occupied my attention was that during these times, how do we really navigate the brand and really take it ahead and look at possibly playing to our strengths and really seeing that we are scoring centuries as we kind of do stuff.
All right, and 2 years later, as you stand, consumer sentiment is at the inflection point of improvement. Competitive intensity, while it stays, the disruptor is not the disruptor anymore, is an incumbent. And at the same time, you have a lot of your business excellence, etc., consolidated. So from where we are, how do the next 2 years look to you?
So if you look at even now, while you are seeing some shoots in terms of the demand, we are not seeing that there is belligerence, there is full exhilaration coming into the market to that extent. We feel that today the rural markets are just coming back, even the urban centers are just trying to show some spark. I feel that possibly it will take some time before we really get on to the parameter of really double digits and so on and so forth.
How long will it take?
It's very difficult to say, but I would say that possibly another 2 quarters is something we need to kind of watch out for sure in terms of what we are looking at. So therefore, right now, I think the whole peg is in terms of saying that we continue to grow higher than the market, and that's the pitch in terms of what we would take.
And you haven't been doing so for the last few quarters, and now you're confident of doing that, right?
The first 2 quarters of this year, we have grown higher than the market to that extent. And as you look at the H1, we have grown much higher than the market overall.
So you will continue to gain market
That's
share.
Absolutely.
And that still holds with 18 to 20% margins, because now whatever savings you will get, you will deploy it back towards building the brand, building growth.
Absolutely.
So say high single digit sort of revenue growth, double digit volume growth, and 18 to 20% margins is the new normal for Asian Paints.
So that's the margin guidance which we have always maintained. And I think the great part is that despite all what we have seen in the market, we have kept our head on the shoulders in terms of what we are doing. We've not kind of taken the whole route of discounting or pricing in terms of that, but we've taken the route in terms of building the brand and playing to our strengths.
What are you most proud of over the last 2 years?
I think the fact that we have been able to kind of really build the brand to a new high, and what we have been able to kind of get nuances and being very strongly related with home as a brand which no other brand is. So I would say that Asian Paints' whole attempt to kind of really get into the consumer's mind has been very, very strong, and we think we are appropriating home more than ever before.
What are you most disappointed by over the last 2 years? What is the one thing what do you regret the most over the last 2 years?
I would say that from a point of view of saying that we would have liked to grow much faster. I think that is something which possibly I regret to that extent. I think we could have possibly put more drivers in terms of looking at what we could have driven the market far more strongly. But I think given the circumstances, I would say it has been quite good in terms of what we have performed.
What have you done to ensure that your dealerships stay while within the guardrails of the law?
So we felt that one of the big things which has held by us is the relationships. It's not only about business, it's not only about margins, it's not about profitability. It's about relationships, it's your personalization, it's your ability to kind of really be empathetic about the business in terms of what you're dealing in. And I think that's something which I have tried, that it's not only me, the face of Asian Paints, but my entire leadership and my people who believe in that relationship very, very strongly. And that is something which I think is the trump card which Asian Paints hold.
And it's not just them, right? It's not just the disruptor. It's also the other incumbents, because everyone who's entering the industry right now, they respect you. Obviously, they say that we want to aim at being the number 2 player in the country. But when everyone is looking at the number 2 place, the number 2 also wants to ensure that they are number 2, and the number 3 also wants to ensure that they are not ceding any ground. So that on the whole becomes like a big pressure cooker situation for the industry. Have you faced that as well?
I think this pressure has always been there. You know, if I look back last 2 decades, it's been always there. Just that today the number of players who are coming and trying to take a dig at it is much more to that extent. And I think that's something which is good because it also, as a leader, keeps us on toes in terms of thinking what is the differential thing in terms of what you are kind of really talking of. And that's why I keep on saying that, you know, we will keep on creating trends. People have to make case studies out of it.
And to the investors, what will you say, who've been sitting on 2 years of losses?
I think the investors will see that this is a brand which they will have to watch out for because there are lots of things which are coming, and we think that possibly we have our clear eyes on the stakeholders and we will give them a good return.
All right, a good return for stakeholders. That's the promise coming in from Asian Paint. Sumit Singhal, the MD and CEO. You can catch him all day today on CNBC-TV18. Right, with that, we wrap up on this edition of Chartbusters with the news that the market continues to reel under a wee bit of pressure, but does it continue to stay there or does it recover? For all of that, you stay tuned. Trading Hour comes up next.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Ritu Singh and with me are Hormaz Patakia and Manglam Malu. Hormaz, Manglam, good morning. It's been a weekday of trade. The rupee obviously weighing in on the sentiments. Both the indices now in the red. Nifty down about 108 points, Sensex down about 288 points as we speak.
Yep, 110 points today, but from record highs down almost 400 points for the frontline index. What's interesting is that the Nifty is just at the 20-day moving average. 25,922 is where the 20-day moving average is. That's where the Nifty is. The Nifty Bank is about 200 points away from there. So we'll watch out for how that pans out, because the big trigger for them would obviously be what the RBI has to do on Friday in terms of an outcome from the monetary policy meet. And the one thing that's supporting the frontline index right now from falling much further is the IT pack. So if you pull up, the IT index or any of these large cap IT stocks, they are the beneficiaries or the expected beneficiaries of a weaker rupee, and there you have it. Infosys, a fair weight on the index. TCS, a decent weight on the index itself. The IT index by itself has around 20-25% sort of weight on the frontline index. So when that index is doing well, the only one which is actually in the green right now, it supports the market, and that explains why the Nifty is at an important, technical level as well. The broader markets, though, could do a lot better. Only 700 stocks in the green for about 2,000 which are in the red. So the crisscross lines come up for you. The broader markets, the Nifty mid-cap index at the low point of trade. At the widest is where we have the distance between the red and the green lines. But Hormaz is always puts the spotlight on the top movers in the market this hour. Hormaz has walked across to the wall. Hormaz.
Well, not a very pretty looking screen, especially when it comes to the broader markets, as has been the case over the last few sessions now. We start off with a losing stock, then Indian Bank. Now, the stock was the best performing PSU bank of the year so far, but the last couple of days have been forgettable ones. Now, 6% lower for Indian Bank. The volumes already at almost 65% of yesterday's volumes already, and 17.5 lakh shares already traded on Indian Bank, the 20-day average of close to 4 lakh shares, so declines on very heavy volumes, and now the stock has moved below its 50-day moving average of 817. Now, why the 50-day MA is crucial? Because it has not closed below that level since July of this year. So it's a very important level for Indian Bank to defend before the close of trade. And why I meant it was the best performing PSU bank, not just this year, but over the last 5 years as well. The stock from almost 80 rupees had gone up to almost 900 rupees in just these last 5 years. Now, bucking the trend in otherwise weak market today is Route Mobile. The stock is up 10%, the biggest single day gain and volumes since June of 2024. Almost 45 lakh shares have been traded already on Route Mobile. The 20-day average here is only 91,000 shares. So gaining on very strong volumes, the stock has moved above its 50-day moving average of 730. And after 5 straight months of losses, the stock has finally gained in the month of December, but continues to remain an underperformer this year, has almost halved in value and was down 13% last year as well. And lastly, Spark, and it continues to have that spark in today's session as well, was up in a 20% circuit yesterday, another 8.5 added today, so almost 31% in the last 2 sessions. The volumes are already double of what yesterday's number was. At 5.5 crore shares have been traded on Spark. The 20-day average is only 4 lakh shares, and this 2-day move has resulted in the stock breaking above all of its key averages and has trimmed its losses now on a year-to-date basis as well. Now down only 13 to 14% is Spark. Back to you guys.
All right, Hormaz, looks like we'll have to slip into a short break there, but we'll keep track of the markets and we're also focusing on the crypto market when we return with Manisha Gupta, so stay tuned for that.
Welcome back. As promised, shifting focus now to the crypto space. Manisha is here with the latest updates. Manisha.
Well, thank you so much for that, Hormuz. While we have seen some bit of a rebound come in for the prices here, but there's another debate that's raging within the crypto space. One, that a lot of money from crypto is going into AI. And the second, is AI going to be more priority than what perhaps blockchain can do? But there are various reports also suggesting that putting the two together perhaps could really work very well strongly going ahead. So let's take at both of these markets first of all. When it comes to artificial intelligence, well, it is known for speed, efficiency and processing massive data sets there. Also, when you look at the infrastructure part of it, AI is known to be centralized functioning, and then you have high performance computing which comes with AI. The current impact that we have coming in from artificial intelligence is that it is integrated into financial consumer markets for predictive analytics, risk reduction and also custom recommendations therein. Now, take a look at what cryptocurrency really does. It utilizes blockchain and its core strength is decentralization, which is not the case with AI. And then you have more transparency and security, of course, via cryptography there. If you look at the current impact of that, well, we do have decentralized network of computers within. The hurdles and regulation is something when it comes to mainstream acceptance that crypto still seems to be facing some headwinds from. But when they both come together is what the world really seems to be working on in sense of various research reports and how perhaps it could change the face of the world in the next 10 years or so. So one is decentralized AI. As of now, AI is centralized while blockchain is decentralized. But decentralized AI is what the street is talking about right now. So with this, crypto can enable decentralized networks, making AI more accessible beyond the large tech companies into mainstream as well. The second thing is about data security, because when you talk about blockchain, you also are talking about transparency and open ledgers here. So this can create an auditable trail for data models used by AI, enhancing trust and security. And finally, it is also about the data economy. Herein, the crypto can facilitate secure data sharing and management. So the movement and various companies and technology firms and large corporates seem to be working is it putting AI and blockchain together.
Manisha, thank you for those updates from the crypto markets now. And getting in a corporate conversation going on the show, Zen Technologies and defense stocks have continued to be in focus, and more so now in looking forward to the visit of Russian President Vladimir Putin towards the end of this week. We are being joined by Ashok Atluri, who is the chairman and managing director at Zen Technologies on the show. Mr. Atluri, good morning. Thank you for joining in. You've completed 4 strategic acquisitions recently, as for your company is what I'm reading right now. If you could tell us how much are these strategic acquisitions going to benefit you, if they are going to benefit you this year in terms of the P&L, and if not, by when do they start accruing into your balance sheet?
So the companies that we have acquired, two of the one is ARI simulation. They are into naval simulation, and I think they've already started contributing significantly to our both to bottom line and top line. And there are other companies like AI Turing, which we expect to start contributing in the current year. There are a couple of other companies like TISA and which is a loitering munitions company. The other is Vector Techniques, which is into subcomponents and engines for drones. We expect them to start contributing next financial year.
Could you give us a sense on how much Vector Techniques and Bhairav Robotics would contribute to your overall sales? Largely because when you had acquired them, initially put money into them, Vector Technologies had practically zero revenue, as did Bhairav Robotics. So if you could give us a sense on how those businesses are now scaling up and at what level will they start contributing to the revenue?
So, they will I'll not hazard a guess, but next year they'll start contributing. And what we have been insisting on is the products that they make should be unique and the first time in India. And the value addition should be significant so that, R&D is enabled with the margins that we have. So, but the exact, probably, by early next year, we should have some figures in hand.
Have any proof of concepts around? Have you, signed any letters of intent?
Yeah, I mean, the demonstrations are going on for like AI Turing has been demonstrating the remote control weapon stations, and we expect them to contribute in the current year itself. But so that is going on. And in the meantime, we are going to attend US world's largest simulation exhibition in US, where we are looking to show our showcase our products, which is an outreach for the exports at this point in time. And we find it very, very interesting because what has happened in US is a dramatic shift from earlier slow paced procurement. Now they're moving very, very fast. In fact, there are 12 agencies. They have collapsed them into 6 agencies called Program Acquisition Executives. And which is what is really good for Zen Technologies is that earlier they would insist on a huge presentation paperwork for shortlisting companies. And this would be all talk and no walk in the sense. But now they are saying, but if you have a product, please come and demonstrate. If you like, we will buy it. And then if we after buying, we'll test it out. If we like it, we'll scale it up. So this is huge for companies like Zen Technologies, because we are completely self-funded R&D, and we are looking at really scaling up in US and for both US and NATO markets. So this begins a very big opportunity, and this is borne out by their experience with in the US setup. They have seen companies like Lockheed, Boeing tied up with NASA, and for 20 years doing cost plus basis R&D, but not flying a single rocket. And then they saw a company with skin in the game, self-funding the R&D and saying, pay me only if my rocket flies. SpaceX. So, we see the SpaceX advantage. So
Got that, Mr. Atluri.
Actual reality. Yeah, sorry.
Yeah, sorry to interrupt there, but you've got this contract of 108 crores from the government for the supply of tank crew gunnery training simulators. Just give us a sense of what ordering activity in the second half will look like. The first half has been pretty weak. Where do you think you'll end FY26 with?
So I think the two things which were happening, one is the procurement was going on for the regular orders. And then what happened suddenly was when operation, the crisis happened, Operation Sindoor crisis. After post that, the regular procurement was slowed down and much focus was given on the emergency procurement, which we expect to conclude in a month's time. And so the regular orders that we were expecting around September never materialized. But they have started materializing. In a couple of them, we have got it already. But overall, I think the second half will be heavy with the orders, and we have already started getting this. Not only the 108, but we got the for the anti-drone system almost 300 plus crores. One was a repeat, or order to upgrade the existing system. The second was for the hard kill. So, really, really cutting edge orders in the anti-drone system and simulators also, for the tank simulator, etc. We expect the simulator orders to scale up as we speak.
So, in that case, Mr. Atluri, if you are expecting these orders to scale up, where do you end FY26 in terms of revenues and margins, and the same for FY27 as well?
So, at this point of time, we are not exactly going year-wise, but, what I can say is this, that, we were expecting a cumulative turnover of 6,000 crores plus over 26, 27, 28. But 26, unfortunately, will be very muted year because of the various reasons that I have shared just now. But, what we think is both for 27 and 28, we will be able to make up the difference and try to deliver the total figure that we had envisaged.
All right, we take that point. So FY26 to 28, that 6,000 crore now shifts to 27 and 28 and not beyond 28, right?
Yeah.
All right, take that point. So next 2 years have a lot to do, weightlifting of almost 3,000 crores every year in terms of top line. Now, will that be front-ended or back-ended?
Again, what I'm saying is 6,000 crores for the 3 years. So whatever we do this year, you have to take it out. And the remaining, whatever are left out of the 6,000 will be achieved in 27 and 28. So, again, I probably it will, both years will be maybe, I think 27 would definitely be not as big as 28.
All right, take that point. Thank you, Mr. Atluri, for joining in. We take a short break. On the other side, our big story, the rupee has breached the 90 mark as against the dollar for the first time at an all-time low. What impacts could it create on sectors? We'll discuss that. Stay with us.
Welcome back. Still 120 points down on the index, fighting to hold that 25,900 mark. But it's big story time. Unsurprisingly, it's about the rupee, and our entire battery of research experts at CNBC-TV18 are here to take us through the impact that the fall in the rupee will have. But first up, Ritu, you have to tell us more about the rupee and the record low that it fell to in today's session as well.
Well, yes, it breached that 90 level psychological mark for the first time ever, hitting a fresh record low this morning. The rupee actually opened at 89.96, and within seconds, I think in less than a minute, we saw it crossing that 90 mark pretty much immediately. No RBI support really coming in on those levels as was expected. This sharp depreciation is almost 5% this year because capital outflows continue from the foreign investors. They pulled out nearly $17 billion this year, and that, of course, coupled with the strong dollar demand, we've been seeing the subdued domestic equities, which makes the market unattractive. And importantly, the lack of any progress on the US-India trade deal. We pretty much know the reasons that are weighing on the sentiments as far as rupee is concerned. And this pressure, experts we've been speaking to say will persist in the near term. But do keep in mind, we have adequate reserves. I think last was about $688 billion disclosed data. So, good for, of course, importers. For exporters, rather, not so good for importers.
All right. Not so good for importers. So what we'll do is then we'll find out about the sectors that benefit from it, the exporters, in particular the IT space, service exports, and that's the only index which is actually in the green right now as we speak. Rima joins in to tell us the impact alongside all the others who will talk about their specific sectors. Rima.
Thanks so much for that. So, before we get to INR depreciation, once again to reiterate that the Indian IT sector has been an underperformer. Year to date, the Nifty IT index is down 13%, though it started recovering from the 52-week lows. So from the 52-week low, the index has recovered more than 20%, but it's still down year to date. And from its all-time high level, Hormuz told me it's down close to about 18%. So, one of the drivers for the sentiment today is the INR depreciation. Typically, the simple math tells you that a 1% rupee depreciation benefits margins by about 25 to 30 basis points. But then again, it depends on the kind of hedge ratio companies have. But, outside of that, one reason for the increasing optimism surrounding or why IT stocks and shares are seeing a look in is the underperformance, and also now the AI infrastructure. The global AI trade is moving from infra build out. They're saying eventually maybe that's going to peak out at some point of time. There is diminishing marginal utility, and the focus will shift to application services and maintenance. And this will unlock net AI revenue for the sector 12 to 18 months down the line. And plus, yesterday when we were talking to experts, they're saying assuming the Indian IT companies grow by 5-6%, plus you throw in a dividend yield, that makes it fairly attractive, and therefore it's time perhaps for to take a look in at the sector.
The only sectoral gainer in today's session is the IT index. Rima, thank you for that update. From IT, we move to pharma. Ekta, tell us more on that.
Well, yes, for when it comes to the rupee depreciation and pharmaceuticals, what the analysts have indicated is that it is a short-term impact. The impact of the rupee depreciation is positive, but it is limited. So that's because most of the Indian pharmaceutical companies hedge their USD exposure. Now, there will be a temporary gain in terms of realization of export sales, but there are input costs. So the equation for each pharmaceutical company depends on how much they do import in terms of input costs and how much do they export. So a lot of the companies who do have exports to the US will be benefiting from the rupee depreciation. Now, the input costs also will rise temporarily, but companies will be negotiating with vendors. Remember that the rupee has depreciated continuously over the past couple of years, and hence the pharmaceutical companies are quite well versed in terms of the negotiations and in terms of the impact as well.
All right, let's go across to Sudarshan for autos. Sudarshan, those with a bit of an export bias will be happy.
That's correct. So while the auto companies or auto stocks are today under pressure, but there are certain companies or the pockets from the auto sector that will benefit the most from rupees fall against US dollar. And first on the list is TVS Motor, because 30% of its total volumes come from export. And as far as revenue is concerned, exports form nearly 25 to 26% of the revenue. Second name is Bajaj Auto. Almost 50% of its revenue comes from the export segment. And in Q2 FY26 dollar realization was 87.1. So I did certain calculation. So in Q3, dollar realization increases to 89. And management today early in the morning has said if there is a fall of rupee 1 against US dollar, it lifts EBITDA, annualized EBITDA by almost rupees 200 crores. So you can do the calculation, what can the increase be. Now coming to auto ancillaries, I have taken 3 names. Samvardhana Motherson, Bharat Forge and Minda. Samvardhana Motherson, it would be a minor positive because 60 to 65% of their total revenue comes from the export segment, but they do have the manufacturing base in the US and Europe, so that will increase the costs as well. Coming to Bharat Forge, for Bharat Forge, 60% of the revenue comes from the export segment, and they have majorly 3 businesses. First one is Class 8, then PV EV components, and the last one is forging business, which is a high margin business. So Bharat Forge will be impacted positively, like hugely positive it would be for them. Coming to Minda, it would be a negative for them because they have the 70% of the revenue comes from domestic business. So now it will increase the import cost because they import chips and all the other components. That's the reason they are majorly dependent on the import, so it would be negative for them. So it would be a mixed impact, but majorly positive for few companies.
Take that majorly positive for a few companies, but a couple of companies their import bill increases. What happens to the oil and gas and chemical companies? Sonal joins in to wrap this up.
Well, let me start with oil and gas companies. It's going to be a mixed bag. Let's start with the oil producers. Of course, they will tend to benefit from this because their realizations are dollar denominated. So every 1 rupee depreciation improves EPS for ONGC and Oil India by 1 to 2%. For Petronel LNG, their regasification margins are linked to dollar, and that's the reason why they will improve their EPS by 1 to 3%. For OMCs, it's a mixed bag. They will see some imports as well, but yes, their GRMs, they are dollar denominated. So 11% improvement in EPS due to 1 rupee depreciation. For city gas distribution companies, it could be a negative because remember, they import a large part of their LNG, and that is something which would impact their EPS by 4 to 11% negatively. For chemicals, it's a huge basket, right? So can't talk about all the stocks, but some of them which have a large exposure to the US and they get dollar denominated revenues there, something like an SRF, we have Aarti Industries, Atul Limited, Naveen Fluorine, all of them tend to benefit because of the depreciation that we've been seeing in rupee.
Sonal, thank you for that and for summarizing all of it. And thank you to Reema, Ekta, Sudarshan as well as Ritu for taking us through the depreciation in the rupee and the impact on various sectors as well. The rupee at a new low, the index also making an intraday low 25,891 and now is staging a bit of a rebound from those levels. Take a short break, continue our conversations with the markets with Ashi Anand from IME Capital on the other side.
Flirting around with the 25,900 mark for the Nifty. You're watching us here on Trading Hour, and this is from the FNO desk. If you look at the frontline indices, the Nifty underperforming, the Nifty Bank falling even more. And if we have the mid-cap index, the broader markets would tell you that the portfolios are hurting. The only index which is outperforming right now on account of the weaker rupee is the IT pack. And we had Rima tell us that in the last segment as well. Remember, the IT index has been an underperformer, but now moving off lows with the additional benefit coming in on the weaker rupee. So we have the top, names like Wipro, TCS, Infosys, all of them doing particularly well. But another, sector which gets impacted by a weaker rupee are the PSU space. So you look at the SBI stock, BEL, NTPC, and in that the PSU banks in particular even more so, because that has a correlation with the bond prices. The bond prices fall when the rupee weakens, the bond yields rise, and that impacts their mark-to-market books as well on the overall performance. So we have Indian Bank, PNB, Bank of Baroda, Canara Bank, all of them selling off fairly sharply. The important levels to watch out for: Nifty just below the 20-day moving average at 25,922. The Nifty Bank at 58,771, about 100 point away from the 20-day moving average. Can we hold on to these levels and close above them? That's what the bulls would want. And as far as the options data is concerned, tells you that on the markets above 26,000, there is a fair amount of supply. And these are options that expire next Tuesday. So 114 rupees on the 26,000 call in terms of premium, 1.8 crore shares outstanding, a crore and a half added today itself, telling you upwards of 26,100, there could be supply for the market. But at lower levels, there is some support around 25,800. Why do I say that? Because the 25,900 put also seen a fair amount of writing at around 1 crore shares outstanding open interest, 100 rupees in premium. So 25,800 to 26,100 is the broad range that the street is working with for the very near term.
All right, Manglam, thanks for bringing us that update. We have with us a guest in the studio, Mr. Ashi Anand, CEO and founder at IME Capital, joins us now. Mr. Anand, thanks very much for being here. You're quite bullish on the whole digital space and, in particular, fintech as well. You hold significant, stakes in the likes of Paytm, for instance. Tell us your thesis on those kind of companies. I mean, the only recent positive, so to speak, we've seen on Paytm, a stock like that, has been the payment aggregator license that's come in. But what is the upside from here on, given how the regulatory overhang has been a big concern on that stock?
Sure. So actually, if I can just start off first by just talking about the overall thesis, because Paytm really fits within that.
Yeah.
I think what we are seeing very, very clearly is a very sharp value migration that is taking place from traditional businesses towards kind of new age digital first platforms. And you're seeing this across industry segments. This is a structural kind of theme that we believe is only going to accelerate as we go forward, as kind of the newer generations come in more into the consumer class. That is where that trend we believe will only just accelerate. So you have very, very robust kind of trends in terms of growth towards these new age digital companies. A very important element about digital platforms is that these businesses also tend to move or gravitate towards monopoly, duopoly, or very tight oligopoly kind of structures. So very large markets end up being consolidated within a few companies. Now, that is something similar that we kind of seeing in the kind of payment space or in the kind of overall fintech space. Now, if you're looking at a company like Paytm, while there is clearly a traditional payments business, right, and that's the core of the current business.
Yeah.
What is really very interesting is the longer-term monetization capabilities of as Paytm kind of really starts flexing its muscles around lending, around capital markets, the kind of distribution that Paytm has. And these are a very large part of its consumers are consumers that the traditional finance companies could not really reach. You've seen a recent IPO grow, right? And the kind of growth they've had of extremely kind of in a very short period of time. So I think what is interesting to us about Paytm is not what's currently there, but as you go 3-5 years down the line,
the potential
and the kind of incremental flow through of revenues to profits in financial services. It's a pure distribution business. That is really very interesting, and we see a lot of value being created.
We understand, and it's a big prospect from a long-term standpoint, etc. But just to play devil's advocate here, because what we've seen, barring the food tech companies, which have now migrated fairly well to the quick commerce companies, a lot of these digital natives, a lot of these companies invariably fail at the next leg of evolution. So a lot of the brokers, the discount brokers, etc., will not extrapolate that gain into financial services as much, or a lot of the, say for instance, back in the day we had Naukri, InfoEdge, it still forms a large part of their overall business. They've not captured that sort of moat into other things. So is that a risk? Say for instance, a lot of people using Paytm right now But maybe as they come up with ancillary services or some other app gets the benefit of that a lot better than what these guys could.
So actually, that's the interesting point, right? And I think that is really one of the core of when we are evaluating digital platforms, understanding how easy is it to kind of be able to launch or kind of come up with supplementary services that kind of add incremental value.
Yeah.
Now, if you look at Paytm as an example, before this kind of recent weakness in kind of unsecured lending, they launched kind of lending on the platform and just BNPL and personal loans.
Yeah.
In a year and a half of their launch, they had crossed a dispersal run rate of SBI cards, the second largest issuer of cards in the country. Right? So in terms of do users on the platform kind of, are they willing to use on other services? I think that is quite clearly demonstrated in the case of Paytm. Right? Now, you've had the kind of regulatory issues. You've also had weakness in unsecured lending. So that part had gone a bit slow. But you clearly do see that kind of potential, right, in terms of just the kind of scale that can come in quite rapidly. So when we do look at kind of digital platforms, right, the whole core is in terms of the monetization. How clear is that? So say, for example, when we had launched our digital disruption strategy in Feb 23, at a time when these stocks had been hammered, they were down 50-70% post the IPO. And I think our core call was that if you do study their cost structures and you understand the kind of monetization levers, these companies can be incredibly profitable over the longer term. But you really have to, there are few assumptions that have to be tested. So say, for example, back then, Zomato and Swiggy did not have platform fees. There were hardly any delivery fees before that. Delivery fees were just introduced post-COVID. But as they kind of add on monetization kind of levers, consumers, I think the core call on digital platforms is that once a platform has achieved a certain level of dominance and strength, it becomes very difficult to replace them. And then suddenly users, they don't have an option. You are not going to not order pizza because there's a 5 rupee platform.
So just before we let you go, and you spoke about the platform fees, etc., where do you stand on Meesho? Because they've gone on record saying that they will never have commissions, they will never have platform fees.
So Meesho has no commissions, has no platform fees. They have a 30% take rate. It's amongst the highest in the industry. Right? So you don't need to make money. There are multiple different forms of monetization. Meesho, I think, monetizes advertising income is a very big part. And the whole logistics orchestration that they do, which is amazing, right?
So you like it?
It's an IPO, right? So we do have to be a bit particular, but I think as a business, it is really quite remarkable in a period of 5 years to kind of come in and compete against giants like an Amazon and a Flipkart.
And does that have a threat to delivery as well? Because I was just reading a note yesterday that said that their insourcing model is going to be a threat to delivery's core business. So does that become a threat? Because delivery as a stock in general has not done well anyway.
So in fact, one of the big reasons has been Meesho's insourcing that they've already been doing. And I think the interesting part about how Meesho has done it, they've been able to do this without actually building out the logistics infra itself, just creating a kind of tech layer to build out the logistics. So yes, I think a part of delivery's underperformance could kind of be linked to that. But I think delivery still, in terms of a logistics company, is one of the most attractive logistics companies from a longer term perspective. So that is a company that we still do like, but Meesho is clearly a headwind.
Right, Ashley, thank you so much for sparing time and joining us today with your views on these interesting insights on this conversation.
Are you where would you put Lenskart? As a tech company or a retail company?
So we're having huge debates on that internally.
Got it.
According to us, so if you're looking at a company like a Lenskart, you're looking at a company like a Mamaearth, there are quite a few of these companies that kind of are kind of digital first, but the whole omni-channel and the physical infra is quite
Digital
important.
is what the street is calling them.
Yes, so I think we prefer pure digital companies. It's much easier to kind of scale very rapidly in those models. Though these are, I think, amongst the next best bet. Right. I think a lot of traditional businesses which aren't incorporating digital in a big way are going to kind of suffer from.
They're your one-down batters. Thank you so much, Ashish.
Thank you so much for having me.
With that, we'll take a short break, come back, get you more on the markets and a lot of individual stock-specific action. Stay with us. Welcome back. In a wobbly market, what was a good gainer yesterday was Asian Paints. In fact, from its lows, the stock has gained about 40% on improving demand and reducing competitive intensity perception. In an exclusive conversation with us, the management decodes the events of the last 2 years, what the future looks like right now, and more importantly, when the company decides to pull the plug on their home improvement business, which hasn't been doing as well.
I think this pressure has always been there. You know, if I look back last 2 decades, it's been always there. Just that today the number of players who are coming and trying to take a dig at it is much more to that extent. And I think that's something which is good because it also as a leader keeps us on toes in terms of thinking what is the differential thing in terms of what you are kind of really talking of. And that's why I keep on saying that, you know, we will keep on creating trends. People have to make case studies out of it.
For me personally, one of the things which is a perpetual disappointment from an Asian Paint standpoint is the non-paints home decor business.
Sure.
It's definitely not gone down the way analysts expected, perhaps not gone down the way you expected it as well. Some of the bolt-on acquisitions that were made did not go down well. They were perhaps strategic missteps, so to say. Some of the targets that you've given haven't been met. And for a company the size of Asian Paints, any new foray, one would have imagined would be big, bold, and something not very different from what others would do in the paint industry.
Yeah.
So what was the problem there?
So I feel that, you know, the way we anticipated the market, we were here not fighting any organized competition. We were fighting unorganized sector. And what we didn't realize in the unorganized sector is that the flexibility of pricing, the flexibility of the way they are able to kind of regionalize the product, I think was something which was very, very high. So I think it has taken us some time. We have put about 70 beautiful home stores across the country. The stores are doing well. But when you compare to the size of what we do in coatings, obviously the size is very, very small in terms of what's happening. And what you say is right. Some of the acquisitions which we did, we kind of grew them in the first 2-3 years, but then we were not able to sustain that kind of a buoyancy in terms of what happened to that extent. But as we see it, I think it's an integral part of our strategy because we feel that if you own homes, okay, one of the big things which Asian Paints does is that as part of Har Ghar, you know, you can't just own surfaces, you have to own spaces. And today decor gives us that big rope in terms of looking at owning spaces. And we feel that that's a very big differentiator for us because if you were to kind of put all the brands today, okay, only one brand today appropriates home, and that is Asian Paints. And that is where possibly the decor strategy is still very, very relevant to us in terms of where it stands. Yes, we have a task in terms of how we need to kind of put it into shape and get it back rolling to that extent, but we are committed to it.
And how long will that commitment last, and at what point will you believe that, you know, okay, we've put enough resources, mind space and ideas behind it, but maybe it's just time to pull the plug?
So we are giving ourselves another 2 years in terms of looking at really getting behind it in terms of what we want to achieve, what we want to do to that extent, and really seeing that we can bring excellence in those categories, which is what was Asian Paints' style of businesses.
And what would the end of those 2 years look like for you to call it a success in terms of numbers?
So we are looking at a certain contribution which that decor piece which kind of gives us, and we are looking at something like about a 7 to 8% contribution to our overall business in terms of what will be there to that extent. And that is something which possibly would be an indication that we are on a right trajectory.
And in coatings itself, what is your aspiration? Because right now, obviously a large part comes in from repainting, then there is a certain part which comes in from, you know, the new buildings which are announced, and thereafter there is this new TAM which is opened up, which is government-led infra.
Yeah.
Do you have an ideal mix here?
So see, when you look at today, I think the trend which we are seeing is that the whole area of the industrial and the B2B space is changing quite a bit, and that is really expanding, given the fact that you're talking of private capex and you're talking of government investment, which is coming in a very big way, which I believe will continue to that extent. And therefore, one of the big focus which we are taking is basically the B2B and the industrial business in terms of where our contributions are relatively less as compared to possibly some of the competition in terms of what is there. So that's the new piece in terms of the growth trajectory in terms of what we are taking in a very big way to that extent, apart from the fact that the retail excellence will continue in terms of what we are doing to that extent, and that would kind of really see that it kind of firmly pegs us amongst the top 5 global players in the world.
So if I had to look at Asian Paints 3 years from now, what according to you would the revenue mix be? How much comes in from decorative? How much comes in from B2B? In decorative, how much comes in from, you know, retail decorative, and how much comes in from, say, government infra or all the housing projects, etc.? How much comes in from home decor and how much comes in from international?
See, roughly, if you look at it, basically the whole coatings landscape Overall, when we say from a point of view of a decorative, that will still lie in a band of about 78 to 80% in terms of as I see it. And out of that, possibly about a 20% contribution would come in from the B2B business to that extent. When you look at the industrial business, I think that will continue to kind of go on to a realm of something like about 8 to 10%, and global would be another 10% to that extent.
All right. And, you know, you will still be 18 to 20% margins at that point.
That's what we are kind of dwelling at very strongly.
There is some recovery from the lows of the day, so around 40 odd points on the Nifty, still down 100. The mid-cap index though has seen a bit of a 50-point recovery from the low, still down 550. The indices continue to remain in the red as we head into the second half of the trading session. Take a leave on this edition of Trading Hour from Manglam, Ritu and me. Thank you for watching. Halftime report on the other side.
Stocks see broad-based selling as the rupee weakens but is off the day's low. Declines, however, far outnumber advances. Some rupee sensitives like IT gain, while utilities, energy, industrials and autos slide.
The rupee breaches the 90 mark against the dollar on tight dollar supply and a delay in clinching the US trade deal, while importers and those with overseas leverage brace for impact. Companies with sizable exports like Bajaj Auto cheer the gradual decline.
Meesho's 2,400 crore anchor offer draws a rush of investors, but high allotment to a local fund miffs some who walk away. Even as its IPO opens to the public today, the founders promise they'll engage with investors and build new revenue streams to create shareholder wealth.
Asian Paints MD and CEO Amit Singhal expects double-digit growth in the coming quarters with market share gains. Amid increased competition, he also aims for sales of 50,000 crore rupees in 4 years with a promise of strong shareholder returns.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Putra. Well, there are a lot of complaints for the equity markets as well as the rupee and what is taking place both on the macros and the micros at this point in time. We have the mid-cap index which is underperforming. So we have the mid-cap index which is down over 570 odd points and the Nifty which is down around 0.4% as we speak. The key culprit has been the rupee depreciation. It is down for the third day in a row in terms of the rupee. It's depreciated around 70 paise just in the past 2 to 3 trading sessions. And as you can see, currently at around 90.27. So just going from one level to another and reaching the 90 level mark, which, you know, most of the traders actually had spoken about hitting those levels at the end of December.
Yeah.
So that's where we are at when it comes to the rupee depreciation. It's the worst performing currency in the entire Asian space. So it gives you a sense in terms of where we stand, Sonal.
Okay, all right. So that's, of course, the big story that we are tracking very closely. By the way, an IT is one index that you should keep on your radar. It is the only sector or the index in the green today. It is at the day's high as well. So batting it for the bulls. But do remember, it underperformed for a long period. And, of course, the rupee depreciation is positive for that index and the companies in that sector. But, broader markets, they continue to be on our radar, continue to underperform. And we have Vivek with us to take us through the stocks that are moving around in trade. Vivek.
Well, that's right. What's essentially transpired is that market breadth has been quite muted. But in the last 15 minutes or so, a bit of a recovery that we're seeing in the market, and that's aided slight change as far as the breadth is concerned in the broader end of the markets. In terms of individual stocks and sectors that we're tracking, well, can't look beyond the IT pack, clearly a beneficiary of the falling rupee, and that is something that has aided the kind of up move that we've seen today. A Wipro up almost 2.5%, leading the pack as far as the IT space is concerned. From the broader end of the markets, Route Mobile, one of the top gainers as far as the NSE 500 index is concerned, moving up on strong volumes, almost 10% higher over there. Spark yesterday did see some positive news flow coming about in this particular name. Stock yesterday ended at the higher circuit today. Another 8% up move as far as Sun Pharma Advanced is concerned. And DOMS, very strong price action here in terms of volumes too. It's been quite higher. And also, Antique today has initiated coverage on the stock with the buy rating, so 2.5% pop for DOMS. On the other hand, quite a few laggards. Well, can't look past the PSU banks in terms of the laggards today. Yesterday, a clarification coming in saying that at this point of time, the government is not looking to hike the FDI, allowed FBI limit in PSU banks. On the back of that, all of the PSU names today taking quite a bit of a knock. Look at Bank of Baroda, Canara Bank, both of them down over 3%. Along with that, financials, NBFCs too, most of the names today are under quite a bit of pressure. Sri Ramfin, PNB Housing Finance, all of them seeing selling pressure emerge. Bharat Forge, the Class 8 truck orders have come by November, both on a month-on-month as well as on a year-on-year, has seen significant decline. And lastly, Angel One, operational metrics that the company gave out today morning is quite muted on the back of that over 4% fall as far as Angel One is concerned.
Okay, all right, Vivek, thanks very much for that. So those are all of the buzzing stocks in today's trading session. But let's now shift focus to the primary market. We do have Corona Remedies 655 crore IPO, which opens for subscription on the 8th of December. The price band for the offering is around 1,008 to 1,062 rupees. We have with us Nirav Mehta, who's the promoter and MD and CEO of Corona Remedies, joining in. Nirav, thank you very much for taking the time out. If you could just start by giving us a couple of details with regards to the IPO. We understand that Chris Cap will be selling a certain amount of stake, and it is a pure OFS, so none of the money will be going to the promoter. Or none of the money will rather be going to the company. So just give us a sense, how much is the promoter divesting, how much is Chris Cap divesting, and what are the long-term plans for a PE fund such as Chris Cap in your company?
Yeah, thank you, Ekta. Thank you, Sonal, for inviting me over here on the CNBC live show. We are Corona Remedies Private Limited, going to become a Corona Remedies Limited. Before answering your question, let me take you to the name, because, Corona, we have started on 6 December 2004, where we want to give a name to the company, and we have identified that let's give a name to the company around sun, which is a source of energy. And there's a company nearby that name in the industry, so we have find out other name. A corona is nothing but when sun rises, the orange color ring is called corona. Brighter ring of sun, outside sun is corona.
Sure, Mr. Mehta, we get that.
Corona Remedies Limited.
We get that. Mr. Mehta, on paucity of time, I'm going to ask you to just focus on the details in terms of...
Yeah, right. So it is about 10.09% OFS, where promoter family has been divesting about 3.5%, and Chris Capital is divesting about 6.59%. In the company, Chris holds 27.5%. Out of that, they are divesting this. This is about 70% plus OCF EBITDA. So there is, positive cash in the business been generating by the company. So I think so there is no need for the primary as of now. That's why we are going for 10.09% OFS. Chris Capital has been very seasoned private equity, professional private equity, so they will divest in years to come as far as their stake is concerned.
Got it. The remaining stake, if you can clarify again, it will not be sold in the near term. Have you had that conversation with Chris Capital? Because it's a PE firm which is selling now. Maybe they could sell once, they do get the kind of returns that they have wanted from this particular investment. And in terms of your growth plans, you have been doing a lot of acquisitions to, take up on more growth. So what is the acquisition kitty that you have in place right now?
So as far as acquisition is concerned, we have always gone on the brand acquisition or a therapy basket acquisition, which has been in a fitment to our product. Whatever product has been there in the fitment, we try to acquire if we can able to give the justice to the brand. In the past, we have done the acquisition with a pharma giant, Glaxo, Abbott, and the last acquisition with the Sanofi Aventis, where we acquired a few of their brands. The important is how we can give a justice to the brand. Are there, this brand are in the fitment to us, and every time till the time we have demonstrated a great outcome of the acquisition of the brand. We will eyeing on it. Today we don't have anything in the kitty, but we will eyeing on the portfolios or brands which has been in our fitment or in a therapies, or with the therapies we can enter into the new therapies.
Okay.
As far as Chris Capital is concerned, today they are going to divest about 6.59%. We have, they have a full conviction on the company as of now, so they will divest in years to come whenever they want to divest.
Okay. Well, one of those strategies has been, Mr. Mehta, to, acquire these brands from MNC companies such as Bayer as well as Sanofi and Abbott previously. Mayoril in particular, which is a Sanofi brand, how much has it grown? Because it seems to be one of your top brands that you're selling today. So how much was it in terms of sales before you bought it? How much have you scaled it up to? And is that a key strategy of Corona Remedies going forward, which you can apprise us of? Are you going to continue buying MNC brands aggressively?
Yeah, so as far as Mayoril is concerned, there's an interesting story. In FY23, we have bought this brand at around 230 crore plus. And at that given of time, the volume of business of Mayoril is about 27-28 crore a year. Today, in 2 years of time, this brand has been growing, and we have been eyeing 90 crore plus as far as this financial year is concerned. So we have multifold grown in terms of value. And as far as gross margin is concerned, we can improvise about 800 basis point of the gross margin also. Because we don't have any big brand in the pain management, and Mauril is a perfect fitment to us in the pain management, which has given us a good entry in the market of pain management. We have acquired that brand and given a justice to that brand. Yes, moving forward, we are eyeing on the brands which has been in a fitment to us from the multinational or from the other companies. We are open to acquire brands in our kitty.
Okay. Mr. Mehta, you indicated that 800 basis points gross margin expansion can happen. This is specifically for this particular brand. And are you expecting this similar 3 times growth in revenues that you saw for this one?
So as far as revenue growth is concerned, it's a huge market of pain management. But, you know, in the 2 years of time, we have grown by 3 times. It's not necessarily been necessary that we will grow in the same pace. But yes, we are bullish on taking the market share in the pain management market, and we have make our strategies accordingly. As far as 800 basis point gross margin is concerned, I'm talking only with the Mauril and the group of Mauril, because we have added 2 new SKUs in Mauril, Mauril Plus and Mauril Max, which was not been launched at that given of time when Sanofi has handled this brand. So put together, we have gone for the increment of 800 basis point of gross margin in group of Mauril from FY23 to FY25.
Okay. Just explain to us, there's been a significant jump in terms of your margins. 15% is what you had recorded around in FY23. That's gone to 21% in FY25 and 21% in the latest quarter as well, thereabout. Is 20 to 21% now a sustainable figure for the company, or are we going to see some kind of, decline in that?
Yeah. So if you look at the pharmaceutical industry, it's a very predictable industry. In particularly, we have about 96.33% contribution out of the India pharma market. And in this market, if we grow on our volume, there are 3 levers of the growth: volume growth, price growth, and new introduction growth. If we continue to grow on the revenue growth, ultimately your employee cost and other SG&A cost has been going down and profitability gone up and PAT grown up. So this is the simplest model which our industry has been witnessing with many other peer group companies also, and we are on the same line. So by adding the people, by adding the geographies, by adding the products, today we have been we are number 1 company as far as volume growth is concerned. We are number 1 company as far as growth is concerned out of top 30 companies. And we are seeing very bright future as far as portfolio is concerned. Reason being, in the pharmaceutical industry, 3 things is very important. Number 1, are you in the right industries? Yes, we are. Number 2, are you in the right therapies? So our therapies are growing little better than the industry. I'm talking about women's healthcare, cardiometabolic, pain management, and urology. Okay. And third, how is your execution philosophy? So our execution philosophy gives us the confidence that in the days to come also we'll try to deliver the good results.
Okay, Mr. Mehta, thank you so much for explaining that business structure to us and the outlook on growth going forward as well. We'll have a conversation again when the IPO opens and when you list as well, so that you can speak freely about future projections as well. It was a pleasure speaking with you. That's the word coming in from this new kid on the block, Corona Remedies. But for now, we'll slip into a short break. When we come back, we'll connect with Jignanshu Gaur, who's the Director and Senior Research Analyst at Bernstein, decode what's ailing Trends Growth that is on our radar today. Welcome back. You're still tuned into Halftime Report. Let's talk about retail sector. A recent Bernstein report suggests Trend's store network over-densification seems a key reason for sales growth drop. They add that company's revenue growth now is at the bottom. We are now joined by Jignanshu Gaur, who's the director and senior research analyst at Bernstein. Jignanshu, good afternoon. Thank you so much for joining in. Well, what makes you think that growth is at the bottom for Trend from here on? What are the factors that are indicating that this would be the case?
Thank you so much for having me. It's always a pleasure. We look at 4 reasons why we believe Trend's revenue growth has disappointed over the last 6-7 quarters, and it has fallen from the highs of 50% to close to 16% in the last quarter. And we believe those four factors are sort of at their peak right now. Factor number 1 being the densification of stores. They added a lot of stores, all back-ended towards fourth quarter of last year. Many of them were in the same pin codes where they had existing Zudio stores, and most of them rather, in the same cities where they had Zudio stores. So this impacted existing stores plus reduced the runway for ramp up of new stores, and hence has been a key contributing factor to their revenue growth disappointing, coupled with an element of broader urban consumption slowdown, because we believe most other players who are focused on metro and tier 1 cities have also grown slower than some of the players who are focused on tier 3, tier 4 cities, where the consumption slowdown seems to be relatively better than here. We think both of those large key points are at a peak today. So going forward, the base scenario, the base impact plus the underlying scenario for Trend should be better than what it is today. And hence we pencil in a slight improvement in growth in H2 versus H1. However, we are still under consensus numbers for Trend, but we believe the price indicates even a scenario which is worse than our numbers, which is why we remain constructive on the name broadly.
Jignanshu, if in case you are penciling in the second half growth, can you just tell us what they did in the first half? How much are you expecting in terms of growth in the second half, as well as what the margin performance will be based on what you're expecting, say, when it comes to competition, as well as the densification that you spoke about?
Sure. See, first half growth was approximately 17% YOY for them, 19% and 17 and 16% in quarter 2. We pencil in a full year growth of 19%, which means the second half number should be around 21 odd percent. Festive is a better season for them, so that will help. And then the base effect of last year, where a lot of these stores came into Q3 and Q4, should support the growth as well. So if we pencil in 20-21% growth for H2 of this year. Margin wise, we expect the margin to remain stable. Trend has improved its margin significantly over the last 6 quarters, despite revenue growth rate falling. We believe many of these changes, or rather most of these changes, are structural in nature, led by improvement in employee cost as a percentage of revenue by deployment of technology, as well as other expenses as percentage of revenue. And hence we expect the margin to remain largely stable. We forecast a 14% EBITDA margin for the company for this year, which will be 150 to 200 bips higher than what they did in last year.
Okay,
so better margins, but stable.
Okay, stable margins, but growth bottoming out from these levels. So decent outlook on Trend from here on. Jignanshu, that's about a specific stock, that's Trend. Let's talk about Swiggy as well now. The fundraise, that's a huge one, 10,000 crore rupees. What do you make of it? Do you think the company needs that amount of money for growth purposes? What's your take on this entire exercise?
See, we believe that the quick commerce space is going through significant competitive intensity again. This was the similar scenario in Q2 and Q3 of last year, and the same scenario today. We don't expect 2026 intensity to be lower in any scenario. If you want to be one of the top 2 or 3 players in the market, companies are going to need growth capital. And while food delivery is a net cash flow positive business for Swiggy, as it is for Eternal. We do believe they will need capital to invest, both in terms of capex, but more importantly, in terms of loss funding.
So it'll
And
be
that
for
is
existing verticals for them, or do you think it'll be used for newer verticals? Just trying to understand, because their growth in, say, quick commerce or food delivery has been decent. So do you think it'll be done to accelerate growth there, or look at new avenues?
I would expect a large part of this, at least over the next 12 months, would be for solving the quick commerce business. When I say solving, they need to solve for two things. For the current dark stores, they need to solve for profitability, and they need to bring growth back in terms of their dark store network, which has sort of fallen materially over the last 2 quarters. And that has been a concept, a proper strategy by them, because they had to balance profitability and cash. So we think it will be largely for quick commerce business. That is what I believe they should be solving for.
Okay. The new labor laws, what is the impact according to you on e-commerce companies?
See, it's still very unclear on what exactly rules the labor laws will take. Even the code which came out mentions a very wide range of 1 to 2% of revenue, and that's like 100% difference. But if we take some broad assumptions, we expect the impact to be 2 to 3 rupees per order, which is material if you assume that they will not be able to diffuse this cost in two big ways. One way is they already spend a lot of money on health, accident, maternity, etc. insurances for their existing gig economy workers, so that they can offset once they start giving this money to a common government controlled fund. Second, whatever is remaining impact can possibly be passed on to either some of the ecosystem players or eventually the customer. Will this impact demand? It might. There is always some demand elasticity, but we don't expect a material derating of the companies in any shape or form because of this.
Okay, all right. Well, we're going to let you go on that note. Thanks very much for joining in and speaking with us about the consumer space. So Bernstein talking about stocks specifically, such as Trent, where they have a target price of around 5,000 odd rupees. They are expecting a pickup in the second half, and they don't see much of an impact on the change in labor laws on e-commerce companies in the long term. We'll take a short break with the news that the markets are weak, so good time to get a technical check. We have Pritesh Mehta of Yes Securities joining in next. Stay tuned. Welcome back. Well, let's get talking about the technicals of the market. Pritesh Mehta joins in to discuss what he's strategizing today. Pritesh, well, it's a dull day, it's a weak day. We've spoken about the rupee weakness already. So how are you approaching today's trading session?
Yeah, good afternoon. Now, see, I believe that this move is more about profit booking rather than changing structure. So far, we've seen 4 days of decline. If you include today's day, we have seen a drop of 400 points from the peak. So I think it does not provide, overall dent in the structures for the index. But we have been following the equal top 10 Nifty index because it commands 50% of the Nifty's weight. And what we have seen that in the month, last week, it surpassed the peak of June 2025. And thereafter, it has seen a reversal. Similar such reversal is seen even the customer's breadth. So when both these aspects are moving in one direction, that is on the downside, we can see a bit of cooling off. And this is what we are witnessing right now. So I won't be surprised that Nifty can retrace a bit lower. It can go back to 25,800 also from here on. So I think this is more of profit booking rather than a large term reversal.
Okay, there is some recovery from the lows though, and that is something which will be key to track after that fall that we've seen. Pritesh, any individual names that you have for trade?
Yes, we like auto space. From the space, Ashok Leyland standouts for us. So basically, the stock, in the month of November was one of the best movers, did well. Now, it was followed by a bit of a shallow retracement, but it's quick to recover. What we are witnessing is the anchor column follow through coming in. So buy Ashok for a target of 185. The stop would be around 152. The second stock that we buy is Max Financial. Now see, this particular stock is outperforming our customer insurance index. When we look at the standalone chart, we can see bullish data breakout coming in after bullish anchor column. So after a bit of consolidation, the stock is moving higher again. It's resuming its uptrend. So buy for a target of 1900. The stop would be around 1570.
Okay, all right. We're going to let you go on that note. Thanks very much. Let's go across to Manglam now. He joins in with a setup on what he's tracking on the F&O space this afternoon. Manglam, over to you.
Well, there has been a recovery from the lows on the Nifty. Yes, we're still lower. We're below that 26,000 mark, but closing in around that 25,950 thereabouts. So that recovery has been led by a couple of these private sector banks. So the Nifty Bank, as a result of which, has seen a mild amount of recovery from the lows as well. At one point, the Nifty and the Nifty Bank were seeing cuts of almost 0.5%, and now they've curtailed those losses to about 1/3%. The mid-cap index, however, is still under pressure, and that's reflected in the advanced decline ratio as well. Almost 2,000 stocks in the red for just about 700-800 in the green right now. So the lines are still far and wide apart, with the red one being much above the green one. What's interesting, however, is the Nifty's declines are curtailed by 2 factors. One, the IT index is doing extremely well. So the IT sector has a fair weight. And the second part is now, some of these private banks like ICICI and Axis Bank are supporting the cause of the Nifty, which is why the losses are cut less than 100 points. That's a positive. However, the one thing I'll be watching out for, which is an impact of the rupee, and as a result of which an inverse correlation with the bond yields, and that could have an impact on the mark-to-market losses of all these PSU banks' bond portfolios, which is why we're seeing a sharp sell-off in names like PNB, Indian Bank, Bank of Baroda, as well as Canara Bank. So how the rupee moves would have an impact on some of these PSU banks as well. So that's something we will be monitoring. The Nifty, after having recovered from the lows, has now gone back above that 20-day moving average. Closing above that would be extremely crucial. So would be the case for the Nifty Bank. And finally, just a couple of options that I'm watching out for. 26,000 call, extremely well written. So these are calls that have a premium for almost 120 rupees. So above 26,100 to around 26,120, there is some supply which is expected. But at the lower levels, there is support which has moved higher. So 25,900 put has been fairly well written as well. And that has a premium of almost 100 rupees. So 25,800 to 25,900 is where the support is. A couple of stocks that I'm watching out for which have seen some open interest action. A lot of long positions added on Biocon, so pharmaceutical and IT doing better on account of weakness in rupee. And a lot of short covering in Vodafone Idea, which continues to do well on hopes of some sort of relief coming in from the regulators.
3.5% higher on that one, and what happens with the rupee at 90.29 currently, that remains to be seen. Thank you, Mangla, for joining us with all those F&O trends. It's time for another break now. On the other side, Manisha Gupta will join in with Surendra Mehta. He's the Secretary, India Bullion and Jewelers Association. Stay tuned for that.
Welcome back, and joining us on the show now is Surendra Mehta. He's Secretary, India Bullion and Jewellers Association. Mr. Mehta, hi, thank you so much for joining in. And this is about IBJA putting out a self-regulation when it comes to the digital gold companies there. We do understand after SEBI's warning, a lot of these companies had also approached the regulator to, in some sense, start regulating. But that clearly seems to be a bit delayed, the work being done on that or not. But IBJA taking this step, how does it augur well for many of these companies?
Well, we have, when the SEBI issued the caution, we requested SEBI to regulate these digital gold companies. See, most of these digital gold companies are very top companies, very big companies, and with a huge net worth available in their balance sheet, and they have nothing to hide. So we requested SEBI to regulate them. But definitely, I think SEBI will not like to regulate it. So in the meantime, all these top companies have approached IBJA, and we have voluntarily decided that we will set the rules for the digital companies. Whosoever want to join us, digital companies, whosoever want to join us, they can join us. We will set the entire framework for the digital gold companies regarding purity standards, vaulting, how the payment is to be collected, how taxes are to be paid, how auditing is to be done, whether auditing is required with the industry experienced auditor or not. So there are so many things to it. So we have decided that we will take this further. And initially, we will be calling the consultation meeting for all the digital gold players. But we would be strictly following the rules as decided in the digital gold consultation meeting.
Mr. Mehta, how many companies are there? I'm assuming there are very few service providers and then everybody else partners with them. So how many companies are we looking at in sense of service providers, and what is your sense on what is the number or quantum of these companies meeting the end consumer there?
You rightly said there are many intermediaries who are actually collecting digital gold money on behalf of the primary companies. So according to us, this primary companies number will not exceed even 12 or 13. But we will be regulating not only primary gold, digital gold companies, but also these intermediaries. And many of these intermediaries have also approached us because we want to ensure that this intermediary, whatever payment they collect, it goes to the primary digital gold companies.
Mr. Mehta, also, what is the quantum of the overall market right now? We do understand that the base is low, but the growth has been quite higher. And in the last couple of months, since the SEBI warning, we've seen the number kind of decline. What is it that we're looking at in sense of overall market share for this one?
Well, honestly, the actual numbers are not available, and we are trying to find out what is the actual number now. But honestly, there are many proprietorship and partnership firms also doing the digital gold business, and we do not encourage such practice, and we would definitely keep them out of our regulatory framework. In my opinion, if I take out this partnership and proprietorship firms, and only look at the top companies, I think that the overall market size does not exceed 20 tons.
20 tons.
Yes.
Since you are with us, Mr. Mehta, what is also your sense on the kind of gold imports that we've seen in this year, and your sense on prices also?
Well, gold imports, that is really, the numbers are really shocking at the prices at which the gold import is being done. And in my opinion, there is a lot of stocking happening by the jewelers themselves, on the presumption that there would be a very good wedding season and festival season ahead. But in my opinion, I think the government needs to do something, because if the bank's working capital are being used for stocking of the gold, it doesn't, and if the USD INR goes above 90, then it is really a cause of concern.
Okay, all right, Mr. Mehta and Manisha, thank you so much for joining in today and taking us through this conversation. So important to track what happens with gold demand, pricing, and various ways of investing into gold as well. With that, we'll slip into a short break. When we come back, we'll connect with Mahendra Kumar Jaju of Mirae Asset Investment Managers. The rupee has breached that 90 per dollar mark. So what happens next? We'll discuss with him.
Welcome back. Well, the rupee fall does continue. In fact, it's hit a fresh record low in today's trading session. It's crossed that key critical 90-odd mark in terms of the rupee. And as you can see, 90.25, 3 consecutive days of losses or depreciation that we've seen for the rupee. But we do have Mahindra Kumar Jaju, CIO, Fixed Income Mirai Asset Investment Managers, joining in to discuss his take on the rupee. Well, thanks very much, Mahindra, for joining in. We've crossed all of these critical levels that many of the technical and fundamental experts have been discussing will possibly be hit, by the end of the year or maybe going into next year as well. Where do you think the rupee is possibly going to stabilize at? And do you think that there's a further fall in place?
So at this point, the direction is clearly for the rupee to depreciate further. 90, just a number. The momentum is towards depreciation of rupee. At this point, we have a very, very strong domestic macro, but our global macro seems to be a little bit of a concern right now. We have a slowing export, and because of the domestic consumption story, we have swelling imports. So that is affecting our current account deficit, which is expected to comfortably breach 1% mark in the current year. We have very delicate situation on the trade deal front. There is no clarity as of now. While there is hope, but there is no outline of what the deal might be, and it is beginning to affect our competitiveness on the export side. And then we have seen consistent outflow from the FPIs, because in the current year, the markets like Korea or Japan have done well, and therefore the global investors have been allocating to those markets. And finally, we have seen some of the currencies in the, for example, Latin American countries like Brazil and Mexico, they have done 10% plus appreciation on the dollar. So I think as a cumulative impact of all this, rupee is under pressure. And when everyone realizes, I think the momentum obviously takes the movement much faster, and the targets are easily breached. So I think today is one of those days when the entire force is against the rupee.
So do you think, Mahindra, that will continue? What kind of levels are you watching out for, say, in the next 3 to 6 months? And when you said it's allowed to depreciate, you don't see any intervention coming in from the RBI in terms of using, foreign exchange reserves, other methods?
We have a very, very strong forex reserve situation. However, the rupee is weakening in line with the fundamentals, so to say. In the last year, in 2024, the rupee was amongst the best performing currencies in the second half of 2024, but then that took its toll on the domestic economy. So we have seen at the beginning of this year, RBI switching the gear, and RBI instituted a very, very accommodative monetary policy. They cut the policy rate by 100 basis points during this year. They cut the CRR by 125 basis points. They did the open market purchases of bonds of about 2.5 lakh crores, and that then gave the momentum back to the domestic economy. And we are now, seeing this kind of a growth momentum. At the same time, rupee suffered. So I think at this point, the Reserve Bank is more focused on calibrating and moderating the volatility in the rupee movement, but I don't think there is any clear guidance or indication as to whether or not they allow or accept this depreciation. So we will know, but I don't think that there will be any meaningful intervention to change the direction, but obviously to moderate and smoothen the volatility, there will be periodic interventions.
Okay, periodic interventions to smoothen the volatility. Well, thanks very much, Mahindra, for joining in and speaking with us about the rupee depreciation. Around a 4.5% depreciation in the rupee is what we've seen in 2025 already, and over 1% odd in just the past month. We'll take a short break, but get you more on the markets on the other side. Stay tuned.
Welcome back. It's a 100-point downtick on the Nifty. There was some recovery, but that has been sold into. But Bank Nifty is the one which you should be keeping on your radar. Yes, 200 points lower, but it has recovered around 160 points from the day's low. Axis Bank, HDFC Bank and ICICI Bank, these are the stocks which have recovered from the lows and batting it from the lows of the day as well. At the day's high, almost all of them. So we'll keep tracking market moves for you and what happens with the rupee as well. For now, we'll take your leave on this edition of Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
Stocks see broad-based selling as the rupee weakens but is off the lows of the day. The declines, however, far outnumber the advances. Some rupee sensitives like IT stocks gain while utilities, energy, industrials and autos slide.
The rupee breaches the 90 mark against the dollar on tight dollar supply and a delay in clinching the US trade deal. While importers and those with overseas leverage brace for impact, companies with sizable exports like Bajaj Auto cheer the gradual decline.
Meesho's 2,400 crore rupee anchor offer draws a rush of investors, but high allotment to a local fund miffs some of them who walk away. Even as its IPO opens to the public today, the founders promise that they'll engage with the investors and build new revenue streams to create shareholder wealth.
Asian Paints MD and CEO Amit Singhal expects double-digit growth in the coming quarters with market share gains amid increased competition. He also aims for sales of 50,000 crore rupees in 4 years with a promise of strong shareholder returns.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia, with me Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon.
It's been it's been that kind of a day, right, for the markets. At least they're trying to defend that 25,900 mark on the downside. We slipped below it, made an intraday low of 25,891. And since then, we've been meandering around this 25,930, 25,950 zones. And leading the charge down has been the PSU banks. It's been a dual blow for them. But we'll talk about that as the show goes on. But there are some pockets that you wanted to speak about as well.
Absolutely. Like you pointed out, there's been broad-based selling across Nifty, Sensex, and the mid-cap index actually faring worse than both the Nifty and Sensex. But there was some, specs where we could see some green. It was those IT stocks that are faring better than everyone else, bucking the trend. If you see Wipro, TCS and Infosys, all of them gaining between 1 and 2%. We're also seeing some recovery in big banking names like ICICI Bank and Axis Bank as well, Hormaz.
So, they are the ones that are ensuring that the Nifty doesn't slip further, right? TCS and Infosys that they are. But yes, the IT sensitives, as Arundhati was just mentioning, the rupee sensitives, the IT stocks. But now it costs 90 rupees 25 paise to buy a dollar. Now, the Indian rupee has taken a sharp knock yet again today. There's a 0.5% fall in the face of incessant dollar buying by foreign funds. The RBI was reported to be selling dollars through PSU banks, but in limited quantities. Lata is now here with more on today's fall. Lata.
Yes, dollars high today was, I believe, 90.29. And nothing to say that it won't get more expensive. The reason has been what it has been for some time now. The persistent selling by foreign funds, if you looked at the numbers only for December 1 and 2, it's already over $500 million. So expectation is that they're not going to stop selling anytime soon. The position of the dollar-rupee exchange rate much depends on how the Reserve Bank is behaving. What dealers tell us is that they are supplying dollars through what they call agent banks, basically PSU banks, but they're not trying to support any level or stop the dollar rise at any point. They're just supplying enough to ensure that the volatility is not too sharp. And that perhaps is making importers come in and buy, because people were mostly betting that the dollar won't go above 90 rupees. So now there are quite clearly some positions that whenever there's a spike like this, importers run in to buy, but exporters don't sell immediately because there's always a feeling that you may get a little more. The market is now convinced that the Reserve Bank is wantonly allowing or having a hands-off approach or a slightly hands-off approach, because a cheaper rupee or an expensive dollar corrects the distortion by itself, because your exports will become cheaper and therefore your export kitty grows and imports will become expensive. So that also reduces the trade deficit on its own. With today's move, of course, it's over 2% fall in just 2 weeks. That is from November 18th, the day on which the October trade deficit was announced. So clearly that looks like the number that has sparked the fall. I just want to leave you with one thought, that we tend to speak about a rupee fall in kind of depressed notes, like a stock market fall. No, it is not. It also not just benefits exporters like IT stocks, it benefits the entire economy, because imports become cheap. It is easier for an Indian toy maker or a textile maker to beat the Chinese import, in all these categories when the rupee is cheaper. So it's actually not bad for the economy. We must get that straight in terms of, the impact of a rupee fall.
All right, Lata, many thanks for taking us through those details. And in fact, earlier today, we spoke to former MPC member and economist Ashima Goyal and V. Lakshmanan of Federal Bank as the rupee fell 5% to fresh record lows of 90.14 against the dollar in the backdrop for an RBI policy due on Friday. Let's listen in to what they had to say.
The RBI has, of course, never really
brought in currency as a core factor in its monetary policy statement dissemination. A side eye would always be there. To which extent the policy will definitely take cognizance of that, and to which extent a rate outcome that's going to come later this week will definitely be looked into. Having said so, in as much as we as bankers may wish a commentary on the currency to be brought out, I would state that yes, the fact that the rupee has weakened above 90 would be noted, but the policy statement would clearly again hinge upon the broader parameters of inflation and growth in the wider statement that's going to come by. And that is, I think, is going to be the way the statement is going to be worded to the specific question you asked.
For a long time, RBI's policy has been to prevent excess volatility and persistent real misalignments. So I think they still come in when it is getting too far away from equilibrium. So, and this regime is working. They have reserves and other ways of intervention. So the interest rate is not tied to the rupee. The interest rate has to respond to domestic inflation and growth. I don't think there is any sort of major financial stability concern here. I think that it is very important that the RBI indicates to the market that they are there to prevent excess volatility.
So now how does this fall in the currency have the sectors across the board? Sudarshan is here with more details on this. Sudarshan.
So equity market has been under pressure over the last 2 or 3 days, but it's the currency market which has stolen the limelight, and the main reason the fall in the rupee we have seen today, it has hit the record low of 90.29 against a dollar. So we have tried to find out which all sectors might benefit or which all sectors might have a negative impact. So first and top of the list is the IT sector, which is going to be impacted positively because most of the companies from these sectors have a huge exposure to the US and they generate revenue in the dollar. So any fall in the rupee is largely seen as positive for IT sector. Second comes as the pharma sector. It has a limited impact because most of the companies hedge their dollar exposure. But one negative factor is that because of the rupee's fall, input costs see a sharp rise, and for most of the pharma companies, 40 to 60% of total costs are contributed for inputs, and that's the reason it might be a bit negative. For the auto sectors, amongst two-wheelers, two of the biggest beneficiaries are TVS Motor and Bajaj Auto. For TVS Motor, of total volumes, 30% comes from exports, and of total revenue, almost 25 to 26% comes from the export. For Bajaj Auto, almost 50% of total revenue comes from the exports, and in Q2, dollar realization was 87.1. So I've done a calculation. In Q3, dollar realization has increased to 89. And while talking to CNBC-TV18, company has said if there is a fall of rupee 1 against dollar, annualized EBITDA increased by rupees 200 crores. So we'll do the calculation and get to know that there is a benefit in the range of 350 to 400 crore in the annualized EBITDA for Bajaj Auto. In the auto ancillaries, I have taken 3 names: Bharat Forge, Samvardhana Motherson and Uno Minda. For Samvardhana Motherson, it's marginal positive because almost 60 to 70% of their revenue comes from exports, but they have manufacturing base over there, and because of that, costs rise as well. That's the reason it's marginal positive. For Bharat Forge, almost 70% of their revenue are from the export segment, and it's hugely positive because they have the majorly 3 segments. One is Class 8, then they have PV EV components, and one they have the high margin business, that's the forging business. And because of the fall in rupee, their revenue will see a significant increase. While for Uno Minda, it's negative because they are largely a domestic based revenue. 70% of revenue comes from domestic segment. Now coming to the oil and gas sector, for ONGC and Oil India, rupee 1 depreciation improves EPS by 1 to 2%. For Reliance, it's a mixed impact. For city gas companies, it's negative. And lastly, for chemical sector, it's hugely positive for majority of the companies.
All right, Sudarshan, many thanks for taking us through those details. Earlier today, we spoke to Rakesh Sharma, the executive director of Bajaj Auto, on the impact of the rupee fall on their business. Listen in to what he had to say.
You know, the softly devaluing rupee is very beneficial, as you said.
to a company like ours, which has got almost 50% of its revenue coming from international sources. So it's very, very helpful. Well, on an annualized basis, every 1 rupee creates a EBITDA impact of 200 crores plus, because our exports are over $2 billion.
Let's also now get you some updates on the Vodafone Idea AGR relief issue. Sources are telling CNBC-TV18 that the Cabinet Secretary has called for a meeting with the Finance and Telecom Secretaries tomorrow afternoon, which will take place at around 3 p.m. Remember, the Telecom Minister had told CNBC-TV18 that a relief package for the company could be proposed by the end of the year. Vodafone Idea currently around 3.5% higher at 10.5, still below that FPO price of 11 rupees.
On that note, it is time for us to slip into a short break. But before we go, here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Business Lunch. Meesho's 5,421 crore rupee IPO has opened today, with the retail portion fully subscribed within 1 hour of opening. The IPO comprises of 4,250 crore rupees of fresh issue and a 1,171 crore rupee offer for sale. The price band is fixed at 105 to 111 rupees a piece. Earlier, we spoke to the management of the company to understand their outlook. Take a look.
We as a company look at free cash flow as the right bottom line metric. Any company textbook definition of valuation is the net present value of all your future cash flows. And as a company, we've been the most capital efficient asset light company, right? Like, to kind of reach a lot of milestones in our business, we've actually spent the least amount of money as compared to many other e-commerce companies in India. And we take pride in that. We continue to kind of optimize for free cash flow. If you look at the last 2 financial years, we have been positive on free cash flow. For the last financial year 25, we generated almost 1,000 crores of cash. And even forward, I think we will continue to kind of keep looking at that while doing capital allocation within the company.
If you look at the use of proceeds, we are raising these for the next 3 years. I think that is our estimate of what is the spend going to be in some of these headers for the next 3 years. And if you look at the historical trends, as we have grown consistently, some of our fixed cost base, such as our server infrastructure and other kind of fixed cost line items, including employee cost as well, have not grown at the same path or at the same pace as our overall top line growth has been. So operating leverage is a key metric that we would kind of keep tracking. Our fixed cost base, let's say historically, the server cost grew by only 4.5% when we grew at about 35%. And we'll keep maintaining that going forward as well.
70% the overall subscription of the Meesho IPO so far on its first day. The retail portion, as Arundhati was highlighting, fully subscribed, and current subscription figures at around 2.5 times already. Now, moving on to the widely discussed Sanchar Sathi app. According to recent developments, the Telecom Minister Jyotiraditya Scindia told the Lok Sabha that they will make changes on the basis of feedback from users. Listen to what he had to say.
ऐप फोन पे है, इसका मतलब नहीं है कि वो ऑटोमेटिकली ऑपरेट हो जाएगा। जब तक मैं उपभोक्ता के रूप में उसमें रजिस्टर ना करूं, तब तक वो ऑपरेट नहीं होगा। और मैं उपभोक्ता के आधार पर, जैसे मेरे फोन पर सर ढेर सारे ऐप्स होते हैं, मैं उस ऐप को भी दबा के मैं डिलीट कर सकता हूं। तो ये लोकतंत्र में पूर्ण हक और अधिकार नागरिक का है सर। हम लोग ने केवल ये ऐप सभी को उपलब्ध कराने के लिए कदम लिया है। लेकिन फिर भी मैं सदन के पटल पे भी कहना चाहता हूं, हमारा कोई हट नहीं। इसकी सफलता का प्रयोग जनता के आधार पर हुआ है। फीडबैक हमें मिलेगा, उस फीडबैक के आधार पर अगर उस ऑर्डर में भी हम लोगों को कोई चेंज लाना है, उसके लिए भी हम लोग तैयार हैं।
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Welcome back. Now all eyes will be on Russian President Vladimir Putin, who will be on a two-day visit to India starting tomorrow. We have Parikshit, who is joining in to give us a lowdown on what to expect from this trip. Parikshit.
Well, this is the 23rd India-Russia Annual Summit. The entire bilateral partnership between the two countries will be up for discussion and review between tomorrow and day after. What we're also picking up, that this time, the big focus will be on broadening the economic partnership between the two countries. Both sides will be discussing an FTA. Will it be signed during this visit of President Putin? Very unlikely. But yes, there is a plan to sign an FTA sometime in future if the negotiations are concluded and it is mutually acceptable to both sides as well. Both sides will be speaking about expanding the bilateral trade in a sustainable manner. There will be a package of outcomes that this visit could really yield, and this would include MOUs, agreements on economic cooperation, trade facilitation, maritime cooperation, healthcare, science and technology, education as well. One of the highlights would be an MOU on migration and mobility of skilled professionals from India to Russia. Now, we've seen the movement of many Indians via illegal routes or being caught up in scams and landing up fighting for the Russian army or being involved in services linked to the Russian army. We want to avoid that and give a legal way for migration and mobility of skilled professionals. We will also see discussions being held to improve connectivity between the two countries, and this could be via the Chennai-Vladivostok route or the Northern Sea route as well. India will also seek long-term and stable supplies of fertilizers from Russia. Now, this is a very critical partnership in terms of a fertilizer supply chain, and we would like to have long-term supplies coming in from there as well. In terms of defense, this is a major area of focus between the two countries. But considering that the United States is pushing us right now to buy F-35 fifth-generation fighter jets, it is unlikely that any major aircraft deal could be signed during this visit, but upgrades, maintenance of the Sukhois, maintenance of the current weapon platforms, buying missiles for the current Russian origin defense platforms that India uses, all of that could be up for discussion. We would also discuss opportunities for co-production and co-development of defense platforms, including exports to third countries of the BrahMos as well. Now, the bilateral trade between India and Russia had reached $68.7 billion by FY25. Things are skewed in Russia's favor. For example, India's exports were just about 4.8 billion. We imported 63.8 billion worth of goods from Russia, and this is primarily because of imports of oil and gas from Russia. We would like to bridge this trade deficit and push exports of pharmaceutical items, agriculture and textiles. So these three items will figure in discussions between Prime Minister Modi and President Putin over the next 2 days.
So Putin's visit to India, two-day visit to India, begins tomorrow. Parikshit, thank you so much for taking us through those details. Now, after weeks of turmoil over a US-backed peace plan, the high-stakes Kremlin meeting has now concluded. Russian President Vladimir Putin held nearly 5 hours of closed-door talks with US President Donald Trump's special envoy Steve Witkoff and presidential advisor Jared Kushner. Washington is pushing to salvage a potential deal to end the almost 4-year war in Ukraine, and the completion of these talks marks one of the most significant US-Russia engagements since the conflict began. The meeting wraps up amid fresh warnings from Moscow to European nations, deepening concerns in Kiev and across Europe about where negotiations are headed. Kremlin foreign policy aide Yuri Ushakov briefed reporters after the talks, calling it a useful discussion, but acknowledging that they are no closer to resolving the crisis in Ukraine and that there is much work to be done.
All eyes on the Fed meeting and all eyes on Vladimir Putin's visit. But shifting focus to the Fed meeting, US President Donald Trump has announced plans to reveal his choice for the next Fed chair in early 2026. He also hinted that National Economic Council Director Kevin Hassett has a potential candidate. Listen.
I want to thank you all for being here. It's a great group. And I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin.
And with that, it is a wrap on this edition of Business Lunch. Mid-Cap Radar comes up next.
Afternoon, welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. The story continues to remain the same. The rupee depreciation, falling markets, broader market weakness, and no respite it can be seen so far. Yes, there was some recovery, but that was sold into as well. So remains to be seen whether there is some recovery on the cards or we'll continue to see this fall.
That's right. Good afternoon, Sonal. There was a brief respite that we saw, but that quickly got sold into markets. Once again, continue to witness selling pressure. The market breadth, especially in the broader end of the market, is quite weak. We have a lot lined up on the show, so let's start off with the top headlines. First up, what we're tracking today is stocks see broad-way selling as the rupee weakens, but is off the day's low. Declines, however, far outnumber advances. Some rupee sensitives like ITs gain, while utilities, energy, industrials, and autos slide.
PSU Bank slip in trade with shares of Indian Bank and PNB down up to 6% after Finance Ministry in a written reply in the Parliament says that there is no proposal to increase FDI limit in banks to 49%.
Bharat Forge under pressure after reporting a decline in Class 8 truck sales, both on a year-on-year as well as on a month-on-month basis. Total sales in November have fallen 44% YOY.
Angel One slumps on a very weak business update as market share and client acquisition both slip in November. Average daily orders fall over 15% on a YOY basis. Okay, all right, those are the top headlines. But one of the gainers in the broader market has to be Vodafone Idea. It is in focus amid its AGR dues case. Timsi Jaipuria is joining us with the latest on the developments. Timsi, what are you picking up?
Well, that's right. What sources are indicating to us is that the Cabinet Secretary is going to hold a detailed meeting tomorrow around 3 p.m. in the afternoon with Finance Secretaries and Telecom Secretary on the Vodafone AGR matter and trying to come up with an alternative or a package that could be on the radar. But precursor to this tomorrow's meeting, today again, there's going to be an internal meeting in the Finance Ministry where DOT Secretary, that is the Telecom Secretary, is likely to be present, again discussing on the same matter. So today's meeting as a precursor to tomorrow's meeting, let's see what happens finally in these two meetings. Does government come up with a fresh package or a proposal on these dues? Something that we'll have to wait and watch for. But as of now, two power pack meetings slated in the government.
Well, thank you so much, Timsi, for joining us, and I'm sure you'll keep track of both of these meetings as they unfold. Moving on, this is our special segment, Midcap Movers. Sudarshan is standing by the wall to take us through all of the midcaps that are moving around in the session.
So I'll start with the PSU banks. Whole host of PSU banks are under pressure in today's trade, and there are two reasons to it. 2 days, 2 news. First, government had responded to the query related to the merger. Government said there is no such plan. And second, government has said that they have not approved any proposal related to an increase in FDI limit from 20% to 49%. And tracking both these developments, you are seeing a sharp fall in PSU bank. On top of the list is Indian Bank, which had seen a sharp surge in the last few months. That is down 6%, PNB down 4%, Canada Bank, Bank of India, all these stocks are down in the range of 3 to 5%. Even if you take a look in the Nifty also, SBI is also trading with a cut of almost 2 to 3%. Second, AGR relief. Now, you had heard 2 days ago Telecom Minister talking about that by the end of this month or say by 2025, and there will be an update on Vodafone Idea relief package that Supreme Court had given the ruling last month. Now, today also there is a latest update regarding that. Important secretaries, finance secretaries and other secretaries are meeting today and tomorrow to decide on the same issue. And tracking those developments, you are seeing Vodafone Idea is one of the top mid-cap gainers despite overall market is under pressure. Even Indus Towers is seeing a rub-off impact. Bharti Hexacom too is seeing a rub-off impact. But Telecom Minister had said that this case is only related to Vodafone Idea. Some of the other mid-cap losers, Thyrocare is under pressure, down 6%. And the reason is that promoter has announced that the shares that they have got in the form of bonus, now they are creating pledge on those shares, and tracking that development, the stock has fallen sharply. Wockhardt and HCC are seeing profit booking after a big up move that both these stocks had seen over the last 2 days. And last one is Ola Electric. The same story. This company has been reporting a decline in the sales each month for the last few months considerably. And its market share has fallen sharply. In the month of November, its market share was just 7%. On the back of that, this stock is under pressure as well.
Okay, thank you so much, Sudarshan, for joining us with those mid-caps which are in focus. By the way, something like a Root Mobile is also higher in trade as we speak. Sonata Software is the other one, which is up 5% in trade today. A lot of these IT names doing well. There's Hikal as well, which is up 11% in trade. And Capital India Finance, that stock is surging 10.5% higher there. Aztec Life Sciences, that has been a big mover in last week. And today as well, it is seeing some additional gains come by. So watching out for these names. A big surge in an otherwise weak market is what these stocks are suggesting. Let's get Aditya Agrawala, Head of Research and Investments, Invest for Edu Private Limited. Aditya, good afternoon. Where will this fall continue? Is there any support that that we should be watching out for? What are the charts suggesting?
Good afternoon, Sonal. Thanks for having the show. It's more of a consolidation, I would say, for the markets, not too perturbed by the fact that markets have corrected in last 3 trading sessions. On the downside, 25,900 to about 25,800 is an immediate support zone for the markets. My sense is markets won't break the support zone immediately. On the upside, 26,200, 300 continues to act as a hurdle. For the remaining part of the December month, though it's just the start of this expiry season for December series, I believe markets will remain in a range bound, and within this range between 26,300 on the upside and 25,800 on the downside, you will see heightened volatility in the markets. Usually that is the order if you take a look at historically every December month, because volumes start thinning as the month progresses, and you see volatility picking up in the month of December. Similar kind of a trend we'll witness this time around as well. On the Nifty at current levels, I think you could be seeing a bit of a short covering rally maybe in later half of the day today or maybe tomorrow from 25,800, 850 good support zones. You can again test levels of 2600 to about 26,100 on the upside. Bank Nifty is something which might just be a little bit under pressure because it has outperformed the Nifty 50. On the downside for Bank Nifty, 58,500, 58,800 continues to act as an immediate support zone. On the upside, 59,500 to about 60,000 will act as a hurdle. So Bank Nifty is something I think will take a bit of a backseat, while Nifty from here on can see a bit of a short covering rally maybe for today and tomorrow.
Well, clearly today the Bank Nifty has been dragging the markets much lower. But Aditya, what are your individual stock picks for the day?
So I've got a couple of buy recommendations for viewers. The first one is KPIT Tech. We are witnessing good buying in the IT space, both in the mid-cap and the large-cap names. And my sense is this will continue for this week and maybe next week as well. So KPIT is looking interesting for a target of 1350 on the upside with a stop loss at 1220 on the downside. The second one is Indus Tower. This is also one stock, Vivek, which has been making higher highs, higher lows. And today in trade, we witnessed a breakout from a consolidation zone. So my sense is this up move is likely to continue in Indus Tower as well. So for a target of 440 on the upside, I recommend a buy in Indus Tower and place a stop loss at 390 on the downside.
All right. Thank you so much for joining in, Aditya, with those individual names and market levels going forward. We'll slip into a break now. When we come back, we'll focus on a whole host of Nifty, PSU Bank and the index and Bharat Forge as well. Stay tuned.
Welcome back to Midcap Radar. Well, one sector that clearly is dragging the markets low today is the Nifty PSU space. All of the PSU banks today are under pressure. Ritu joins in with all of the details as to what exactly has kept the street disappointed.
Well, Vivek, you're right. There's been quite a bit of selling pressure in the large public sector bank stocks. You see the Nifty PSU index down by more than 3% on the back of news that the government is not considering, at least at the moment, any increase in the FDI limit for these PSU banks. Now, remember, earlier in October, there were reports that the government could hike the FDI limit for public sector banks, which is currently capped at 20%, all the way to 49% to bring them at par with private sector banks. On the back of that news, we'd seen quite a bit of rally coming in these PSU bank stocks. But now the government has made it very clear in its response to the parliament that no such proposal is on the table at the moment, which means the cap for these PSU banks, as far as FDI is concerned, remains at 20%. Now, keep in mind the overall FDI limit cap for Indian banks, as per the current norms, is 74%. But for private sector banks, under that, FDI is allowed up to 49%. And you have recent examples where large foreign players have come in the likes of RBL Bank and Yes Bank, which has helped support, some of the capital requirements of these banks. But even above that, up to 74% is what is allowed, of course, with the Government of India permission and RBI, for which you need permission for every incremental 5% stake. So the idea was that, public sector banks would be brought on par with private banks, but that does not seem to be the case. What is perhaps also adding to this negative sentiment is the fact that the government also clarified there is no proposal on the table as far as a merger of public sector banks is concerned. Again, that is something that the Finance Minister Nirmala Sitharaman told CNBC-TV18 at the SBI conclave earlier, that work was very much on. There would be consultation with the RBI to consider, merging the existing 12 public sector banks, to reduce or consolidate the sector, create larger entities. But that is also something that the government said is currently not on the table, which means, it is not something that the government is actively considering in the immediate future, which is why, now you're seeing all those hopes of larger FDI coming into PSU banks getting dashed, and the stock seeing some selling pressure. In terms of, the current foreign shareholding in some of these public sector banks, if you pull up the list, Canara Bank, SBI, Bank of Baroda, all of them already have about 11.98% foreign shareholding. So there is quite a bit of headroom to even go up to 20%. But remember, there's large public, government shareholding in the first place, and these banks also have to keep in mind that 25% minimum public shareholding norm. So that leaves little headroom to play with. But for now, it looks like all their hopes are dashed. There is no proposal to hike the FDI limit from 20% to 49%, at least for now.
Okay, all right. Thank you so much, Ritu, for explaining that to us, and explains the move that we are seeing on PSU banks as well. The other stock on our radar is Bharat Forge. It is under pressure on the back of muted November sales data. Sudarshan is back with us. There's some recovery from the lows, Sudarshan, but what did the numbers suggest?
That's correct. So while we were talking about that rupee fall can be a positive impact on Bharat Forge, but the latest update is that we have North America Class A truck orders for the industry, in which it suggests that total sales have seen a decline both on a month-on-month and YOY. On a monthly basis, decline is of 17%, and on a yearly basis, it's a decline of 44%. And total sales or total orders have come at 20,000 units, which is sharply lower even if you do the average of last 10 months, which comes around 28,910 units. Now, what's the reason for it? Even despite a certain clarity we have got about the tariff over the last few months, fleets have been just not basically declining the trend or replacement or the expansion plans, and that's one of the reasons that industry body believes that this is one of the reasons that we have seen a fall in the Class A truck orders, and because of that we are seeing a fall in the Bharat Forge stock.
That's right. Thank you so much, Sudarshan, for joining us and giving us a sense of what exactly is keeping the stock price of Bharat Forge subdued. Weak or very muted Class A truck orders is what is causing this particular downfall. But we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned in to Mid-Cap Radar. Well, the broader markets, they are under pressure, but one stock which is an outlier is DOMS Industries. It is gaining in trade, and this is after Antique has initiated coverage on the stock. It was up 5% at a point in time, has come up from the highs, but still it's a 4% gain on that. They've initiated coverage with a buy rating and target price of 3,250. They say that it is positioned for the next leg of growth, and it is poised to grow at a faster clip in the overall consumption category because there's capacity addition. They're looking at distribution expansion as well and strong innovation pipeline. Company has shown sales performance. Sales growth has been 24% in terms of CAGR for over FY20 to FY25, and it is expected to continue according to Antique going forward as well for the next 3 fiscal. Now, remember, the company is into stationery, pens, paper, something that is used across different segments. They are scaling up their growing categories, be it pen, be it paper, kids, combos as well that you'll see in different distribution centers. They're expanding their presence in adjacent categories, something like bags and toys. So they are trying to cater to that market, and they are looking at acquisitions as well. They did with Uniqlan, which is for baby hygiene, and Super Treads, which is for paper. They are focusing on profitable portfolio expansion, and this is something which could lead to growth going forward. And that is what Antique is very positive about. And hence this initiating coverage, which is on the back of adjacent categories, which could support growth for DOMS going forward.
Well, one of the few outliers as far as the NSE 500 is concerned, one of the few stocks gaining, seeing some gains. Well, the other stock on the radar is actually Biocon. That particular stock, again, another outlier, stock higher by almost 3%. What's going to be important to note as far as Biocon is concerned is that, remember, the management had joined us post the Q2 results, and they told us about the likely merger of the Biocon Biologics business with the parent entity itself. Any development on that is something that the street will keenly watch out for. On the other hand, that will also have a read across as far as Syngene is concerned. Syngene currently trading flat. On the other hand, Ritu did tell us about some of the PSU banking names. One particular stock that we could look at is Indian Bank. Indian Bank, of course, there has been some negative news flow regarding the FDI. But remember, yesterday the NSE had actually gone ahead and given an update regarding the capping of individual weights on the NSE banking index was concerned. Well, the street was anticipating the Indian Bank could enter into NSE banking index, but that hasn't happened. Post which we've seen almost a 10% correction in this particular stock in the last 2 trading sessions. Well, with that, it's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.
Hello and welcome to Your Stocks live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra, and on the show today we'll discuss all the stock queries that are sent by our viewers with our experts. Before we do that, let's take a look at the markets because continues to be a down day for the markets. It's a 120-point cut on the Nifty as we speak. We also have the mid caps which are down 0.9%, so there's a bigger fall that is coming by as well. But important comments coming in from the Chief Economic Advisor. He indicates that the government is not losing any sleep on rupee depreciation. They expect the rupee to make a comeback next year. Right now, these levels are not hurting, be it exporters or the inflation number as well. And the indication is that there could be some recovery in INR in the next year. That's, of course, an important comment coming in from the Chief Economic Advisor. We'll keep discussing this big story. And since then, we've seen some appreciation in rupee. The low today was 90.29, and now it has recovered from those levels, has come back to 90.14. So very, very important to track the rupee moves post this commentary which is coming in from the Chief Economic Advisor, because that continues to remain the big story that we are tracking today. With that, let's move on, and we'll keep, of course, looking at rupee moves through the course of the show as well. But let's welcome in Saumil Mehta, Head of Alternate Research, Capital Market Strategy at Mirae Asset Sher Khan, and Sneha Poddar, VP Research Wealth Management at Motilal Oswal Financial Services, to answer all your stock queries. Saumil and Sneha, good afternoon. Thank you so much for joining in. So let's get it started. Nimish is writing to us from Pune, holds 4,000 shares of Restaurant Brands Asia at 64 rupees. Asks if we can hold stock for another 6 months. Sneha, there's been a lot happening around the PE stake sale for Restaurant Brands Asia. A lot of other updates as well. Give us a sense of what Nimish should do with this stock.
Hi, good afternoon. So my suggestion to him would be he can probably monitor the stock from 1 to 2 quarters perspective. Basically, like, if we avoid this, the recent news flows around restaurant brands, overall from the business perspective, if we look, the Indian business is doing quite decently for them. It's largely like, even the Q2 numbers were quite decent, and it was largely driven by the store expansion and the healthy same-store sales growth. But it's the Indonesian market which is causing trouble to them, and there, the management is taking a lot of efforts in terms of store rationalization and all. So over next 1 or 2 quarters, one needs to monitor whether the Indonesia business turns around or not, because the Indian business is the main focus area, and there the growth is happening. It's the Indonesian market which is playing a little pain in the overall profitability of the company. So my suggestion would be just monitor it for 1 or 2 more quarters, and if the Indonesian market doesn't turn around, then one needs to exit this stock.
Okay, so the stock can be held for next 6 months is your advice on this particular name. Sneha?
Yes.
Okay, all right. Saumil, what about charts? How is the stock looking from that angle?
Good afternoon to everyone. My view is negative on the stock. It's been struggling below the 20 and 40 daily moving average. Since 2024 September, the stock has been trading below 200 daily moving average. Clearly, the trend is down in the medium term, in the short term, both. So I'll be expecting more, down levels like probably 56, 57 levels I'll be expecting on the stock. So clearly my strategy would be to exit from the stock and probably get into some other sectors.
Okay, some other sectors. We'll come back to that in just a bit, Saumil, but let's get more stock specific. We have received a query from Winnie, who's writing to us from Goa, holds 1,000 shares of Mazicon dock at 2,832 rupees a share, wants to know the outlook on the stock. Sneha, there was a point in time that these shipbuilding names did really well, but of course, from those high levels, there has been a sharp correction. Do you think we made a bottom here?
We can say so because, anyways, like, with the Putin visit in due course, and a lot of, defense deals are likely to probably close at that point in time. I mean, it's just a profit booking which has taken place, and I believe, I mean, these are the good opportunities. One should actually, accumulate such quality names, because when we look at Mascot Dog, their order book is very strong, and even in terms of, pipeline, if we talk about, there are few next generation submarines which were approved by the government recently, so it just needs to be concluded in the coming months. Even the Calvary submarine deal was approved by the government, which needs to be concluded. So the pipeline also shows that there's a lot of visibility in terms of revenue growth going ahead. So my take would be to actually, take this as an opportunity to accumulate at lower levels, and if one needs to average it out, it can be done at these levels.
Okay, it can be done. It can be averaged out at these levels. What about you, Saumil?
See, in the medium to long-term outlook, definitely positive. There's no doubt about it. A great channel pattern on the monthly and quarterly charts, and trading above the averages. But in the very short term, there's pain, and I would expect the stock to still continue the sell-off till 2500 or 2550. So in the very short term, there could be pain, but for medium to long term, I'm absolutely positive. 2500 would be a very good opportunity to buy the stock, and my targets would be much higher, above 3,300.
Okay, above 3,300. So an upside from these levels. Let's go across to the next query. Krishnan is writing to us from Ahmedabad with an investment query. Asks if we can buy Sun TV shares at current levels. This time, let me go to you first up, Saumil. The stock is lower, down 1.6% right now. But the media space in general has not done too well so far. I guess there have been triggers, but that hasn't converted so much into stock price yet. But Sun TV, specifically at these levels, what is your take?
Sun TV, again, negative on the stock. Sorry about the media space, but negative on the stock. Since December 2024, the stock has been struggling below 200 daily moving average. Forming lower tops, lower bottom on the monthly charts, quarterly charts. Negative, absolutely. In the very short term, I'll be expecting the stock to go below 530. However, if the stock closes above 620 levels, which is very high, above 200 daily moving average, then probably there could be a medium term uptrend reversal. But at this point of time, negative, and I'll be expecting lower levels.
Okay, lower levels below 530 soon on Sun TV. Fundamentally, Sneha, what's your take on the space and a specific stock?
Sonal, even from my side, I mean, I would say better to avoid, because largely for these TV broadcasters, advertisement is the main, source of revenue. And recently, if you've seen the shift in the FMCG ad spend has been more towards the digital side rather than towards the, the traditional TV broadcasters. So this really poses a big headwind for Sun TV. And secondly, the recent Star Viacom merger, even that poses a threat for players like Sun TV, because with the heightened competition for the ad revenue from these deep-pocketed players, obviously that will create a lot of pressure. And also there's a potential downward risk in terms of IPL media rights in the next renewable cycle. So keeping all these headwinds in mind, I mean, my suggestion would be to avoid such counters.
All right, so avoid Sun TV at current levels, or fundamentally and technically not looking so strong. Let's go to the next stock. Rahul Bakshi writes to us from Faridabad, holds 200 shares of Bharat Electronics at 140 rupees a share, wants to know the long-term prospects of the stock. Sneha, let me come to you for this one. What do you make of this particular name?
I see Bharat Electronics as one of our top picks, because we really like the leadership position of the company, and consistently the company has delivered in terms of earnings quarter after quarter. Their order book is very strong, which provides good revenue visibility, and even in terms of the pipeline, I mean, there's no dearth of order across Army, Navy, or Air Force you talk about. And one thing which really stands out, now the company is completely transitioning transforming itself from just being an electronic supplier to the system level integrator. So
Okay, all right. Sneha, looks like there's a broken link, but Saumil, can you come on this one?
Yeah, sure. BEL looks great to me in the long term, medium term. However, in the short term, as Mazga talked, same situation here. Short term looks a little difficult, and I'll be expecting the stock to go below probably 380, 370 levels. So that would be a good buying opportunity for a long term investor, for a medium term investor. But in the very short term, my target should be around 380 levels, which is 200 daily exponential moving average.
All right, 280 in the near term. That's the level to watch out for BEL. I would request our guests to hold on. We have to slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're still tuned into Your Stocks on CNBC-TV18. We still have with us Saumil Mehta of Mirae Asset Share Khan and Sneha Podar of Motilal Oswal Financial Services. They are here to answer all your stock queries. Let's start with the next one. Prabir Chaudhary writes to us from Chandigarh, holds 20 shares of KC International at 890 rupees a share. He wants to know if should continue to hold or sell at current levels. Sneha, what's your take on this particular stock and generally the entire sector that KC belongs to?
Okay. So basically, the capex is expected to pick up once again, post the elongated monsoon, and thus KC from that angle should do well. Now, it is one of the strong players in the power T&D space, wherein a lot of investments are expected to happen, especially given the condition wherein there's the lot of investment is required with regards to the power is getting generated, but then because of the the choke which is there at the transmission level, so that needs to be addressed. At the grid level, there are a lot of issues that the overall sector is facing. So the pipeline for KC International is looking quite strong in that sense. And the company in terms of overall balance sheet strength, in terms of profitability, is doing really good. So my take would be to hold on to KC International from the long-term perspective.
Okay, all right. What about you, Saumil?
My view is negative on this one. In the short term, yes, that could be a bounce, and there is a bounce in the last 3 days, and I'll be expecting this bounce to continue till 770. That will be a very, very crucial resistance from the stock. However, if you see monthly, weekly charts, there's all low top, low bottom formation trading below 200 daily moving average. Overall weak stock, I'll be expecting in the medium term outlook to stay around these levels and retest the previous swing lows of around 630. But in the short term, yes, there could be a bounce, and that would be an opportunity to exit the stock.
Okay, all right. That is about KC International. By the way, JSW Steel, that stock should be on your radar. There's an update that was come by. JFE Steel, that company has agreed with JSW Steel, where JFE will be investing around 270 billion yen to transfer the integrated facility, that is the steel facility of Bhushan Power and Steel, to a 50-50 joint venture between JFE and JSW. This is an important update that has come by, because remember, there's been a lot of to and fro when it comes to JSW Steel's acquisition of Bhushan Power, and now there's an update here where JSW Steel and JFE will be having a joint venture where there'll be a 50-50 partnership for transferring integrated steel facility of Bhushan Power and Steel to that joint venture. The stock has come off from the highs of the day. It is down around 1.2% as we speak. We'll get in Nigel in a bit as well to understand what this means for JSW Steel overall. But right now, looks like it's a 50-50 JV where 50% equity will be coming in from JSW Steel, 50% from JFE Steel, and the investment is about 270 billion yen. So what happens to the balance sheet, what the funding requirement will be, and where will JSW Steel be funding it from, all of that and a lot more. We'll get in reaction as well. Sneha, I don't know if you track it closely, but any word on what this update means for JSW Steel, if you can help us with that?
We do track JSW Steel, and what we believe is that in the long run, this would be beneficial for the company, as it would help the company to rapidly expand its capacity. Overall, the metal sector is expected to revive. Though the steel prices are under pressure currently, but then from the what we believe is that the metal sector will soon turn around, and the domestic demand is quite strong. Globally, the demand is expected to pick up once these global uncertainties do subside down. So in general, when the demand picks up, the JSW Steel will be well placed to cater to this demand. And moreover, it is moving up the value chain. So a lot of value added products are there in JSW Steel product offering, which really makes the company stand out. So what I believe is, with the this acquisition finally seeing the light of the day, this will really add the feather to the company.
Okay, so the release also mentions, there's a release by JFE which indicates that right now BPSL or Bhushan Power owns an iron ore mine and integrated steelworks in eastern India with a crude steel production capacity of 4.5 million tons per year, and there's a potential to expand the capacity of this particular integrated facility to 15 million tons in the future to make it one of the largest integrated steel facilities in India. So this is an outlook that JFE has also given on what it would mean for the entire plan. They say they expect, of course, this is about their own company that they're talking about. They expect it to be profitable by fiscal 2035, but that's, of course, about JFE. We need to understand the impact that it would have on JSW Steel, because the stock has sharply come off from the highs of the day. It is at the day's low. It's a 2.5% downtick on this particular name. So we'll understand in greater detail what this would mean for JSW Steel, which has come off sharply from the highs of the day. We'll keep that story alive. Of course, we'll keep talking about that. But would like to thank our guests, Neha and Saumil, for joining us today and answering all the queries very patiently from a technical and fundamental viewpoint. But let's move on now. Amazon Web Services, the world's largest hyperscaler, has taken a giant leap in the ongoing AI race over its rivals Google and Microsoft. Ashmit Kumar visited the company's flagship summit, reInvent 2025 event. Here are the key takeaways from the event.
Well, the world's oldest, the largest hyperscaler in the world, Amazon Web Services, throwing the gauntlet to its competitors, the likes of Microsoft and Google, through some big announcements that we saw today at their day one of their flagship summit, reInvent 2025. Now, the markets, the industry was watching very carefully. What were we watching out for? Well, there are four things that caught our attention. Number one, the chips race. Now, hyperscalers like AWS are not happy just being hyperscalers. They also want to enter the chips race. AWS entered this race back in 2018, and today they released the latest version, their most powerful homegrown chip called the Trainium 3, which they believe is exponentially more powerful than previous generations, and it couldn't have been more timely since Google has been flexing with what their chips can do, which they've shown with Gemini 3. Not just this is not the end of the road. Matt Garman, their CEO, the AWS CEO, said that there are lots more work under the wraps, that as far as the next generation is concerned of chips, that will be Trainium 4, which will be exponentially more powerful than this version. And this, importantly, is a statement of intent by AWS that they want to enter an ecosystem which is on lockdown by NVIDIA, courtesy its powerful GPUs. That was one. The second, as far as the LLM race is concerned, this is clearly heating up. With Gemini being released by Google, we've seen the GPT versions released by OpenAI. Today, AWS released its Nova 2 generation of LLMs, which they say is significantly more powerful, can achieve higher benchmarks than even the likes of OpenAI as well as Google. And number three, data sovereignty impacts. A lot of countries are asking for their companies to store data locally, and AWS's solution is what they call AI factories, where they move entire server racks to the location of the customer companies to meet any data sovereignty mandates. And finally, as far as AI agents is concerned, AWS releasing what they call our frontier agents, which can compress timelines for tasks which ordinarily would have taken months, and that this is something which can be done by AI agents working round the clock for days and weeks on end. So that's a quick wrap of four highlights that caught our attention.
All right. Thank you, Ashmit, for joining us with all those details. By the way, JSW Steel stock, it has sold off. It is down 4% at the day's low. It is on the back of the news that there's a joint venture between JFE and JSW Steel for Bhushan Power and Steel integrated facility. They also indicate that the steel production capacity of 4.5 million tons per year could be scaled up to 15 million tons in the future to make it one of the biggest integrated steel facilities in India. In a while, Nigel will also join in to make sense of this JV that has come by, to understand what led to that sharp sell-off in the stock as well. But of course, it is a CNBC-TV18 news break, which has been confirmed as well. In fact, actually, let's do one thing. We do have Nigel in the studio joining us now to explain what's happening here. Nigel?
Well, it appears initially the street is a little bit disappointed, maybe on the valuation front, because it appears, if you're valuing the company at 15,000 crores for around 50%, then it'll be around 30,000 crores on. I think many on the street would have wanted to see that it getting valued a little bit more. That could be one part. And this, Yash has reported about it as well, and it's been in the works for the last many months. To put out a few details, Bhushan Power and Steel, the holding currently is JSW Steel has close to around 83% in this company, and 17% is with the promoter entity. So we'll have to look at what are the contours of the deal and how much JSW Steel will be getting as well. Because if the holding comes down from around 83% or then even the profitability, the contribution will come down by an equivalent amount as well. And what is the promoter holding post this? So I think a few unanswered questions. The reason that the stock could potentially be selling off, just to first look at it, is the valuation that is given is relatively lower. And what is the pending stake of JSW Steel in this Bhushan and Steel, Bhushan Power and Steel asset? Because it's been turned around to a great extent. And, the street, when we reported this itself, most analyst feedback was it should be valued at more than 30,000 crores. And back of an envelope suggests that actually it is around 30,000 crores or thereabouts. So that's just a brief take out there. Maybe the valuation at which this is done is relatively low. We'll wait by further details, and I'll be speaking to the management at around 4 p.m. later today. So all through the trading session, there was a lot of open interest built up, thinking that there is this deal that is in the works. From the morning, the word go itself, the buzz was that the deal is coming about. And now the deal is not as good as what the street anticipated, but it could be a knee-jerk reaction. We'll have to look at the detail in, the details in further, in the time to come. But as I said, Bhushan Power and Steel, the holding was JSW Steel had 83%, promoter entity had close to around 17%. So I'll get back with some further analysis. But first, take it appears some profit taking, and secondly, maybe the valuation is a little bit lower. We'll come back with more.
Okay, we'll come back to you for more details on that. For now, there's a sharp recovery from the lows as well. The stock was down 4%, now it's down 2%. But further details, as Nigel mentioned, is something we'll get from the management in just a bit. But with that, we'll do one thing. We'll take your leave on this edition of Your Stocks. But do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Asian markets have opened up a slight bit on the positive side. Taiwan index is trading with gains of 0.69%.
Nifty support stands at 25,924, which is the 20-day moving average.
We create more value for the investors in the long run. So we believe that's the right way to think about this.
Their intervention, or rather their gross activity, has gone down, the buy and sell over the last 6-7 months.
Markets have opened 25 points higher on the Nifty. The Sensex is starting in the green.
Every 1 rupee creates a EBITDA impact of 200 crores plus.
Nifty down about 108 points, Sensex down about 288 points as we speak.
The big things which Asian Paints does is that as part of Har Ghar, you can't just own surfaces, you have to own spaces.
We tend to speak about a rupee fall in kind of depressed notes like a stock market fall. No, it is not. It also not just benefits exporters like IT stocks, it benefits the entire economy.
The story continues to remain the same. The rupee depreciation, falling markets, broader market weakness, and no respite. It can be seen so far.
Good afternoon, hello and welcome to Closing Bell. And here we are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi, with me is Nigel. And it's been a bit of a hectic day for markets, for the equity market, for the currency market. And we've also got corporate action coming in from JSW Steel. So it's a packed 1 hour. Keep it with us. The ride is just getting started. Nigel's working his numbers on JSW. And we'll talk about that in just a second. But first up, it is a disappointing day for equities. There's no two ways, no other way of putting it. And a lot of it obviously stemming in from the uncertainty around the currency as well. So let's come to the Nifty straight away and see what's going on. What we're dealing with right now is about a 100-point drop. A while back, the Nifty actually slipped below the 25,900 level as well. Now it's trying to come above that. And this is a very critical mark because this is where the fight is around the 20 DMA. Now, if the bulls can at least defend this level, it will give some semblance of positivity. Otherwise, there's not much of it to find. The other issue with the market action today is the crunching fall in mid-caps. Look at broader markets. Look at what's happening to the mid-cap index. The mid-cap index is, as we speak, down about a whole 1%. Let's pull up the small cap index as well. So broader market pain is very, very visible. The small cap index is also down about 1%. And if you look at the advanced decline ratio, then it's very, very clear in favor of the declines. Lots of stocks are selling off. I'll just give you some examples. If you talk about the key losers, because this is the broader market pain that we're talking about. So a lot of PSU banks, PNB, Canara Bank, Indian Bank, Bank of India, a lot of these PSU banks are down. I remember yesterday there was clarification coming in from the Parliament Q&A that right now there is no proposal to increase the FDI limit above 49. Maybe that's become an excuse to take some profits. There are other stocks like Wockhardt, where there was good news coming in. Wockhardt rallied very, very smartly ahead of this big drug launch, the antibiotic launch that they're doing. Today is a day of complete profit taking, and many such other names that we'll talk about as we go forward. On the large cap screen, the only island that seems to be performing is IT. Maybe some of it is sentiment because of the rupee. Some of it could be just because of the fact that now you are getting slightly upbeat calls on IT. Brokers have been saying that there's some value here that's worth looking at. So Wipro, TCS, Infosys, these stocks are up and about. Otherwise, even for the Nifty, and let's pull up the heat map actually. It'll give a nice sense of what's going on the large cap screen today. Beyond IT and one or two bank names, there's not much to talk about. Let's see if we can get the Nifty heat map up in a bit. So a lot of stocks, BEL, Titan, NTPC, Tata Consumer, Interglobe. It's cutting across sectoral lines. It really doesn't matter. It's that kind of a session. And then there is JSW Steel. Stocks down 2.5%. Nigel, hopefully you've had some chance to breathe now. But it was interesting because this was not entirely unknown. The market was always looking at the possibility of JFE coming in as some sort of a partner on Bhushan. What is your sense on what's happened?
Well, the problem is that the valuation, the EV that was being discussed, or the buzz or whatever that is, that was in the vicinity of 45,000 crores to around 50,000 crores. Now, the equity stake is come in at roughly around, 31,500 crores approximately. In all probability, and add a net debt to this. So it should be in the ballpark of around 38,000 crores approximately, which is much lower than what the street was working with. This asset, remember, in the first half of the year, the EBITDA number of this asset, BPSL, was around 1,500 crores, right? So the year you assume that it will be around 3,000 crores with a scaling up opportunity as well. So you say that if the deal is done, at around 38,000 crores approximately, given that equity value will be 31,500 crores. Add to that the debt, which makes it an EV of around 38,000 crores odd. It is still not very, very cheap. It appears like it's at around 12 times approximately on EBITDA, current EBITDA. But there is a optional value where they can go ahead and scale up this capacity as well. So the asset is good. So for the time being, the street at around this 38,000 crores of enterprise value will not be happy, because the buzz, the expectation was it will be more than 45,000 crores. Some were even talking about it being at around 50,000 crores. All the other details that are flashing for you on the screen, that's, there's a lot of information being put out there. Short point is JFE will be picking up 50% stake for around 31,500 crores of equity value. They'll be paying around 15,750 crores approximately. And the enterprise value is relatively lower in comparison to what the street was anticipating. So that's the first take on this asset. And the EBITDA for the first half of the year was 1,500 crores. So on an annual basis, it'll be a little more than 3,000 crores.
So I think that we'll discuss this in greater detail as we go along. But as what you explain is that essentially why the street seems to be disappointed is that JFE has gotten the asset at a bargain price. And maybe the street was hoping that it'll be a better pricing at which that this deal actually happens in terms of the equity component that JFE is putting in right now. More on this, we'll get some analysts on this as well as we go along. The other story, before we get to our technical experts on the show, is the rupee. Let's quickly flash what's happening with the currency right now. So we are at levels of about 90.13. I mean, we've had a marked deceleration. At one point in time, the rupee was down almost 0.5% for the day. Now there is some semblance of a recovery, but closer to about 90.29. That's where the day's lows were. Let's see what happens in the next 1 hour. So let's straight away get to the trading strategies now. First up, we have Mitesh joining in. Mitesh, a lot of moving parts and a disappointing day. I mean, look at what's happening with the broader market. So your first thoughts on the index and then specific stock ideas.
Good afternoon, Surmi. I said that we will possibly look at consolidation given the fact that now 26,300 has become an established pivot on the upside. And the markets, should try and do some range between 25,850, 860 on the downside to about 26,300. And now we are getting close to the lower end of the range. The idea is that if this doesn't break, then I think this consolidation might well extend for a couple of few more days, and then we might see that upside breakout. But in case we start closing below 25,850, 800 levels, then I think another 200 points kind of decline will happen before a serious comeback can be mounted. So in that sense, I think I'm keeping a close watch on the index as we get close to 25,850. And on the stock side, I have one buy and one sell. Varun Beverages is a buy with a stop at 469 for targets of 495, and Gas Authority. A couple of days back, there was a bad news. It bounced back from 170, 171. But if it breaks 169.5, I think it will be a breakdown. Sell then with a stop at 172.5 for a first target of around 162 to about 161.
Okay. All right. Got that, Mitesh. Thanks very much. Mitesh, just because it's a stock in focus, it's a news on fundamentals. But anyway, just quick technical check on JSW Steel.
Yeah. So I was watching that. I think that fall happened very fast, and the stock has some weekly supports around these levels of 10 to about 1100, and we got a low for around 1104. So in case we start breaking below 1100, then I think the stock could correct more. There's certainly a chance of that happening because the daily indicators have, with today's fall turned slightly negative. So if people are holding, I think they should use 1100 as the stop loss. And if they get a bounce back before the 1100 level breaks, then I think, try to exit close to about 1160 or at least.
Okay. All right. So we'll keep those goalposts in mind. Thanks, Mitesh. We'll come back to you a little later. For the time being, let's introduce Sudeep Bandyopadhyay into the conversation. Good afternoon, Sudeep. What a day, Just when you think we had those all-time highs and the market momentum completely fizzling out. We'll get to all the stocks, but let's start with the newsmaker right now. JSW, what do you make of the transaction? Nigel just explained that the pricing seems to be a bit of a worry for the market.
Oh, absolutely right. I think, the expectation was of a much better valuation. And on the back of that, I think JSW had moved up also. Unfortunately, the valuation isn't what the market was expecting. It's kind of, I would say, that's probably the perfect value. No premium or nothing extra is coming to JSW Steel. I think, that's probably the little bit of niggling worry for the market. Also, we don't know exactly what's going to be JSW's shareholding. because in BSPL, promoters also had about 13-14% shareholding. So is it, who's diluting, how much they're diluting? We need to know that to ensure, understand fully the transaction. But on the whole, I would say this is probably a little bit of a knee-jerk reaction. Eventually, this is good for the JSW Steel Group. They're getting a strong partner with expertise, and a little bit of value unlocking is happening. Liquidity is improving for the business also. So I don't think it's too bad a transaction. However, of course, market has been little disappointed, and that's why we see the correction.
Absolutely, and I think that's going to be a point that will continue to be debated over the next couple of days. Whether it's like, I mean, you're getting a big international partner with reasonably deep pockets. So then, if you give in a little bit in terms of just the valuation and pricing and the equity piece, whether it's a good bet to take, strategic bet to take, or whether it proves to be disappointing.
No, JFE already has taken JSW Steel. They've already hit their upper end. That happened more than 10 years ago. So is this an indirect way where JFE, this is these are all the questions that I'll be asking the management later today. JFE already has taken JSW Steel. Now JFE is picking up a stake in one of their subsidiaries, which is BPSL.
Yeah.
They'll have 50% out there. At some point of time, will they reverse merge it into the listed entity? And then that'll be indirect way of JFE increasing stake as well. So the money comes in, but the street is wondering, first the street is being by for rationale. Why did they do something like this? Do they want to bring down the debt? What will the promoter holding be in BSPL, after this?
How much
BPSL.
the listed entity, how much JFE?
What will it be? Or is the promoter entity moving out? They have that 17-18% or thereabouts. So that's something that we're waiting by for. And ultimately, what is the plan? To fold this unit back into, JSW Steel. And that's the way that JFE indirectly will go ahead and increase their stake. We'll wait by. We'll have an analyst who will be joining in soon as well. But JFE has been holding on to that stake. The last few interactions that I've had with JSW Steel as well, my last question has always been, is JFE coming in directly or indirectly? And they have been saying no. So this is, this was why I was asking that question for the last few times.
So a lot of bigger strategic questions that still need to be addressed. And I'm sure Nigel has his list ready for the press interaction that's going to unfold a little later in the course of the day. That's JSW Steel. But let's move on to the other.
JFE has 15% stake as of now. Sorry.
So 15% stake in JSW Steel, the listed entity. Now we need to see what their plans are with respect to Bhushan Power and if there's some sort of a reverse merger, if that's what they're thinking right now. So we'll get to it as we go forward. The other big story of the day, obviously, has been the rupees slip and slide. So let's bring that chart back up. The low came to closer to around 90, 28, 29 almost. And from there, it's pulled back a little bit. Lata is here. Lata, I'm sure the last 24 hours have been a complete whirlwind for you as well. Dealers, rupee experts, onshore, offshore. What sense did you make of all of it?
Well, actually, the rupee has been falling from November 18th, the day when the trade deficit for October was announced, and it was an all-time high of $41 billion. Since then, the fact that the trade deal hasn't come has kept rupee bears up and about. And we saw a huge fall today, more because of the psychological 90 rupees per dollar barrier getting crossed. Though technically it's just one other number, but it was a good 1% or an over 0.5% fall today. The point is now in late trade, it appears like there is selling exhaustion. I mean, it's a typical way in which how bear markets normally end. I hope I'm not speaking too soon. But how much will you sell on the same news? And the market, came to terms with the idea that we can't go on selling at this point, and they have probably taken this protection from that statement that the CEA made, that the government is not losing sleep over the rupees fall, and probably this is the best time for it to fall because there are tariff walls coming up, and this makes us even more competitive, was what he seemed to be hinting. And the important point to note is that the RBI was supplying dollars earlier in the day, but at no point it was supporting a level or protecting a level. It was the selling intensity was always very weak of dollars, but it let the market find its own level. The recovery from 90.29 to 90.11 or thereabouts has not come because of a huge supply by the Reserve Bank, but because the market appears to think that we have done enough, and there has been a long dollar unwinding and probably covering of rupee shorts, or maybe even exporters coming in and selling at that 90.29 level. That is very important, that the market takes cognizance and there is an exhaustion of selling. The market is now convinced that RBI is of the view that we should allow the market to correct itself. A cheaper rupee is good because it will mean lower trade deficit. Exports will become more attractive, and more importantly, the economy gets protection from imports. I mean, you can ask steel, since we were discussing steel earlier today. For a steel company in India, nothing is as good as a rupee depreciation because Chinese steel becomes, imports become expensive. So the market needs to veer around to the view that a falling rupee is not bad. President Trump has been asking for the dollar to come down to 90 or 89 or thereabouts. His big complaint was that the dollar was expensive. And likewise, a falling rupee actually is a protection to the economy. It is not just IT stocks or specific stocks. For the economy as a whole, it's a protection. It is almost like a rate cut.
I wonder if President Trump is watching the rupees fall today, and then if he understands the FX markets and what you just said, then he might be thinking, oh, is this some other way
We call it currency manipulation.
Yes, exactly. So we're trying to preempt the next set of posts on social media platforms. But thank you very much for explaining that to us, Lata. So there we have it, the Indian rupee, and it seems to have found some sort of a semblance. There's no runaway move to 91. The market seems to be fairly balanced, at least at this point in time. But what does this move on the currency? It's been a sharp 5% sort of a move over the last couple of months. What does it mean for a lot of the individual companies, both importers and exporters? We have Sudarshan joining in. He's been running through the lists and what it means for EBITDA. I think the statement from Bajaj Auto was interesting this morning. Mr. Sharma gave us a number. Every 1 rupee fall, we get 200 crores additional EBITDA.
So 30% fall in 10 years, 18% fall in 5 years, 5% fall in 1 year, and in the last 2 days, the kind of fall that we have seen in rupee, and the record low for rupee is 90.29. We have seen a minor recovery from that level, and currently it's at 90.11. So now we have tried to find out how this will have an impact on certain sectors. So to certain sectors, it will have a positive impact, while certain stocks will be impacted negatively. So on top of the list, one sector that is trading with gains today is the IT sector, because rupees fall will have a positive impact on majority of the IT names, because they have a huge exposure globally to both US and the Europe, and revenue that they generate or they get is in dollar. So any fall in the rupee will have a positive impact on their margin. Next sector comes to the mind is pharma, where the impact will be limited because majority of the companies go for hedging when there is a fall or appreciation in the rupee. But one negative impact can be seen here is the increase in the input cost because of a fall in rupee. And input cost form majority part of the sales. For most of the companies, the range of input cost to total sales is in the range of 40 to 60%. Now next is auto sector. Two-wheelers name. Two companies that will benefit the most. One, TVS Motor, because 30% of their total volumes come from exports, and to total revenue, 25 to 26% comes from exports. So they will be impacted positively. Next is Bajaj Auto. 50% of their revenue comes from exports. In Q2 FY26, dollar realization for them was 87.10. For Q3 FY26, I did the calculation for last 2 months, and average comes to around 89.10. Now, while talking to CNBC-TV18, management did say that if there is a 1 rupee fall, then it impacts EBITDA, annualized EBITDA positively by rupees 200 crore. So now for Q3 FY26, benefits can be on EBITDA in the range of rupees 350 to 400 crore for Bajaj Auto. For auto ancillaries, I have taken 3 names: Uno Minda, Bharat Forge, and Samardhana Motherson, marginal positive impact. Bharat Forge, hugely positive. For Uno Minda, negative impact. Oil and gas, it would have a mixed impact. For Reliance, it's a mixed impact. For other companies, CGDs, it would be a negative impact. In the chemical sector, it would impact positively because, like IT, these companies have a huge exposure, like the SRF, PI Industry, Atul. All these companies will be impacted positively.
Okay, so all right, got that. Very exhaustive list. So thanks very much. It's quite helpful. Just a quick check in terms of who benefits. So it seems some of the auto ancillary companies, the auto companies, IT, they are straight out beneficiaries, where it could be a little more mixed for sectors like pharma or energy importers like, say, Reliance Industries. Anyway, let's now move on, get back to Sudeep. Sudeep, let's take up some of these sectors, starting with IT. IT, in any case, like I was saying earlier, a couple of brokers, CLSA, Motilal, I mean, they've started issuing more optimistic calls now on IT, saying there's value, there's the currency tailwind, and maybe, eventually revenue growth will also pick up. Do you agree? And if yes, give us some IT names that you would buy now.
Well, currency tailwind is definitely real with the kind of depreciation we are seeing. Definitely, these large cap IT companies, which have roughly around 50% of their revenue coming from US, definitely improves their EBITDA by the sheer force of the currency depreciation. But having said that, I'm not too excited about the prospects of IT. At this stage, there are still many challenges. The US, irrespective of whatever we see and hear, the reality is large US corporates are still a little cagey, hesitant about awarding new contracts or large contracts. They are holding back. They are probably wherever they can give a contract of 100, they are only doing 50 at this stage. They're slowing down execution. So there is definitely challenge as far as order book is concerned. There is also pressure on margins for Indian IT companies. The corporates are insisting on use of AI and benefit out of AI, whereas unfortunately, large Indian IT companies don't have their own AI models. They depend on third-party models, and their cost benefits don't really work out. So margin pressure on these companies is also real. So as far as I'm concerned, and I've been saying this for quite some time, I will focus on segments like travel and tourism, where there is a lot of excitement world over, and look at picking up IT companies which are catering to travel and tourism. Or in the automobile, that ICE to EV transition, a lot of IT companies are working in this space. So pick up companies which are working in this space, because the scope for work is continuously increasing, and the margins are good because this is a fast moving and fast evolving and growing segment. So RateGain Technologies, Coforge, Persistent Systems, maybe Tata Technologies, these are the companies which I will definitely look at.
Okay. All right. So that's as far as the rupee-related moves are concerned. Let's take a look at some other stocks that are up and about. Like I said, in the broader space, there is plenty of pain and pressure. And it's these PSU banks that really stand out. And the cuts range between 4, 5, 6% in many of the cases. These are also stocks that have had a great one-year run. I mean, if you look at, for instance, Canara Bank, which is down 4.5% today, stocks up about 40% in the last 1 year. If you look at something like an Indian bank, which is down 6% today, ditto, 40% up in the last 1 year. So there's profit-taking and sharp profit-taking that's playing out today. Sudeep, any advice here, PSU banks?
Well, I love PSU banks at this stage. Believe me, the valuation gap is glaring. Look at, let's say an NBFC like Bajaj Finance. See what is the kind of price to book it is quoting at 5, 6, 7, depending on the market, depending on the value, where we are talking. But look at SBI, the largest PSU, it's quoting at 1.1 book. So there is a significant valuation gap. I'm not saying they should be exactly identical, but this valuation gap has to get bridged in one way or the other over a period of time. So definitely PSU banks need to be picked up for long-term portfolio building. Even if you are not interested in picking up SBI, which I think we should, look at these smaller PSU banks. We love Bank of Maharashtra. I think leave aside the government disinvestment and related volatility, but pick up Bank of Maharashtra. It's a good bank. Valuation is very good. Pick up, let's say, Central Bank. Valuation is very good. And these doesn't depend on government's plan to merge, consolidate. These are independent actions which government may or may not take. But valuation-wise, they're definitely worth picking up.
Okay. All right, Sudeep, thank you very much. Good to have you on the show today, and we look forward to connecting again soon. Thanks for joining us this afternoon. Need to take a quick break. We'll come back on the other side, keep tracking the market. We'll have Pashupati Advani joining in for some fresh perspective. Welcome back. Rounding up to 3 o'clock, and in a bit we'll have Pashupati Advani joining in. But before Pashupati joins in, we have Manglam joining in because Nigel's hopped across to get to the JSW press conference, which promises to be a very, very interesting one.
Yeah, we'll watch out for how that pans out. You know, the kind of questions that we'll pose to them, the kind of clarity that we'll get. For now, the stock is slightly under pressure post that deal was announced, holding the cut of 2%, but that's pretty much what the market is. The good part, however, is the kind of recovery that we've seen, especially coming in on the Nifty bank because of 2 or 3 private banks. The largest weight of them is HDFC Bank for as long as it stays. You know, HDFC Bank, obviously, we're doing a rejig on the weight on the Nifty bank soon. So HDFC Bank has moved higher, and that by itself has caused the Nifty bank to now be in the red by just about 35 points. So chances are a few more sentences that we speak, and we will obviously see the Nifty bank move into the green as well. The Nifty currently is sitting with a cut of almost 0.25%, which is, again, a good recovery of almost 100 points from the lows that we've seen. But what are the top movers that we have in the market in this hour? Hormaz joins in to tell us more. Hormaz.
Trying to find some optimism within the broader markets, and so we'll start off with some gainers today. And even if the mid-cap index is down, Sonata Software is holding on to gains of around 5%. Another potential beneficiary from the rupee weakness. The volumes today are the highest in over a month. We've had close to 70 lakh shares that have been traded already. The 20-day average here is around 6 lakh shares, so 10x in comparison to the 20-day average. The stock is now at a very important level. The 50-day moving average at 366.7. That is where the stock currently is trading at, and has been an underperformer all through 2025. Down 40% so far this year, was down 20% last year as well. Indian Bank among the top losers within the state-run lenders today is 5.5% lower, still holding on to the day's low, down almost 10% now in the last 2 sessions. Volumes today are already double of yesterday's number. Today's volumes are already also the highest since June of last year. Had 60 lakh plus shares that have been traded already on the stock. The 20-day average is around 11 lakh shares, and the stock is broken below a very important level, the 50-day moving average of 817. Why is that important? Because it has not closed below that level since the month of July, but it had been among the best performing PSU banks this year, and not only in this year, over the last 5 years as well, because from 80 rupees the stock had moved to almost 900. Aztec Life is back in the list of gainers today after a 5-day losing streak, around 6.75% today, 13% in that last 5-day losing streak that the stock had. The rebound today, though, is not on very significant volumes as the gains were before this losing streak. There are almost 50 lakh shares that have been traded. The 20-day average is around 33 lakh shares. It took support at its 100-day moving average and has rebounded from those levels. And lastly, Capital India Finance is the 3rd straight day of gains for the stock. The highest volumes on record in today's session. Close to 2 crore shares have been traded today. 20-day average of around 3 lakh shares. The stock back above key moving averages and has also managed to trim some of its losses on a year-to-date basis.
Right, Hormaz, thanks a lot for that. And when it rains, it pours. Right now, as we speak, there is an exclusive that has come in from our colleagues. I believe this is Yash. We'll shortly get him for a link as well. He's saying that the SEBI will likely consult exchanges on suitability criteria for F&O access. So up until now, the question was whether there will be weekly options expiry or not. But for now, there is some clarity or some belief that maybe weekly options expiry stays. So how else do you curb the sort of excesses that are taking place in F&O? Maybe for that, the SEBI will go ahead and issue a consultation paper which limits the eligibility of people who are able to trade in F&O so as to reduce a lot of the risk-taking abilities that people would have. So maybe you will have something like a direct or indirect equity exposure and the size of that as criteria for F&O trades where the speculative...
That's underlying cash market exposure.
In some form or the other, I guess, Yash will be best placed to that but theoretically speaking, there are just 3 things for which F&O is traded. One is hedging, the other is arbitrage, and the third one is speculation. So the speculating part is what the SEBI may want to curtail, and for hedging and, arbitrage, you would obviously need a counter position in cash or not. As of now, we've seen an impact of that on the BSE. Remember, the stock has been under pressure all through today's trading session. But if you pull up a 1-month chart, it's rallied from around 2480, 2490, all the way up to 2800. So it's not that the stock hasn't moved higher as well. So which is why on the basis of this news, there you have it. A 1-month move is 8%. So it's sitting on gains. But after this story, the stock has extended its cuts, now sitting with a cut of nearly 3.5%. And Angel One, which has always been under pressure in today's trading session because the weakness that came by in their last month's update, is, still sitting with a cut of almost 4%.
Yeah, absolutely. In Angel One, anyway, I mean, their monthly update was not that great, so that's an added issue. But I think we've got Yash joining in. We also have Pashupati. Pashupati, in fact, okay, Yash will come to us in 2 minutes. Before that, if we can get to Pashupati. Hi, Pashupati. It's a bit of a perfect storm, right, today. We have the rupee, we have a corporate deal breaking, and then we have, our own story on what the exchanges, or what the regulator, rather, may do to tighten up some of these norms and curb speculation, which continues to be one of the biggest talking points, I think, from SEBI's perspective. But first up, on this whole rupee business, Pashupati, would you link today's fall to the slide in the currency? I mean, how should we read life at rupee at 90?
Well, we've seen FPIs and OFSs coming, quite rigorously, and that has seen money going out of the country at 86, 87, 88. So, it's continuing to go out. I'm not seeing money coming in. And, somebody made a comment to me that on all the new issues, they should put in block letters on the front page that the OFS is how big versus the issue being that big, because people are feeling that the OFSs are now getting bigger than the new money for the company. So obviously these things are all telling a toll, but I don't think the story ends there, because the story also ends with the uncertainty of the trade tariffs with the US, the things that are going on in US, particularly in AI, and what that means for our IT companies. Today they've turned up, but I think that they've been hammered quite a lot in the last few days, and will, in my opinion, continue to be hammered. So, it is sort of cautious times, I would say. Surabhi?
Right, Pashupati, it's cautious times, but at the same time, the companies that are coming out with their paper, OFS or fresh, whatever be the case, it's the sectors are sunrise. The growth runway is fairly long, and oftentimes the ones who are offering their stake aren't offering the full stake. So they are, holding on to some, and in many cases, they're also doubling down in the anchor book after what they've invested earlier. What do you make of that?
No, those are the ones who are here to stay. But the reality is it is quite, what I'm seeing is a lot of outside money going back. And, maybe it's the US that's attractive, maybe it's Europe that's attractive, maybe it's another set of countries. But basically, I'm seeing, we've had a really vibrant market, and so it is an opportunity to walk away. Plus, there are mumblings from China that things are turning around over there. So a lot of our money will probably, take a breather and go into China. So, India funds will move to China funds, and India and Asian funds will shift from India to China. And I think I'm seeing a little bit of that as well.
Okay. All right, Pashupati, just hold on. We just want to address this story that Yash has broken a while back on fresh curbs to, limit speculation in the F&O market, particularly when it comes to retail investors. Yash, explain this to us, because when you want to dabble in F&O, you always need to cuff up margin. That margin requirements are always there, and there's been enough speculation on whether those margin requirements also might go up. But you're saying that there could be a whole new entry criteria, whether I, as an investor, can enter in the F&O market or not. So just explain this.
Well, exactly. The main intention from market regulator SEBI, as we understand at the pretext of it, is to safeguard retail investors when it comes to the risks and, risks which they don't understand of the derivatives market. What we've been given to understand, and it's been some time, that market regulator is discussing the concept of eligibility criteria itself, which essentially, restricts or allows an individual to trade into derivatives market. Under the eligibility criteria, the most discussed point right now amongst, of course, SEBI is to consider, making an individual furnish his equity exposure. This could be through mutual funds, this could be through PMS, this could be through direct equity exposure or SIPs. All put together, what is the equity exposure that a particular individual has, and only if that equity exposure is beyond a threshold which is likely to be decided by SEBI, then he would be eligible to trade into equity derivatives. This is currently being discussed so far, of course, within the boundaries of market regulator SEBI. What we understand is that this soon could be discussed with stock exchanges in terms of how to really decide this particular threshold. What will be this threshold, which if crossed by the equity exposure of an individual, he would be allowed to trade into equity derivatives. and then there could be a consultation paper on the eligibility criteria for individuals to trade into equity derivatives.
All right, we take that point. Like we said, hedging, speculation and arbitrage, hedging and arbitrage stay. Speculation is something that SEBI wants to curtail. Will be very interesting, Surbhi, because the point that you made, there is margin which is required upfront for trading in FNO already. My sense would be logically, I mean, from an exchange standpoint, this will obviously be negative because a large part of the volumes, a large part of the revenues come in for the exchanges, and that's something that we're seeing on the share prices as well. But what would be theoretically important to know when you're talking about the threshold is that for options there is something known as a delta, right? The rate at which the price of the option changes basis the price of the underlying. On that they can put that threshold. Delta could be that threshold. But for futures where the delta is 1, where the underlying changes just the way the futures changes, how do we put that threshold, and what threshold is good enough or what isn't good enough is something that'll be a very interesting one. So just as a market observer, this will be a very interesting conversation to watch if at all that comes by.
I hope it's as nuanced as what you're saying, that it's on certain positions or the delta or certain parameters. I hope it's not a blanket thing, because I can already sense the debates raging on social media. If it's a blanket entry threshold that Mangalam should have at least a 1 crore cash portfolio.
Not in this lifetime, for sure.
Cash market portfolio before he can do FNO. We don't trade anyway, so that was just a, in a lighter vein. But essentially, we need to see how this plays out. Pashupati, let's get your sense. Capital market stocks. In the earlier part of the year, they were very good wealth creators, and all this regulatory turbulence. I mean, do you still like anything? Do you own anything?
We obviously own. We're not exiting the market. We have to have something. But it's been tough, and I think that you can count the number of people who have made money this year on the fingers of 2 hands or maybe even 1 hand. Because I saw an article with all our big friends who have large portfolios, and all of them are in the red this year. So it's not a good situation, and if you don't make money, you're going to run away from the market. And I think we're getting to that point where people are getting a little bit sort of antsy, I would say the right word is, and they're moving away.
You have any buy tips, Pashupati, before we let you go? Anything to buy in this?
Sounding very pessimistic. Pashupati pessimistic. That's what we call you today.
Well, no, I don't think that. I think there are obviously going to be values. See, I actually believe that the government is going to continue to spend, and we have to be in infrastructure, but it's not going to be a here and now deal. They are going to spend, they're going to spend. We have to be in cement, we have to be in steel, we have to be in aluminum, precious metals. Those are the stocks. That's the half of the index that's going to drive the whole market. Now, it will go up and down, but the reality is we need all these commodities for our growth. The government is fueling it. Private companies are also coming into the space. So that's where we have to just buy and pray, I would say.
All right, buy and pray. It sounds like some of that is rubbing off on the markets right now. The Nifty has reclaimed that 26,000 mark. So that's the headline for this hour. Thank you, Pashupati, for joining in. You put some pessimism, but you put some optimism as well. The Nifty is actually just about breaking into the green, as is the Sensex. The Nifty Bank, when we just, spoke about 5-7 minutes ago, the HDFC Bank stock doing extremely well. The Nifty Bank is now fair and square in the green, almost 120 points up in the green. HDFC Bank is the one which has crossed the 4-digit mark in today's trading session, taking the Nifty Bank higher. The Sensex is in the green, the Nifty just about 35 points in the red. Good time to get in D Street chatter. Nimesh joins us now. Nimesh, there has been a good recovery from the lows. What's your sense? What's exactly happening in the dealing rooms?
Well, Mangalam, it looks like it's a bit of a surprise that we've seen a sharp recovery in the last 15-20 minutes of trade. Why I'm saying surprise, because the pressure in the last few days is largely dragged by the FI selling. And even today, the sense is that there is selling pressure from larger FIs, especially in the broader market. So that's been a big underperforming space, and that continues to see a lot of pressure, and there is a lot of pain as well as far as the broader markets are concerned. Today, for specifically, the PSU banks are under pressure because there was enough clarity that there is going to be no hike in the FDI limit, and that's the reason we have seen a bit of profit booking there after some bit of rally in that space. So that stands out in today's market. But I guess, while Nifty has seen a bit of a recovery, I guess the bigger story is the pain in the broader market, and that seems to be still not ending or not abating. So that's a real pain point. If you ask any dealer or a trader or an investor, the cribbing point is that while Nifty is at all-time high, close to all-time high, their portfolios are down 15, 20, 30, 40%.
Take that point. And what about the interesting stocks that you have today? Any more large trades likely?
Well, that is likely, but the first stock on my list today is Kiri Industries. After a long time, some traction on that stock. It's up 6% in a weak market. And for the last few days, there is a bit of accumulation as well happening at HNI desk. And for Kiri Industries, the big trigger to watch would be as and when they get the money from the Dystar stake sale. The legal formalities are over, only the inflows has to come. So that's something to track as far as Kiri is concerned. The second couple of Adani Group stocks, again, it stands out because after a long time, though small, but there is delivery-based buying in Adani Green as well as in Adani Power today. More so in Adani Power, but for Adani Green, also the fact that there is a large block anticipated in the next few days. So that's something to track there. The third name is Semi India Projects, which is erstwhile ITD cementation. For the last 2 days, the stock is under pressure, but overall, if you look at this year, the stock is relatively outperformed the broader market names. And the big buzz for this particular company is that they're likely to bag a very large order very soon. So that's something to track in Semi-India Projects. And the last is Aeroflex Industries. Again, a small stock. There is a bit of institutional owning as well, but I understand the company is likely to raise further money via QIP very soon. It's a small amount they're going to raise, but nevertheless, fundraising is on the corner for Aeroflex Industries.
Okay, all right. Nimesh, thanks very much for all the buzz as always. We'll take a quick break on that note, come back on the other side, and we'll, of course, get to the final trading calls with Mitesh, and we'll have Mayuresh Joshi join in with some final fundamental ideas.
Well, there is important update coming in on the Sanchar Sathi app. The government has removed the mandatory pre-installation of the Sanchar Sathi app. Remember, once this was announced, the pre-installation of Sanchar Sathi app, there was a fair amount of backlash, concerns around data protection and privacy, etc. So yesterday afternoon, we got the news that the government has actually allowed for people to delete the app once it was, installed. But now the mandatory pre-installation of Sanchar Sathi app itself has been removed. So that's the latest that we have on that one. Obviously, we heard from a bevy of experts as well as the telecom minister himself on the views around the Sanchar Sathi app. But now what we know is that the government has removed the mandatory pre-installation. So that's positive. Just keep an eye out on the markets though. There has been a stellar amount of recovery. The Nifty just beneath that, just below that 26,000 mark. But, the recovery in the private sector space, private sector bank in particular, has been notable. We've been speaking about HDFC Bank. Take a look at ICICI Bank. Remember, these two stocks were most sold in yesterday's trading session on fears that the weightage on the Nifty bank being capped would lead to a lot of stock outflow and passive fund outflow. But today they're bouncing back in style. So ICICI Bank, HDFC Bank, Axis Bank. In fact, all through the first half of trade, we had the IT stocks which were outperforming, contributing the most to the Nifty. But the second half of trade so far, the recovery has been led by the IT not falling beyond, its highs through the day, and the private sector banks coming up as well. So, and that's something that we can see in the contribution chart as well. Earlier it was TCS, Infosys, Wipro. Now it's ICICI Bank, HDFC Bank, TCS and Infosys. That means that the Nifty's cut is just about 50 odd points. Let's get in Mitesh. He's with us for the tomorrow trade. Mitesh, there's been a good recovery. What's the trade for tomorrow?
I think, I'll go with a couple of long positions. Dr. Reddy has come on my radar. I think that's closing well. Take a BTST here at the stop at 1270 for targets of 1300 or 1305. And APL Apollo, I think that's a stop. It's correcting now. It's trying to reverse. So that's a BTST as well. Keep a stop at 1739 for targets of 1766.
All right. So that's the tomorrow trade coming in. We also have Mayuresh Joshi joining in right now. Mayuresh, good afternoon. Do you think from an underperformance, now this tailwind that has come in from the rupee that makes IT stocks a little more attractive, or would you say that the overarching theme of a weakening rupee is not particularly good for the Indian market, so I won't even touch IT?
Afternoon, Mangalam. Now, obviously, I think it does aid and assist earnings flow sentimentally as well as technically to a certain extent for export-oriented sectors, including IT, as they will report a large part of their of their revenues, offerings, and services in dollar terms. But to a large extent, again, Mangalam, I think a large part of that is hedged and pegged to a certain value. And therefore, I think the rupee depreciating might not mean that they get the full-blown benefits of the rupee against the dollar at 90, but partially thereof. And therefore, I think how long does this slide persist is also one thing to be noted. However, from a sectoral perspective, our own sense is that though large cap IT seems to be valued attractively compared to mid cap IT, the mid cap commentaries have been far more resilient and their earnings delivery have been far more robust compared to large cap IT. The expectations largely heading into Q3, largely impacted by furloughs, and Q4, where decision making will become a paramount factor for the sector as a whole. Mid-cap IT commentaries in terms of order wins, pricing, relative EBIT performance expected, and the scaling up in terms of their AI platforms is something that is aiding their accentuated valuations compared to large caps. So in our opinion, I think it does help them partially if it persists for a longer period of time as the quarter ends. But mid-cap IT selectively, stocks like a Kofo or Genesis is persistent, where the performance was exceptionally good in Q2, might continue doing well, even if valuations might be a tad bit higher compared to the large cap.
Got that. Mayuresh, hi, afternoon. I'm just looking at Angel One on the screen right now. It's falling a little more, 5.5%. I don't know if you caught their update, the monthly business update. The stock was anyway down from the morning, and then this latest news has come in on maybe some sort of an entry threshold, some barrier for retail from getting into F&O. Your thoughts? Specifically on Angel One or anything else that, maybe on BSE as well, actually, even that stock's under pressure.
Afternoon, Surbi. No, again, I think the monthly updates were again on the softer side. And what really has transpired since the expiries have not got curtailed to exchanges at one per exchange, I think it has really impacted volumes. Now, Angel One's large part of the client base is retail, and predominantly out of that, it is majorly F&O. So to that extent, you're probably seeing that volume come off quite significantly. And with that, I think it's a cascading effect in terms of all numbers that are associated. Obviously, they are trying to diversify, both in terms of their PMS offerings, wealth management offerings as well. But to a certain extent, I think a large part of the revenue pie still came in from F&O trading. And therefore, an impact thereof does have an impact in terms of the client additions and all other parameters associated with that. So at this moment, a neutral call on Angel. But for the platforms itself, I've been very, very optimistic on MCX, and that stock has performed exceedingly well. My take is that with the volatility that you're probably seeing in gold, silver prices, the expectations in terms of volatility also expected to come through in terms of natural gas, new contracts getting added, functionalities getting added, might actually get revenues going forward.
All right, Mayuresh, what we'll do is we'll take a short break, come back, continue our conversation and track the closing of the market as well. There has been a firm amount of recovery, but as the Nifty moves towards that 26,000 mark, supply emerges again.
Welcome back. Down to the last 3 minutes of trade. So let's quickly throw it open to Mayuresh. Mayuresh, any ideas? Buy, sell? It's a confusing market out there.
No, we're still on the buying side, should we? So I think Vishal Mega Market, something that we continue liking. Our own sense is that the discretionary spending patterns will be even more profound as we head into Q3, Q4. And therefore, the format that they probably got in terms of apparels, FMCG and other FMCG, the margins that they probably posted in the quarter gone by and the stability expected in margins, the commentary sounded very, very positive in terms of realization, volume growth, the calibrated expansions also working in their favor. Therefore, Vishal Mega Mart, from a rating rankings perspective, as we see it in Markets With India, looks attractive. One of the other stocks that we've kept on our watch list and on our radar is Apollo Tyres. Our take is that the MHCV segment is turning for the better. And both MHCV and NCV, as they turn for the better, the expectation in terms of tire volumes from the OEM segment should start picking up meaningfully. It's got a meaningful presence with 40-45% coming in from the tires. Sorry.
All right, Apollo Tyres, the stock's been doing well. Just as we move, the last tick on Sapphire Foods is something that we need to watch out for. The stock is ending at the high point of trade in an otherwise very wobbly market where the mid-cap index is down about 1%. Sapphire Foods, the street is expecting some sort of corporate arrangement between Sapphire and Devyani at some point. This has been the rumor for months now. So the price is telling you, let's keep an eye out on something that comes by. But let's wrap up on this edition of Closing Bell with the news of the market. In fact, let's start wrapping up. The Nifty going with a cut of almost 40 points, but it could have been much worse. There's a recovery of nearly 100 points from the lows, closing just closer to that 26,000 mark. The headline of the day obviously would be the rupee crossing that 90 mark to the dollar. The Nifty banks shown remarkable recovery led by the private sector banks. Public sector banks were still lower, and the broader markets. Out there, we had nearly 2,000 stocks which ended in the red for about 900 stocks which were in the green. Among the top gainers on the Nifty, we had the private sector banks and the IT stocks. On the top losers, we obviously had a couple of these FMCG stocks, Tata Consumer, we had Adani Ant, BEL and Shriram Finance.
Absolutely. I think on the mid-cap screen, overall pain for sure coming through, 1% lower on the indices. Two sectors stand out. A lot of profit taking in PSU banks, which have had a great rally for the better part of this year. So names like Indian Bank, PNB, all of them were down 4-5%. The PSU, look at the PSU banking index, it's shed 3% today. And aside of this was the capital market space. If we look at the final tally on stocks, then Angel One 5.5% lower, Motilal 3.5% lower, BSE itself falling 3%, and MCX finally ended with a cut of about 0.5%. So not such a bad day for the large cap screen, but yes, pain in the broader markets.
We wrap up on this edition of Closing Bell, and stay tuned. Our special coverage on the rupee, which was the headline of the day, continues on the other side. Stay with us.
The rupee recovers after breaching the psychological 90 to $1 barrier for the first time amidst incessant dollar buying by foreign funds. Dealers cite limited intervention by the Reserve Bank of India. The rupee has now fallen by almost 2% compared to the dollar in the last 2 weeks.
Markets close in the red, but have bounced sharply off their day's lows. Private banks and IT stocks lift D-Street amid a broad-based decline. Nifty holds above its 20-day moving average.
E-commerce platform Meesho's over 5,500 crore rupee IPO is fully subscribed on the first day itself. The retail portion gets booked out in the first hour, but a higher allotment to local funds draw the ire of some global investors who walk away from the anchor book. Hello and welcome to this special show. I am Hormuz Fatakia, with me Ritu Singh, and we'll focus today on the rupee as it breached the critical 90 per dollar mark. Ritu.
We will focus on the rupee, and over the next 30 minutes, we're going to unpack why the Indian currency is under pressure and what this means for various sectors. But before that, Hormuz, take us through the day's market action to begin with.
Well, it was a very choppy day indeed, but the bulls would be a happier lot considering how the closing turned out to be. And they would owe a profuse amount of thanks to a lot of the private lenders, ICICI Bank, HDFC Bank, Axis Bank, and of course the IT names that ensured that the losses in the first half of the session were curtailed. And then the recovery began. It was Infosys, TCS, Wipro, they led the recovery as well. And the private sector banks, HDFC Bank ending at the highest point of the day, ICICI Bank ending at the highest point of the day, that contributed to the Nifty recovery. Although the index ended in the red, there are no doubts about that. But we go into the penultimate trading session of the week, as in the weekly expiry for the Sensex contracts tomorrow, on a much positive note compared to what we were somewhere around 1:30 this afternoon, Ritu.
Well, then let's talk about what's been souring that sentiment, and that's the Indian rupee, which has now slipped past the psychological 90 per dollar mark for the very first time, hitting a fresh record low this morning. Opened at 89.96 and then quickly slipped to that 90 level with little to no RBI support really coming in. We've seen a depreciation of almost 5% this year as foreign capital continues to flow out of India. That coupled with the trade deficit numbers, the subdued domestic equities, and importantly, the lack of any progress on the US-India trade deal, all weighing on the sentiment as far as rupee is concerned. The decline is also raising concerns across multiple sectors, but for some, there is a bit of an upside. Let's go across to our team of researchers who are standing by to decode the impact of the shift on key Indian sectors. But first up, we go across to Lata for her editor's take. Lata.
Well, first up, the support for the rupee came towards end of trade, late trade, not really end of trade, the last one and a half hours, with the market giving support. That's very important. It was not because the Reserve Bank lent a horrendous amount of, sold a horrendous amount of dollars at 90.29 that the rupee went towards 90.11 after that. It was because there was an exhaustion of selling. That's how usually bear markets end. But that exhaustion of selling was probably triggered because of the chief economic advisor saying that he is not losing sleep over the rupee's fall. I mean, is this not the best of times for the rupee to fall? Considering that, even if prices go up, we are not worried about inflation at this juncture. And that he expects a rebound very soon, probably next year. That was used as a trigger. But really, there was an exhaustion of selling also, because how many times do you sell over the same news? We all know about the October trade deficit. We all know that the trade deal has not come in. We all know that there is a BOP deficit for probably 2 years in a row. The BOP number for the second quarter came on December 1st, and that triggered the accelerated selling on 2nd and 3rd of December. But now all that is priced in. So with Reserve Bank and government both saying that, okay, let the market take its course, perhaps, the bears, the rupee bears came in and covered their rupee short positions, or the dollar longs were unwound. The market is now convinced that the RBI also wants a market-oriented solution to the trade deficit. Once you let the rupee cheapen, then obviously exports will improve because they're price competitive, and imports become expensive. Anything has to be multiplied by, 90 rupees plus for a dollar. And that makes everything from textiles to T-shirts to, pharmaceuticals more expensive to import. That's the best competition you can have for the Chinese flooding. By the way, we must remember, we keep talking about the dollar rupee. The rupee to renminbi used to be about 11 up until like a year ago. And now it is 12 rupees 80 paise to buy a renminbi. So that also is a protection against, Chinese flooding. And finally, perhaps the view must also come to the market that a lower currency is actually a protection for the economy. It's almost like a rate cut. It gives domestic producers more breathing space. The message today is that the market has found its own level. That is why today's recovery of the rupee, albeit mild, is an important takeaway.
It's an important takeaway indeed. 90.19 the tick on the rupee. Lata, thank you for breaking that down for us. But let's now go across to our team of researchers to understand the impact of this currency weakness on various sectors. Rima first on the IT companies. Rima.
Thanks so much for that. So, before we get to INR depreciation, once again to reiterate that the Indian IT sector has been an underperformer. Year to date, the Nifty IT index is down 13%, though it started recovering from the 52-week lows. So from the 52-week low, the index has recovered more than 20%, but it's still down year to date. And from its all-time high level, Hormus told me it's down close to about 18%. So, one of the drivers for the sentiment today is the INR depreciation. Typically, the simple math tells you that a 1% rupee depreciation benefits margins by about 25 to 30 basis points. But then again, it depends on the kind of hedge ratio companies have. But outside of that, one reason for the increasing optimism surrounding or why IT stocks and shares are seeing a look in is the underperformance, and also now the AI infrastructure. The global AI trade is moving from infra build out. They're saying eventually maybe that's going to peak out at some point of time. There is diminishing marginal utility, and the focus will shift to application services and maintenance. And this will unlock net AI revenue for the sector 12 to 18 months down the line. And plus, yesterday when we were talking to experts, they're saying assuming the Indian IT companies grow by 5-6%, plus you throw in a dividend yield, that makes it fairly attractive, and therefore it's time perhaps for to take a look in at the sector.
All right, so that's the IT sector. Next up, we have Sonal, who's tracking the impact on both oil and gas and the chemical companies. Sonal, take it away.
Thank you for that. Well, it's a mixed impact on the oil and gas space. Let's start with the crude producers because they tend to see realizations in dollars, so it'll be a benefit for them. For every 1 rupee depreciation, they will see an improvement in their EPS by 1 to 2%. This is ONGC and Oil India that I'm talking about. If we talk about Petronet LNG, their regasification margins, basically they re-liquefy the gas. These are dollar linked, so every spread that they earn on that will be beneficial for them, and that could improve their EPS by 1 to 3%. For oil marketing companies, it will be a mixed bag, but do remember that refining margins will see an improvement because diesel cracks, petrol cracks, they are doing really well right now, but they also import a lot of crude. So it will be an impact of 11% on their EPS positively right now, considering the macro situation that we are in. For city gas distribution companies, it will be a negative because they do import LNG, and that is a big part of their overall input, and that will have an impact of around 4 to 11% on their EPS, be it Gujarat Gas, Mahanagar Gas, or Indraprasth Gas Limited. For chemicals, the basket is huge, but specific stocks which tend to benefit because they are big exporters to the US, something like an SRF Limited, Naveen Fluorine, Atul Limited, all of them have big exposure to the US markets, and they tend to benefit because of this depreciation that has come by.
Sonal, thank you for breaking that down for us, for the OMCs, for the upstream companies, and for the city gas distributors, and for the chemical companies as well. Now, from a whole host of sectors, moving to pharma, Ekta is here to tell us about the impact there. Ekta.
Well, yes, the overall feedback with regards to the rupee depreciation and the pharmaceutical companies is that it is short-term impact, and the impact of the rupee depreciation is limited, but could be largely positive dependent on the mix that you have when it comes to exports to other countries such as the US, along with the imports that you import, such as APIs. Now, most of the Indian pharma companies hedge their USD exposure at this point in time. There hence will be a temporary gain in terms of realization of export sales, and prices are later renegotiated to account for the depreciation. Input costs will be something that one needs to actually look for. It is possibly around 40 to 60% of sales for some companies, but how much of that gets negated based on the mix that they have in terms of exports is something that each company would have in terms of a different mix. Largely, you will expect some amount of negotiation which will take place with vendors going forward to account for the rupee depreciation. But as of now, when is this possibly going to tangibly show in terms of the exports as well as possibly in terms of the inputs is most likely towards Q3 and Q4.
All right, so more of a temporary impact as far as the pharma sector is concerned. Next up, we have Sudarshan. Sudarshan, how is it looking for the automakers?
It's not really that bad news for the auto sector, especially from two-wheeler names. TVS Motor and Bajaj Auto are the biggest beneficiaries. For TVS Motor, 30% of their total volumes come from exports, and to total revenue, export forms in the range of 25 to 26%, so they are expected to benefit. Next name comes is Bajaj Auto. Almost 50% of their revenue comes from exports, and in Q2 FY26, dollar realization was 87.10, and they did gain on that front. Now in Q3 FY26, I did the calculation of last 2 months, and now the realization has increased to 89.10. And the management, while talking to CNBC-TV18 today early in the morning, they said that if there is a fall of 1 rupee, it improves or it lifts annualized EBITDA by rupees 200 crore. So now with realization increasing to 89.10, the positive impact can be in the range of rupees 350 to rupees 400 crore on annualized basis. Coming to auto ancillaries, 3 names I have taken: Bharat Forge, Samvardhana Motherson and Uno Minda. So for Samvardhana Motherson, rupee fall is marginally positive. So 65 to 70% of their revenue comes from export, but they have manufacturing base in the Europe and the US, so costs are also going to increase, so that will be offset by the cost increase. So benefits will be offset by cost increase. Coming to Bharat Forge, almost 60% of their revenue comes from the export segment, and they majorly have 3 segments: forging business, PV and EV components, and Class 8 truck orders. So they are going to be the biggest beneficiary as far as auto ancillary pack is concerned. Last one is Uno Minda. Rupee fall is going to impact negatively. It would be a negative impact for Uno Minda because for them, majority part, or say 70% of their total revenue comes from domestic segment, and they are dependent on imports of the components. They import chips and whole host of other components. So costs are going to increase, and it will have a negative impact. But overall, it's going to largely have a positive impact as far as auto sector is concerned.
All right.
You know, the softly devaluing rupee is very beneficial, as you said, to a company like ours, which has got almost 50% of its revenue coming from international sources. So it's very, very helpful. Well, you know, on an annualized basis, every 1 rupee creates a EBITDA impact of 200 crores plus, you know, because our exports are over $2 billion.
Okay, on that note, we're going to slip into a short break, but don't go anywhere. We'll get you what experts have to say about the depreciating Indian currency. Stay tuned for that and more.
Welcome back to this Rupee special show. But before that, let's take a look at the big newsmakers of the day. E-commerce platform Meesho's 5,000 crore rupee IPO was fully subscribed on the first day itself. Retail investors have shown a strong interest in the offer. Their portion is subscribed almost 3 times. The quota allocated for non-institutional investors has also been fully subscribed. The e-commerce major raised close to 2,500 crore rupees from anchor investors ahead of the IPO. Now listen into what their management had to say.
We as a company look at free cash flow as the right bottom line metric. Any company textbook definition of valuation is the net present value of all your future cash flows. And as a company, we've been the most capital efficient asset light company, right? Like to kind of reach a lot of milestones in our business, we've actually spent the least amount of money as compared to many other e-commerce companies in India. And we take pride in that. We continue to kind of optimize for free cash flow. If you look at the last 2 financial years, we have been positive on free cash flow. For the last financial year 25, we generated almost 1,000 crores of cash. And even forward, I think we will continue to kind of keep looking at that while doing capital allocation within the company.
If you look at the use of proceeds, we are raising these for the next 3 years. I think that is our estimate of what is the spend going to be in some of these headers for the next 3 years. And if you look at the historical trends, as we have grown consistently, some of our fixed cost base, such as our server infrastructure and other kind of fixed cost line items, including employee cost as well, have not grown at the same path or at the same pace as our overall top line growth has been. So operating leverage is a key metric that we would kind of keep tracking. Our fixed cost base, let's say historically, the server cost grew by only 4.5% when we grew at about 35%. And we'll keep maintaining that going forward as well.
All right, in other news, the Cabinet Secretary has called for a meeting of Finance and Telecom Secretaries on Vodafone Idea's AGR dues, that case tomorrow. Now, sources tell us that the Finance Ministry is going to hold an internal meeting today on Vodafone Idea ahead of the meeting with the Cabinet Secretary tomorrow. The Telecom Department Secretary is also likely to be present at this meeting at the Finance Ministry.
And continue to focus on the currency. Earlier today, we spoke to former MPC member and economist Ashima Goyal and V. Lakshmanan of Federal Bank as the rupee has now declined 5% to a record low of 90.29 before that minor recovery towards close. The backdrop for an RBI policy due on Friday. Listen into a slice of that conversation.
Well, the MPC under flexible inflation targeting is not supposed to look at the rupee, only at inflation and growth. And I think last year there was very little movement in the rupee. And this regime, they have taken the call to let it float with market movements. But preventing the old for a long time, RBI's policy has been to prevent excess volatility and persistent real misalignments. So I think they still come in when it is getting too far away from equilibrium. So, and this regime is working. They have reserves and other ways of intervention. So the interest rate is not tied to the rupee. The interest rate has to respond to domestic inflation and growth.
Okay, no, I agree that the Reserve Bank and the MPC members have repeatedly said that they are an inflation targeting central bank and it will be governed by domestic factors of inflation and growth. But this is dramatic enough to upset growth calculations as well. It will impinge on inflation to some extent because imported elements are going to become expensive. So it's not that it doesn't have a macro impact, and it's also a financial stability question now. When given the rapidity, it's a 2% fall almost since November 18th. When the October trade deficit was announced, we realized it is a 1-month high, and since then it's been a near 2% fall. So won't this make the currency take center stage because of financial stability issues?
I have seen always, crises like the global financial or taper tantrum, that it passes and there is a reversal of the outflows. And most of these outflows are driven by global events. And the reserves are used and other policies are used to smooth rupee volatility. And then whatever loss of reserves there is made up later on.
Okay.
So I don't think there is any sort of major financial stability concern here.
Just yet. Okay. Mr. Lakshmanan, what are your treasuries awaiting from the Reserve Bank? Will you all want a statement from the RBI governor on the currency? Will a rate cut make it a little worse? I mean, I know people don't come to us because of the rate differential, but in this year, debt flows are positive, equity flows are negative. Will a rate cut make even debt flows negative? Can that be a fear?
Yeah, so thanks for having me here. Firstly, alluding to the point which Madam Shima well said, one, RBI has, of course, never really brought in currency as a core factor in its monetary policy statement dissemination. A side eye would always be there. To which extent the policy will definitely take cognizance of that, and to which extent a rate outcome that's going to come later this week will definitely be looked into. Having said so, in as much as we as bankers may wish a commentary on the currency to be brought out, I would state that yes, the fact that the rupee has weakened above 90 would be noted, but the policy statement would clearly again hinge upon the broader parameters of inflation and growth in the wider statement that's going to come by. And that is, I think, is going to be the statement.
What kind of a statement are you expecting, Mr. Lakshmanan, from the governor on the rupee? What kind of a statement can boost or help the market, you think?
No, so one, again, as I stated, I don't think there's going to be a boosting statement coming in from RBI in any manner on the rupee. Okay. It's just going to record the fact that the rupee is weakened beyond 90 in any fashion, if at all, to the maximum. Nothing beyond that, in my view.
Okay, and on that note, we're going to wrap up this special show on the rupee depreciation. Thanks so much for watching. From Hormaz and me, it's a goodbye, and thank you so much for tuning in. Stay with us. More news and updates will continue after this break. Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the rupee recovers after breaching the psychological 90 to $1 barrier for the first time in history amidst incessant dollar buying by foreign funds. Dealers cite limited intervention by the RBI. The rupee has now fallen by almost 2% versus the US currency in the last 2 weeks. The government's chief economic advisor, Anantha Nageshwaran, says he's not losing sleep over the weakening rupee, expects a rebound next year, adding that current levels are not hurting exports or inflation. The Sensex and the Nifty end marginally in the red after a late recovery. The Nifty drops below 26,000. Mid-cap see sharper cuts today. E-commerce platform Meesho's 5,400 crore rupee IPO fully subscribed on day one. Retail portion gets booked in the first hour, but higher allotment to local funds draw the ire of some global investors who walk away from the anchor book. CNBC-TV18 News break confirmed just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. After backlash, a U-turn by the government on Sanchar Sathi app withdraws the directive to phone makers, making it mandatory to preload the state-owned cybersecurity app on phones. India and Russia all set to bolster economic ties when President Putin arrives in New Delhi on a state visit tomorrow. India to push for increasing pharma, agri and textile exports. Prime Minister Modi and President Putin would also discuss a free trade agreement which could be signed in the future. The Kremlin calls the meeting between President Putin and US envoys Witkoff and Jared Kushner as constructive, but both sides are no closer to a resolution. President Putin accuses Europe of preventing peace, says if Europe wants a war, Russia is ready. Maruti Suzuki steps up the electric vehicle push, plans 1 lakh charging stations across India by 2030, promises several new launches as it outlines an expansive electric mobility roadmap. Amazon throws down the gauntlet to Microsoft, Google and the entire AI ecosystem, announces the next generation of chips, large language models and AI agents at its annual Amazon Web Services Summit in Vegas. Well, the big story we're tracking this evening, and it is the currency, the rupee breaching the psychological 90 to $1 barrier for the first time ever. Dealers cite limited intervention by the Reserve Bank and incessant dollar buying by foreign funds. The rupee has now fallen by almost 2% against the dollar in the last 2 weeks itself and by 5% so far in 2025. However, the rupee did see marginal recovery before it closed. For trade, Lata joins us now with more on the rupee. 90.19, the dollar rupee, that's where it closed for the day. Lata, the kind of free fall that we have seen, especially in the last 2 days, Lata, what do you make of it?
Well, first up, the support for the rupee came towards end of trade, late trade, not really end of trade, the last one and a half hours, with the market giving support. That's very important. It was not because the Reserve Bank lent a horrendous amount of, sold a horrendous amount of dollars at 90.29 that the rupee went towards 90.11 after that. It was because there was an exhaustion of selling. You know, that's how usually bear markets end. But that exhaustion of selling was probably triggered because of the chief economic advisor saying that he is not losing sleep over the rupee's fall. I mean, is this not the best of times for the rupee to fall, considering that, you know, even if prices go up, we are not worried about inflation at this juncture, and that he expects a rebound very soon, probably next year. That was used as a trigger, but really there was an exhaustion of selling also, because how many times do you sell over the same news? We all know about the October trade deficit. We all know that the trade deal has not come in. We all know that there is a BOP deficit for probably 2 years in a row. The BOP number for the second quarter came on December 1st, and that triggered the accelerated selling on 2nd and 3rd of December. But now all that is priced in. So with Reserve Bank and government both saying that, okay, let the market take its course, perhaps, you know, the bears, the rupee bears came in and covered their rupee short positions, or the dollar longs were unwound. The market is now convinced that the RBI also wants a market-oriented solution to the trade deficit. Once you let the rupee cheapen, then obviously exports will improve because they're price competitive, and imports become expensive. Anything has to be multiplied by, you know, 90 rupees plus for a dollar, and that makes everything from textiles to t-shirts to, you know, pharmaceuticals more expensive to import. That's the best competition you can have for the Chinese flooding. By the way, we must remember, we keep talking about the dollar rupee. The rupee to renminbi used to be about 11 up until like a year ago. And now it is 12 rupees 80 paise to buy a renminbi. So that also is a protection against, Chinese flooding. And finally, perhaps the view must also come to the market that a lower currency is actually a protection for the economy. It's almost like a rate cut. It gives domestic producers more breathing space. The message today is that the market has found its own level. That is why today's recovery of the rupee, albeit mild, is an important takeaway.
Well, Lata, we'll have to see if the rupee holds this level. Thanks very much for joining us. New record low for the rupee today. But let's talk about the stock markets, which also staged a recovery in the last hour of trade. The Sensex and the Nifty ending the day with marginal losses. The Nifty dropped below the 26,000 mark, but it did manage to defend the 20-day moving average, finally closing 46 points lower, 30 points lower on the Sensex. The Nifty banker just about in positive territory. The cuts were really coming in on the mid-cap side. That index down by about 600 points today. So that's where you saw the big moves. But the big newsmaker this evening, with less than 2 months left for the union budget, India Inc.'s wish list is only getting longer. Will exporters roiled by Trump's tariffs get any special attention in the upcoming budget? Will the recently notified labour code give Indian manufacturing the much-needed fillip? And what is India Inc. expecting from the RBI policy this week, and also from Russian President Putin's visit? To speak about all of that and more, we're now joined by Anant Goenka, who's just taken charge as the president of industry body FICCI. Anant, many thanks for joining us here on CNBC-TV18, and congratulations on taking over as president of FICCI. To start with, Anant, let's talk about the rupee. It's great to have you on a day where we've seen the rupee move, breach that $90 mark today, Anant. What's the mood within industry? As we've been arguing here that a depreciating rupee could perhaps be good as far as competitiveness is concerned, but the extreme volatile moves that we've seen specifically in the past few days, what does industry make of it?
Right. I think, as was highlighted, largely we've let market forces determine, as RBI and the government has been mentioning. To that extent, I would say exports have become more attractive. Chinese imports may become a little bit more expensive. I think large volatility is obviously something of a concern. But overall, I would say no major impact to industry. I think it's a positive from an export point of view. And I think it's more about the RBI taking a decision whether they would like to intervene or not. And I think their decision is absolutely fine.
Well, speaking of the RBI, we've got the MPC meeting coming up. Anant, what's the expectation? Is industry hoping for a rate cut? Hope, of course, is always on the table. But do you believe that a rate cut is likely this time around, given the fact that we've seen some very strong GDP numbers come in as well?
Right. I think inflation has been under a fair amount of control, better than expected numbers. Government is gearing for growth. In light of that, from our side, we would say 0.25% basis, 25 basis points cut is very welcome. And that's what industry is rooting and hoping for.
Okay, that is what industry is hoping for, another 25 basis point cut. The big development tomorrow, President Putin is going to be here in India, both sides hoping to further deepen their bilateral engagement, bilateral relationship, including economic cooperation. What's the expectation that industry has on this front?
India has always maintained its position of strategic autonomy. And to that extent, it is for us, or as industry, we are looking at strengthening our defense ties. This is something which we are already intertwined as two countries, and that is always going to continue in the longer term because of the strength between the two countries. It's a time-tested partnership that is there. We will be looking at seeing how can we supply more into Russia and vice versa. The obvious areas are engineering products, pharmaceuticals, IT, and so on. I think one concern on industry side is always going to be with respect to sanctions and that risk. But I think from an industry side, if the opportunity is there, we'd be very happy to look at Russia as a larger market to strengthen our relationship with.
You know, you talked about sanctions, and that brings me to the issue of U.S. tariffs and the possibility of a deal with the U.S. It was the FICCI AGM where I spoke with the Commerce Secretary, and he, for the very first time, said that there are two parallel negotiations underway with the U.S. But is hope now fading for either of the two deals to go through with the U.S., one to deal with the reciprocal tariffs and the other to deal with the larger bilateral trade agreement?
I think not at all. I'm still very hopeful of a deal happening. Commerce Secretary also was fairly positive that a number of the points have been discussed. It is hopefully a matter of time, and a deal is likely to be around the corner, although you never know till last minute or till the deal is signed that it's going to happen. I think on both sides, there have been some concessions, but India has very clearly stuck on its sensitive issues, always putting the country first. So to that extent, I'm hopeful that a deal will be signed, and that will be great for whether it is the rupee and an end to the tariffs that would be very good for certain industries.
Yes, the wait continues on that front. But speaking of suspense and the wait for the budget is on. Pre-budget consultations underway, and I know that FICCI's presented its budget wish list. What are you baking in terms of expectations, the top three priorities that you believe the government must focus on, Anand?
I'd say one is Atmanirbharta. I think continued focus on investing in defense. There is a large change that is happening with respect to technology on the defense side, and we need to continue to invest on that front. We've asked for a 30% increase in capital investment on defense expenditure, a 10% increase on operating expenditure, and about a 10,000 crore outlay on DRDO-related investments. The second ask is on export promotion. There has been the export promotion mission that has come about, various corporate guarantee schemes, but RODDEP, we feel the outlay is still too small. We have recommended an increased outlay on RODDEP. The third is the critical minerals program that has come about. On that, there is a minerals tailing recovery program that we are recommending, that use of fly ash, leftovers of the mining. How do we use technology to tap critical minerals out of the tailings? So a critical minerals program is something that we are recommending. And finally, on the electronic side, we've seen great headway and progress over the years. This is a space where we are recommending India's largest IT industrial park, where you can have the entire value chain in one place, increase the value addition, have OEMs and assemblers all together in one place, much like the model that we've seen in Shenzhen or Vietnam. I think that will further propel growth of the EMS sector.
All right, well, we'll have to wait till for the 1st of February. It's a Sunday, but let's see if the budget is going to be on the 1st of February, and all will be revealed then. Anand Goenka, once again, wish you the very best of luck for your new innings, and thanks so much for joining us here on CNBC-TV18. That's the president of FICCI with his budget wish list and more. Time for us to head into a break, but up next, just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. That and more when we return. E-commerce platform Meesho's 5,000 crore rupee initial public offer was subscribed over 2 times on the first day. Retail investors showed strong interest in the offer, with their portion being subscribed 3.59 times. The quota allocated for non-institutional investors was also fully booked. The e-commerce major raised close to 2,500 crore rupees from anchor investors ahead of the IPO. But the big global story, a CNBC-TV18 News break now confirmed just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. Nigel is here with the details of the deal and why the market seemed a little disappointed when the news initially broke. Nigel.
Well, that's right. A big deal coming in from JSW Steel, with JFE going ahead and picking up close to around 50% stake in BPSL, and for an equity value of around 15,750 crores, which would mean that the total assets equity value will be roughly around 31,500 crores. You put in there a debt of roughly around 5 to around 6,000 crores odd. So the enterprise value that this deal is being done at is roughly around 37,000 crores or thereabouts. Remember, BPSL, they had a debt of around 5,000-6,000 crores odd, and also in the first half of the year, the total EBITDA that they did was roughly around 1,500 crores, which means that for the year, on an annualized basis, they could do around 3,000 crores. Valuation-wise, well, the deal appears to be done at around 12 times EV on EBITDA, which is fair. Pretty good valuation actually is what they have got. How does the holding structure change? Well, as of now, the promoter entity of JSW Steel had in their personal capacity close to around 17% stake in BPSL. And the listed entity, JSW Steel, had close to around 83%. Now, post JFE coming in there, JFE will have 50% stake in BPSL, and JSW Steel as well will have close to around 50% stake in the company. Now, going by the way the shareholding pattern is changing, out of the 15,750 crores odd of equity valuation that JFE will be putting in, well, it appears that JSW Steel will get around 10,300 crores, and the remainder could go to the promoter entity itself. Then why did the stock see some kind of selling? The street was sniffing a much higher number in the vicinity of around 45 to around 50,000 crores, and the enterprise value now is around 37,000 crores. So maybe some disappointment on the expected valuation out there, and the rationale of the deal as well is something that the street is coming to terms with. The completion is likely in the next 6 to around 9 months, so it appears it's a big boost actually coming in for JSW Steel. However, the valuations is something that the street is actually split on, which caused the stock to remain a little bit nervous.
Nigel, many thanks for joining us. The other big story, India and Russia all set to bolster economic ties as President Putin arrives in New Delhi on a state visit tomorrow. India is likely to push for increasing pharma, agri and textile exports. Prime Minister Modi and President Putin will also discuss a free trade agreement which could be signed in the future. Parikshit joins us now to take us through what is on the table. Parikshit, what can we expect?
Well, economic cooperation and having closer economic ties with Russia will be India's #1 priority during this visit. Both sides recently initiated discussions on an FTA between India and the Russia-led Eurasian Economic Union. We're not expecting any finality during this visit, but yes, the discussions between President Putin and Prime Minister Modi are likely to put those discussions on a fast track. There is a massive trade deficit when it comes to the India-Russia partnership. The FY25 trade numbers are to the tune of around $68 billion. India's exports to Russia were just about $4.8 billion. The trade is largely in Russia's favor because of India's large-scale dependency on Russian crude. So what India is going to convey during this visit is that Indian exporters must get more market access in Russia, and Russia must buy more. So be it pharmaceuticals, be it textiles, be it agriculture products or steel, we would like Russia to be a bigger buyer of Indian goods. And therefore, discussions on more local currency settlements, trade facilitation, economic cooperation, healthcare, all these MOUs or a package of agreements supporting economic cooperation are likely to be signed during this visit. A key outcome will be the MOU between India and Russia on migration and mobility of skilled professionals. We've seen a large number of Indians going to Russia for employment, a lot of them getting trapped and ending up serving the Russian army against Ukraine. So we don't want that situation to arise. We want to have avenues for legal migration from India to Russia. So that will be the highlight during the visit. In terms of the defense partnership, while it's very, very critical, there will be continuity. We'll explore cooperation in co-production, co-development, there will be a strong pitch from President Putin to sell, co-produce and further develop the Su-57 fifth-generation fighter jet. But India is going to make it very clear that we've not taken any decision on either Su-57 or F-35s, and there cannot be any discussions even at this juncture. On the oil trade, we've seen November oil imports from Russia at an all-time high of almost 1.9 million barrels per day. This is because the sanctions were coming into effect on the 21st of November, and there was front-loading. Post that, we are seeing from analyst reports that the oil imports from Russia from non-sanctioned entities is to the tune of 800,000 barrels per day. This is likely to continue till larger secondary sanctions are imposed by Russia. So the oil trade is likely to continue via the non-sanctioned entities. Overall, India and Russia would like to signal continuity of the larger strategic partnership between the two nations.
All right, Parikshit, many thanks for joining us. And do remember to tune into CNBC TV18. Parikshit will be tracking President Putin's visit to India. And staying with the Russian president, President Putin and negotiators from the US appear to have failed to achieve a breakthrough on securing a Ukraine peace deal. Now, Putin met with President Trump's special envoys, Steve Witkoff and Jared Kushner, for nearly 5 hours. Remember, the Secretary of State, Marco Rubio, not present at any of these meetings. Russian officials have said that talks were constructive, but no compromise was reached over territorial concessions for Ukraine. Putin has accused Europe of preventing the US administration from achieving peace on Ukraine. He added that Russia is ready for war if Europe starts it. Now, the government has withdrawn its earlier directive to phone makers, which had made it mandatory to preload the Sanchar Sathi app. That's the state-owned cybersecurity app. Now, the U-turn comes days after the Telecom Ministry's order raised concerns over possible snooping or mass surveillance. Responding to the Congress MP Deepinder Huda's question in the Lok Sabha today, Telecom Minister Scindia said that even if the app has been installed, it would not be operational unless the user registers on it. But post that intervention in Parliament, the government has now decided to withdraw its directive asking for the pre-installation of the app to be made mandatory.
जब सिस्टम के अंदर प्रीलोड की रिक्वायरमेंट होगी तो डिसेबल करने के बाद भी सारे फीचर्स डिसेबल होंगे कि नहीं होंगे किसी यूजर्स को ये बात पता नहीं चलेगी। तो कहीं ना कहीं ये जो एक अधिकार है निजता का, उस पे कोई बड़ा प्रहार तो नहीं है।
क्योंकि ऐप फोन पे है, इसका मतलब नहीं है कि वो ऑटोमेटिकली ऑपरेट हो जाएगा। जब तक मैं उपभोक्ता के रूप में उसमें रजिस्टर ना करूं, तब तक वो ऑपरेट नहीं होगा। और मैं उपभोक्ता के आधार पर, जैसे मेरे फोन पर सर ढेर सारे ऐप्स होते हैं, मैं उस ऐप को भी दबा के मैं डिलीट कर सकता हूं। तो ये लोकतंत्र में पूर्ण हक और अधिकार नागरिक का है सर।
कहीं ये जो स्नूपिंग के प्रश्न उठ रहे हैं पूरे देश में, इसको लेकर सिविल राइट्स एक्टिविस्ट से, कंप्यूटर साइंस एक्सपर्ट से, उनको लेकर मंत्री महोदय क्या कुछ कहना चाहेंगे?
फीडबैक हमें मिलेगा, उस फीडबैक के आधार पर अगर उस ऑर्डर में भी हम लोगों को कोई चेंज लाना है, उसके लिए भी हम लोग तैयार हैं। ये मैं अवश्य कहना चाहता हूं कि इस ऐप के आधार पर ना स्नूपिंग संभव है, ना स्नूपिंग होगा।
Ready to act on feedback. That was the telecom minister. And as we pointed out, the government now issuing a statement saying that the pre-installation is no longer mandatory. So it has withdrawn its previous directive, making the pre-installation of the Sathi app mandatory. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. We're back in a minute with more.
Let's Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As rising pollution levels become a pan-India problem for many months of the year, this week we have decided to turn the spotlight on health insurance. Now, claims relating to respiratory and other pollution-related ailments have been on the rise. So is our current health policy keeping us adequately protected? Or is there a need to do something more? Do we need more plans? Do we need add-on covers? Do we need to go back to the drawing board and check the math? Plus, we also need to understand how health plans are evolving in the zero GST era now that GST on health insurance has been cut down to nil. So joining me to discuss all of this are Priya Deshmukh of ICICI Lombard, Amit Chhabra of Policy Bazaar, and Sanjeev Bajaj from Bajaj Capital. Ladies and gentlemen, thank you so much for joining in. Really appreciate all of you taking out the time because we have an important issue at hand. When I thought about this subject itself, because we were getting some queries on it, my first instinctive answer was, no, it shouldn't really matter. Your adequate, current policy should be adequate if it's regular respiratory or cardiac ailments. But then I thought, no, let's check with the experts. So here we are. And Amit, I want to open with you because I know Policy Bazaar has been doing some research, some survey on this. I think you've gone back and studied pollution-related trends in the last couple of years. And it's showing that indeed there is a marked increase in claims relating to pollution. Tell us more about it.
Sure. So be a couple of interesting trends, came out, and we were looking at how the insurance claims data is linked to it, because one of the things that we hear from our customers a lot of times is that while pollution is an irritant, right, it probably causes a bit of headache, or you have a bad throat. It may or may not cause a long-term harm. That's part one. And the second thing is also another view that a lot of people have is that if there is long-term harm, is it impacting me right now? So that's why we started looking at the claims data to understand what's happening. Now a couple of very serious trends came out. So one, and this we saw across the years, there has been an increase in pollution related claims post Diwali. So typically around this October, November, December timeframe, we see an increase in claims related to pollution. Now, just to clarify, what does claim related to pollution mean? So these could be claims which are very directly attributable to air pollution. So typically respiratory problems, lung related problems, these are the ones which get very directly attributed. There are a lot of longer term effects as well, like for example, heart related problems or cancer, right? Now, these are the ones which typically, happen over a longer term and may or may not have direct attribution to air pollution. But when it's directly caused, linked to, throat or respiratory issues, that's why we, sort of attribute it to air pollution. And there, we have seen a sharp increase. There's almost a 15% increase in pollution linked claims. The second, and I would say, it's almost quite sad that the ones which are bearing the brunt, the most of this is actually children under the age of 10 years. So they form a very, very large proportion of the total claims coming. About 43% of the customers who are claiming are because of pollution are little children. Now that's also logical because, the airwaves are smaller. They are also more susceptible to infections around pollution. So it's logical, but yeah, it's quite sad that is also happening.
Now that's really important. And I think as the rest of our data, which is on the screen, will show our viewers that this is not just a Delhi problem. These claims have been rising in other cities as well, in Mumbai, in tier 2 towns, or in other cities like even Hyderabad and Bangalore for that matter. Bangalore was an interesting one that really struck me, that even in a city like Bangalore, which arguably has one of the best temperatures and climates in the country, there is an increasing incidence of claims relating to pollution-linked illnesses. Sanjeev, your opening thoughts. What are you observing? And that really critical question that could there be an outer chance that in my current policy, usual, health policy, there could be inclusions which keep me away? That's the biggest worry, I think, among the customer base.
See, the biggest problem right now is that most of the people are not adequately insured. They are not keeping into the mind that, look, their salary is increasing in single digit, but the health insurance inflation is in double digit. So if a treatment which costs 20 lakh today is in 20 years is going to cost 2.8 crores. So, that is the kind of medical inflation that we are seeing. And most of the people are underinsured. And what they don't realize that the medical claims are very long, especially pollution related. If you get something happens to your lungs, or you are having severe asthma or asthma related, these are very expensive claims. This is not something you can go and pay 30,000, 50,000 or 1 lakh. What we have seen is not only the quantum of the claims, but it is also the amount per claim. In case of pollution claims is very high. People are getting sick, they're getting pneumonia, they're getting hospitalized in the hospitals for a longer term. So the average claim size is also gone up. And the first thing you need to do is increase your sum insured. And you have to insure for the sum insured you require in 10 to 15 years, not what you require today. Because if you increase it later, then whatever pre-existing has happened, the unconditional claims payment will not happen if you really, because that will only be for the sum insured you were carrying in the past. So I think for the pollution, the biggest impact that people need to keep in mind is that the size, the quantum of a pollution-related claim is very high, because pneumonia takes at least 2 weeks to 3 weeks to clear out. The hospitalization is much longer. Also, another thing that people need to keep in mind is that claims for newborn babies which are being born during the high pollution time, there are a lot of problems they are facing. And most of the time, these babies are not covered in any policy. But we have not bothered to take a policy which covers newborn babies. So if you are pregnant or you are planning a child, must make sure that you have a protection for your newborn baby also because of this pollution. These are a couple of things that you need to keep in mind.
That's a great point, and I think one that would be easily missed otherwise, when do you start insuring a child, a newborn? In fact, Amit, let me throw that to you. So one point that Sanjeev has made, that make sure that your cover itself is big. And by big, you gentlemen can define big. I'm guessing big these days has to be above maybe 1 crore. And then weigh in on the point of covering infants, because your study is also saying that it's children who are getting impacted the most.
So I think very pertinent points, Surbhi. See, a question that we get a lot as well is, what is adequate sum insured? And depends. So I'll just take this. It's a very, very important point. One, it depends on what city you're living in, because the cost of hospitalization in, let's say, Delhi, Mumbai, Bangalore, Hyderabad versus a cost of hospitalization in a relatively smaller city is different. So if you are somebody who stays in a tier 1 city, you should at least look to have 10 lakh rupees per person of sum insured. So let's say if you're a family of 3, then you must have about at least, even 20 lakhs or 15 lakhs of sum insured instead of 30 lakhs for the same family type. But here is the catch. The cost of the higher sum insured is actually very, very minimal. So let me give you a perspective. If the cost of 10 lakh sum insured for a family is, let's say, 100, then the cost of 1 crore, which is 10 times the sum insured, is going to be about 115, 120. So it's not significant delta to get a very high sum insured. So as you just said, the right sum insured to buy is a 1 crore sum insured. It protects you now, it protects you forever, because this is a lifelong renewable product. So it protects you forever against any illness, be it pollution linked, be it cancer, heart.
Sure.
It could be anything, right? And see, it's also very, very important to understand that today, because a very common perception that we see specifically amongst the younger people is that I'm young and fit and healthy and nothing's going to happen to me. So I would buy a higher sum insured when I get, when I get older. Maybe I can buy at 60, 55, 60, or that age.
Sure. No, and Amit, I'm sorry coming in, because of lack of time. And this is something we've covered in the past as well, that you need to have plenty of coverage, and it needs to be a very comprehensive health cover. And both of you are reiterating that point. I completely take it. But on the point of covering children and infant, now, if there's a newborn, I don't know if a family floater automatically covers the newborn. What should you do to ensure that, young children in the family are adequately protected, not just the mother and father?
So, sorry, this is for me, I'm assuming.
Yes, Amit. Yeah.
So by default, every floater policy, in every floater policy, you can add a newborn after 90 days. Typically, that is the standard process that is there in health insurance right now. So after 90 days of childbirth, you can add. The only catch is if you've already bought a policy which covers for maternity, there are some special policies which cover the child from day one itself. So if you're somebody who's planning a family right now and this is something that does bother you, you may want to buy some specialized policies which cover the child from day one. If you have an existing policy already, don't worry. After 90 days, a child can be added by default. There is a good health declaration that is required. So, the insurance companies typically want to check that there is no pre-existing disease, something congenital that the child may already have. But beyond that, it's a very, very standard process. Children are covered. And if there's any problem linked to pollution or otherwise, they are all covered in the health insurance policy.
Okay, that's helpful. That's helpful to know that you can take add-on covers for absolute newborn infants. But otherwise, after 90 days, a family floater can also cover the children. Priya, very quickly, to close the loop on the pollution-related subject, tell us what should be the most important questionnaire list, the checklist for us, the policy buyers, to ensure that we are fully covered and that we don't hit any exclusions when we actually go in for a claim, which could be related to lung. I mean, I don't know if insurers right now are making a distinction. You can have pneumonia due to X number of cases. Pollution could be one of them. That base insurance policies do cover pollution-related claims, and typically, these claims are related to upper respiratory tract, lower respiratory tract, so a couple of eye kind of ailments. So all of these are covered typically in the base insurance product. So from a checklist perspective, I guess, what is the sum insured that you're covering yourself and your family for? And any pre-existing disease that is, connected to any of these ailments that I mentioned should be very clearly declared. So I don't see a reason that, customers like yourself or any member should be concerned whether pollution-linked claims can be paid. Okay, all right. We'll take a very quick break on that note, come back on the other side. And then the other big development, right? Now, we don't have to pay 18% GST on our health insurance plans. What does that mean in terms of coverage, in terms of the features of the product? We'll discuss it with our panel of experts after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are putting the spotlight on health insurance because there's pollution on one side, rising claims. And then, of course, we're in a new era where there is no GST on health plans or nil GST, which has made it that much more easier for policy buyers to go ahead and buy the right plans. Let's ask our panel of experts what this really has meant in terms of product evolution, what's happening in the market. Let me put that question to you, Sanjeev. Has the cost gone down by the full 18%? Or are you seeing insurers load up more features? So net, my cost remains the same as a policy buyer. And what's visible on the horizon?
Right now, the cost has definitely gone down directly by 18%. So if you were paying 59,000 rupees as premium or 50,000 premium plus 9,000, it's come down to 50,000. But what we are also seeing is that people are quite excited about this, but they're also taking this as an opportunity to see, look, I was already allocating 30,000 to my premium. And, since the base cost has gone down, can I look at enhancing my cover? So at least what we are seeing is that as people are reaching the renewals, earlier about 10 to 15% used to reach out to us for reviewing the sum insured and others. So that has gone up to almost 40-45% as people are getting aware. And we are also getting a lot of surprised calls. This has been a big announcement. The government has been going gung-ho announcing this, but still a lot of people didn't register this. So, we are getting a lot of calls from people that why has my premium gone down? What has happened? So is there something wrong? So there's, but this awareness is getting spread, but your premium has definitely gone down by 18%. Yes, there are challenges which the companies are facing because the input credit is on GST is a challenge where clarity still is required that how that will otherwise the actual cost will eventually end up going up. But keeping that aside, the cost has gone down. People are looking at a higher sum insured. And you need to understand for the future that health insurance in India has been absolutely damn cheap. And it's going to become slightly more expensive in the long run because of the medical inflation. 14% medical inflation is crazy. As I had shared that example, that a 20 lakh treatment is going to cost you 2.8 crores. And also what is happening, the heart attacks used to be the biggest claim reason. Today, that's getting changed with cancer, and cancer is much, much more expensive to treat. So those things have to be kept in mind.
Got it. So I think Sanjeev's message is loud and clear. It's a message very well taken. More insurance, and more insurance. Just increase your cover. That's your starting point for, taking care of all your health insurance-related needs. But Amit, let me ask you, now that this wonderful sweetener has come in, and now that my policy is costing me 18% lesser, with that spare cash that anyone has available, apart from increasing the cover, which is, Sanjeev's already made that point, apart from that, what else should one definitely add on to the policy, a rider or something which could be very, very utilitarian and useful now that I have the money?
Sure. So a couple of things, we have seen already playing out in the last month or so. So one is a lot of people are also wary of the fact that my premium may increase in the future. Because while right now there's a technically 18% discount that's been offered to me, there may be a price increase to counter it. And it's been going around in news and social media. What a lot of people are doing is, one, they are buying a longer term plan. So instead of taking a 1-year policy, which typically a lot of people take, people are taking 3-year and 5-year policies as well. The stage of that is that you lock in your premiums. Yes, you have to pay upfront, but you lock in your premium. Otherwise, what may happen is there may be a 10-15% price increase every year. So effectively, over a longer period of time, the customer does save a lot of money there. So that's one very clear trend that is coming out. So the extra money being saved is being used to buy a longer term policy. That's one. Second thing, and a very interesting trend, we are seeing that there is a rise in people buying consumption-based plans, which are typically maternity plans and outpatient OPD plans. Now, these are expenses which otherwise the customer anyways has to do. So if one is planning to start a family, then maternity is a guaranteed expense. Historically, there have not been great health insurance plans to cover for maternity and OPD because one of the reasons was GST comes in between, because there was an 18%. sort of lost to the customer, right? Because see, just to give you the customer background, customers look at this as I paid 50,000 rupees, am I getting 50,000 back or not, or more? Now, what was happening was that the customer was paying 50,000 rupees, he was also paying 9,000 rupees extra because the GST was there. And now at least that has gone away. So now there is more attractiveness of maternity and OPD plan.
So let me put you on the spot there. If you were to advise someone, and I think OPD plans are something, maternity is still specific to specific couples and people who might need it. And OPD cover, I think, given the rising cost of outpatient treatment, it would perhaps be definitely in order. So what OPD plans do you think are worth our while, and what are the features we should check in these OPD plans? Amit?
So see, I think what a customer really wants is a plan which gives you a very large network of doctors, right? That's one. Second, you need somebody which also gives you a large network of diagnostics. So if you want to get a test done, you want to go visit a doctor, get a consultation. And thirdly, you want pharmacy. These are the three large, I would say, categories within OPD products: pharmacy, diagnostics, and consultations. And consultations can be in person as well as digital. A lot of people now prefer digital consultations. So any plan which offers you a very good network of these three categories, that I feel is a good OPD plan to take. In fact, a very good plan right now, Priya only created that plan, is by ICICI Lombard. It gives you a very good selection of all the three factors that we mentioned. So yeah, these three are the ones one should look at when you're looking at the OPD plan.
Okay, all right, got it. We are completely out of time, but Priya, let's have the last word with the lady then. Entering a brand new year, 2026, health insurance, Priya, what to watch? You guys make the products, so tell us, what can we customers expect?
No, surely, absolutely excited with the changes that have happened in the current year. So we've seen a 4x increase in, people buying insurance because of GST cut. As you said, it's a very good sweetener. Amit mentioned more number of people are buying long-term, tenured policy. We've seen around 35 to 40% increase in such, consumer behavior. So what to expect in 2026 is larger number of people buying health insurance, new category of customers buying it. And customized product which are suiting the needs of the customers. That is another trend. And we are seeing immense amount of increase in everyday care kind of product around OPD and, care management. So driven by AI and technology, customer focused kind of solutions. So those are the things that we see are going to propel. And of course, a lot of changes from a regulatory standpoint in the favor of the consumer is what we are expecting for us to, disrupt this space as we go ahead. So we, very, very exciting times ahead for the consumers and for India, for all of us as part of the ecosystem.
Okay, fantastic. Well, on that note, we'll wrap up this edition of Let's Talk Money. Thanks to all of you. And I personally firmly believe that nothing in financial services is more important than a great health plan. It all starts there, and then we build on our investments and the rest of our wealth. So thank you so much for joining in on a very important subject. Well, with that, we're completely out of time. So thanks to our viewers as well for tuning in. We'll see you next week with another theme.
Let's Talk Money.
Hello and welcome to News Center. I'm Parikshit Luthra. India and Russia are all set to bolster economic ties as President Putin arrives in New Delhi on a state visit tomorrow. This will be Putin's first official visit to India since the war in Ukraine began in February 2022. The two-day visit is scheduled to begin with a private dinner on Thursday at Prime Minister Narendra Modi's residence. The leaders are likely to discuss a free trade agreement which will be signed in the future. So what does New Delhi want from Moscow? First on the agenda is boosting exports of pharmaceuticals, agriculture, textile products to Russia. India is also looking for stable fertilizer supply from Russia, along with higher exports. The two nations are also likely to sign an MOU on migration to enable mobility of skilled workers and boosting connectivity. Non-tariff barriers, regulatory impediments, defense co-development and export of defense equipment are also likely to be discussed during the meeting between the two leaders. Remember, trade between India and Russia stood at $69 billion in FY25, with India importing $64 billion worth of goods and services. Let me go across to our special guest right now. Brahma Chalani, strategic affairs expert, joins us right now. Brahma Chalani, what do you think is going to be the big focus of Putin? Yes, they're coming with an idea to pitch the Su-57 to India, but we believe there is going to be no headway on the fifth generation fighter jet deal, no major defense agreements, but India would like continuity of the partnership and maybe have a discussion, an agreement on bridging the trade deficit. What do you think would be the best outcome for both sides?
In an increasingly polarized world, Putin's visit to New Delhi carries outsized geopolitical significance. It's not the agreements that will emerge from the visit. The deliverables are not that important. What's important is the symbolic element, the fact that Putin, for the first time since the Ukraine war, is visiting India, and his visit lays bare another important reality, which is a steady deterioration of US-India relations. And that deterioration has pushed India to re-embrace Russia as a reliable long-term partner whose strategic value cannot simply be dismissed because it unsettles Washington. And for Putin, this visit to India is very critical because it demonstrates Russia has options beyond China. After all, we should not forget that India has watched with growing dismay as Western policy has driven Russia closer to China. Yet, Putin's visit underscores that Russia still has options beyond China and will not allow itself to be reduced to a junior partner to Beijing. And for India, there's also important geopolitical signaling involved, which is that at a time when the US under Trump is treating India very badly, India is messaging to Washington that it will not look at the world through a simplistic Western versus anti-Western binary, that it will make its own strategic choices and will preserve its strategic autonomy. So in the totality of things, Putin's visit is very important.
Right. Let me also get an Ambassador Sibal at this point. Ambassador Sibal, do you think Putin will allow greater exports of Indian goods, pharmaceuticals, textiles, shrimp products to Russia? Will he open up the market for Indian goods?
I think they want to. They have already said that they will want to increase the trade volumes between India and Russia, and that the Russian market will be available to them. And they have in mind the kind of difficulties we are facing with regard to exports to the United States because of the sanctions that have been tariffs that have been imposed on us. They are conscious of that, and they want to take the full benefit of that opportunity to signal to India that if the US market is now restricted for us, they can open up the Russian market more. And this is in the area of pharmaceuticals and textiles and agricultural products, IT products, and things like that. Now, this also means that their regulatory and registration processes, non-tariff barriers, all that has to be modified. Plus, of course, the potential of an FTA with the Eurasian Economic Union would help matters. But this is not something which is going to happen immediately. It's a work in progress. Discussions will need to take place and it will take time. But the inclination is there, desire is there, the political commitment seems to be there on the part of Russia, because they understand that if you want to raise the volume of trade to $100 billion by 2030, which Dmitry Peskov, the Kremlin spokesman, has reiterated, will require a major effort on Russia's part. You see, from our side, we can buy more from Russia. We can buy more fertilizers, we can buy more coking coal, we can buy more raw material, we can buy more LNG. But this will keep increasing the trade deficit between India and Russia. Our trade to Russia is only $5.6 billion. It is nothing at all. So they understand that. But I think despite that, it'll take a little time before we can substantially increase our exports to Russia.
Right.
See, the problem.
Ramachandani, I'd like to ask you about I'll come back to you, sir, about the importance of the discussions on an FTA between India and the Russia-led Eurasian Economic Union. Is this going to be beneficial for India?
India has been either signing or negotiating FTAs, even though the Indian government under Prime Minister Modi made it clear just a year ago that the FTAs that India has signed so far, for example, with Southeast Asia, with the ASEAN countries, with Japan, with South Korea, they have actually not benefited Indian economy because India is not an export-driven economy. India imports far more than it actually exports because India relies largely on domestic consumption for its economic growth. And yet, ironically, the Modi government has been signing or negotiating FTAs, including with, for example, the EU. We signed one with Britain fairly recently. We're negotiating one with Canada, for example. So FTA, again, of whether it's with one region or group or with one country, the question is, how does any FTA benefit an economy that is import-dependent, which relies on domestic consumption for its growth? Of course, FTAs are very important in a geopolitical context and geoeconomic context because they symbolize the convergence of larger strategic interests. But beyond that, in terms of concrete benefits for the Indian economy, there hasn't been any debate in India. I think in the case of Putin's visit, given the fact that now Russia has pivoted to a war economy, earlier there was disruption in supply of military hardware to India because of the Ukraine war. Russia was trying to meet its own defense requirements, but now it has recalibrated and rebuilt its armament industry to such an extent that, as the Americans are now openly acknowledging, Russia is producing more missiles today than it can fire. In other words, it's building a large inventory of long-range missiles. And I think on the military side, on the defense side, there might be important possible deals in the works. Maybe there may be no announcement during Putin's visit, but certainly there's some very important deals that India is seeking, including India wants 5 additional squadrons of S-400 air defense systems. There's going to be discussion on a host of other things. These are ongoing discussions.
Absolutely.
But I think,
Mr. Chelani, let me take that forward with Ambassador Sibal. Ambassador Sibal, we're not expecting any big ticket defense deals, but yes, there will be a logistics agreement whereby the militaries of the two countries will be able to access each other's bases. This agreement was signed earlier. It's now been ratified by the Russian parliament, so to say. Having said that, when do you think India would be able to bite the bullet when it comes to acquiring the 5th generation fighter jet, either from the US or Russia? It's a very difficult choice. Sources tell us that India will not give any indication, or we're literally going to stonewall any kind of discussions on the Su-57 right now. But when do you think India will be ready to take a decision?
Well, if you ask my opinion, we should not at all go in for an American 5th generation fighter with F-35s. I don't think we should do that. It'll be foolish strategically to do so, given the vagaries of US foreign policy and the punishment that we get at US hands every now and then, which is unprovoked. So you can't rely on the United States because they can weaponize their dependence, our dependence on them. However, with regard to acquiring a 5th generation fighter, we have also another issue we have to deal with, and that is our self-reliance, our AMCA project. Will that then go into hibernation if we go in for Su-57? Can we wait for AMCA or the later versions of LCA to fill in our needs while we develop our indigenous capacities? To that end, whether we can buy more Rafales to boost our air power, all these things will have to be considered. But the point I'm trying to make is that it's not a choice between United States and Russia. It's a choice between self-reliance, the French connection, and the Russian connection. And I think government will have to take a view on that.
Okay, Brahmachalani, the Russian government spokesperson, the Russian president's spokesperson said that they want to offer a no-limits partnership to India. What does that really mean? And in the face of US tariffs and trade tensions with the American president, are we likely to accept any such partnership? Do you expect India to announce such a no-limit partnership with the Russian government?
Well, the phrase no limits is being used in the context of China-Russia partnership. So we can't be importing the same terminology in the Russia-India context. And certainly the Russia-India partnership is a long-standing partnership that dates back to 1971. It's the longest partnership that has remained very stable and reliable for 55 years or so. I don't think there's any other bilateral partnership in the world that has been so stable and mutually beneficial for both partners as the partnership between Moscow and New Delhi. And I think the history of it and the fact that that the two countries still value it very much is by itself a good advertisement of the importance that both countries acknowledge in continuing this partnership. So it doesn't require any terminology, any kind of phrase to describe it. The partnership speaks for itself.
That's important. Let me go across to Kamal Sibal, Ambassador Sibal, for the one final question. Ambassador Sibal, both sides are likely to sign an MOU on migration and mobility of skilled professionals. How important is this? And I'd like to ask you, from your experience as India's ambassador to Russia, a lot has happened in the relationship since then. This year, we've also seen a disturbing trend of Indians going to Russia, joining positions in the Russian army, somehow landing up with jobs they don't really want to.
Before I answer that question, I want to say something about this no limits partnership. You know, there has been concern in India that Russia has become very close to China. They have no limits partnership, so Russia will no longer be a reliable partner. It will be influenced in its relations with India by China. So what the Dmitry Peskov, the Kremlin spokesman, meant by saying that offering a no-limits partnership to India was, in fact, to send a political signal that if you are concerned about our no-limits partnership with China, we are willing to have a no-limit partnership with you. We can go as far as you want to go. In other words, indirectly telling us, don't be worried about our relationship with China. We are not linking our relationship with China with our relationship with you. We can raise it to the same level if you so want. So they have opened the door to us. So politically, this is very significant. Now, whether in the background of Brahma, Chelani rightly said that this phrase of no limits partnership created a huge turmoil in American geopolitical circles, whether we would like to use the same phraseology and raise the same concerns. And then they'll start talking about Russia, India, China coming together and the kind of thing that they visualize in terms of further erosion of Western hegemony. Maybe we would not like to use that term officially, but I'm just explaining the background. With regard to the skilled workers, I think context, one, of course, is this H-1B visa stuff. Not that the two are related directly in terms of what the H-1B visa is for, but to say that, look, your skilled workers are being denied openings now in the United States, but we can open doors to you to the extent that it meets the requirements on both sides. We are talking about, you see, we have great strengths in the IT sector. Russia too has strengths. In my time, we tried to develop cooperation, but it didn't succeed because the Russian IT sector is structured very differently. Now I understand that they have restructured it, and maybe there is potential there, and we should explore it to the maximum extent. With regard to other workers, unskilled workers, who are going to Russia, I think they want another 40,000 to come to Russia to work on in construction, on agriculture, or what have you. There is some potential there, but we should have a proper agreement with them so that the thing remains controlled and is subject to monitoring and making sure that this is not misused.
There is a legal route. All right, so we've run out of time, but thank you very much, Brahma Chelani and Ambassador Sybil, for joining us on the program for a very comprehensive discussion on President Putin's visit for the annual India-Russia summit. We're taking a short break, but don't go anywhere. We get you an exclusive interview with Sanjeev Bajaj, Managing Director of Bajaj Finserv, and Rajiv Memani, CEO of EY India, the CII President as well on the other side. Welcome back. You're watching News Center. The Confederation of Indian Industries is holding a two-day conclave titled India Edge 2025 in New Delhi. The event saw industry leaders and policymakers deliberate on the opportunities and challenges for Indian companies and the economy at large. Timsi Japuria and Shivani Bazar spoke to Rajiv Memani and Sanjeev Bajaj about the rupee breaching the 90 mark against the dollar and also their outlook for growth.
I think from an industry standpoint, Timsi, the view is that we don't, industry doesn't like volatilities. So as long as whatever market trends are and the rupee is behaving on that basis, I think that's fine. But if there is too much of volatility, I think then it starts impacting people. So I think right now people are just starting to see where it eventually settles. And then I think people will take a view on that.
When we talk of export competitiveness, at this level of rupee, how do you see what is in stride of India, especially when it comes to the economic trends?
So, I think overall the Indian economy has done well. You've seen the last quarter's GDP numbers. You see relative to what's happening in the world. I think the Indian economy has been doing very well, but we are also in a situation where the global economy is underperforming. Each country is having its own trade policy. So in that environment, to look at exports and also the India-US trade deal and the impact of that. So I think when we look at our exports, we have to look at it at that context. I think definitely from an export standpoint, rupee reaching 90 rupee will add to the either the export revenues or to the profitability of exporting companies. We should not forget that services is now 45% to 50% of our total export basket. And I think that definitely a large part of the services, raw material cost is in rupee. So I think that definitely makes the services more competitive. And in some areas where the exports are very reliant on imports as well. So whether it is gems and jewelry or whether it's crude exports, there obviously the domestic value addition is not that high. Therefore, the impact is not that much. The import also rises in a similar vein. But overall, if you were to ask me, I think just looking at an isolated way that how does it impact exports, I think it does impact exports positively. And from a macroeconomic standpoint, the current account balance is not much of an issue right now in India. The interest rates are very benign. Inflation is very benign. So I don't think there's any macroeconomic risk because of what's happened to the rupee-dollar ratio. So I would say yes, it'll add to the competitiveness of exports.
We are at a very interesting position where we live in a world which is full of uncertainties and continues to be so. And in a situation like that, to grow at 7.5%, 8% is, I think, very commendable. So there are a number of things that the government, that private sector has done right to bring us to this stage. But there's an equally important need to see that how can we keep this steady, not for the next 2 quarters, but for the next 5 years, 10 years. And that requires a lot more work to be done.
Okay, but do you see any slowdown in terms of consumption when it comes to urban or rural for that matter?
At this point of time, we've seen consumption to be reasonably stable. The GST rate cuts have only just happened. We saw an immediate bump up in October in consumption because of that. The festival season was also there. So we'll have to wait the next few quarters and see. But I would say this is the right time for us to see the next generation of reforms.
There's also news about Niti Aayog proposing an end of license Raj. How do you see that? Do you think that in a way will help Indian businesses?
Even in the last few years, we have seen this government move to decriminalizing a number of regulations, which is now helping business move ahead with more confidence. But as we do all this, we must keep in mind that with competing countries, we're just about at the starting line. And that's why a lot more needs to be done. We have enough experience of working as a liberalized society and economy for over 30 years now. And this is a welcome step by the Niti Aayog. I do hope it is taken seriously, because this will just provide a lot more tailwinds for investment, for growth going forward.
I also wanted to ask you about NBFCs and the scrutiny in that area. Is the cost of funding becoming a challenge? Is that a challenge in any sense?
Firstly, we must recognize in the last 15 years that NBFCs play a very significant role in the economy. Over a third of credit now is NBFC credit. And it's not just in geographies or in areas that banks can't reach. The large NBFCs today, many of them, including ours, are bigger than most banks in the country. RBI has correctly, in the last decade, increase their scrutiny, supervision, inspection over these NBFCs because they are important now to the economy, and hence we have to make sure that their stability is first and foremost kept in mind. We have seen credit flow to NBFCs reduce in the last couple of years because there were certain segments, especially dealing with small value unsecured loans, where we had seen higher loss ratios, and that needed to be controlled as a sector. I believe we are past that now, and this is a good time to focus as the economy grows for additional credit through the NBFCs going to consumers and businesses.
Rupee has slumped to like a historical low at 90 today, $90. What do you think about all of this in terms of India's export competitiveness?
If we take a step back and see over the last 15 years or so, rupee has been depreciating about 3-4% a year. It doesn't necessarily happen in a linear manner because it can't, but it has been in that direction. And as we see from RBI's intent, it is not necessarily to peg the rupee at a particular level, but it is just to reduce the volatility. And I believe that is the correct path to follow as well. As an economy, given that we have this huge chance for all the reasons that we have seen in the last few years to become another significant manufacturing and services supply base to the world, naturally a weaker rupee is better than a stronger rupee. But as long as that slide is a stable slide, I think that is what is important.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Well, the world's oldest, the largest hyperscaler in the world, Amazon Web Services, throwing the gauntlet to its competitors, the likes of Microsoft and Google, through some big announcements that we saw today at their day one of their flagship summit, reInvent 2025. Now, the markets, the industry was watching very carefully. What were we watching out for? Well, there are four things that caught our attention. Number one, the chips race. Now, hyperscalers like AWS are not happy just being hyperscalers. They also want to enter the chips race. AWS entered this race back in 2018, and today they released the latest version, their most powerful homegrown chip called the Trainium 3, which they believe is exponentially more powerful than previous generations, and it couldn't have been more timely since Google has been flexing with what their chips can do, which they've shown with Gemini 3. Not just this is not the end of the road. Matt Carman, their CEO, the AWS CEO, said that there are lots more work under the wraps, that as far as the next generation is concerned of chips, that will be Trainium 4, which will be exponentially more powerful than this version. And this, importantly, is a statement of intent by AWS that they want to enter an ecosystem which is on lockdown by NVIDIA, courtesy its powerful GPUs. That was one. The second, as far as the LLM race is concerned, this is clearly heating up. With Gemini being released by Google, we've seen the GPT versions released by OpenAI. Today, AWS released its Nova 2 generation of LLMs, which they say is significantly more powerful, can achieve higher benchmarks than even the likes of OpenAI as well as Google. And number three, data sovereignty impacts. A lot of countries are asking for their companies to store data locally, and AWS's solution is what they call AI factories, where they move entire server racks to the location of the customer companies to meet any data sovereignty mandates. And finally, as far as AI agents is concerned, AWS releasing what they call our frontier agents, which can compress timelines for tasks which ordinarily would have taken months, and that this is something which can be done by AI agents working round the clock for days and weeks on end. So that's a quick wrap of four highlights that caught our attention. We're coming to you from Amazon Web Services flagship summit called reInvent 2025. I have with me Mr. Praveen Sridhar. He's the head of the partner business at AWS India and South Asia. Mr. Sridhar, thank you so much for joining us, being a part of this conversation. First, AWS, the one message that keeps traveling from the company to us is that you're a customer-oriented company. When you talk about that, that puts you front and center for the India-South Asia geography. Tell us what it is. In this current context of when we're talking about Gen AI, we're talking about agentic AI, what those conversations are like when you have it with the partners, potential partners as well.
Thank you, and Ashmit, first and foremost, welcome to Vegas. Welcome to our flagship event, as you called it, reInvent 2025. We are very excited to be present over here with all the innovation and the announcements that are coming in. From my perspective, I work along with partners and customers in ensuring that they get the best of technology delivered to them through the AWS services. We have been servicing customers in India for over 9 years since the launch of our Mumbai region in 2016. Okay. We even have the Hyderabad region, which was launched recently. Overall, we have made investments in the tune of $12.7 billion going into 2030 for our customers to innovate and work upon.
Let's talk about one of the recent launches that we've seen with respect to AWS Marketplace. There you've provided solutions where vendors can provide solutions in the local currency, which is INR. You, at the time of announcement, was said that this will allow for not adjusting for Forex situations. It allows for tax savings as well. Just give us clarity with this new solution being onboarded. What is the rate of adoption like?
The India AWS Marketplace that we actually launched in the first week of November has been an ask from our customers and partners for a long period of time. At a global level, we have the AWS Marketplace. Over 30,000 of our partners have their listings on the marketplace. We actually have over 70 categories of listings, all the way from security to storage to networking to business application solutions that are provided. Now, customers and partners in India were asking for that kind of an experience to be available in an India context. And what I mean by that is having the ability to transact in local currency, which is INR. Now, this is very, very important because a number of our customers and partners, especially who service financial services or in SMB, they do not want to actually, or sometimes they do not even have access to the USD dollar to do the transaction, so they wanted it in INR. And we are happy to have it launched in India. We are seeing tremendous amount of uptake. At the time of launch itself, we had 37 partners signing up to be launch partners with us. This included companies which are building software out of India, like Freshworks, like Core.ai, like Gupshup, and we had global companies such as Cisco, Salesforce, all of them coming over and launching their solutions on the marketplace.
Speaking of fear of missing out, there are also questions being raised on the other side of the spectrum, which basically which pose the query that is there sufficient ROI as a part of these IT spends on Gen AI? So the question that I want to ask you is that are the investments that you're seeing, that your partners are putting in, is that substantiated by an uptick in revenue or an uptick in savings on account of the IT spends that they're making as far as Gen AI is concerned?
So AI is that kind of a technology which we see once in a generation or once in a lifetime, right? I mean, we are obviously seeing, like you actually mentioned, the palpable excitement of what AI can deliver in terms of business outcomes is there. We are actually seeing both partners and customers innovate on this. We have our new solution, Kiro, which is our IDE environment for building agents and building codes. And this is actually adopted by over 250,000 users in a record period of time. So these kind of technologies, the kind of what I call as organic adoption that we are beginning to see makes us, and we get to see that this is mainly happening because they are seeing business outcomes come out of it.
Operating in a tough market like India, where there are options available, where you're competing with other hyperscalers as well, the question that I had in mind is that what does that do to your conversation when you're looking at it in terms of margins, in terms of revenues, in terms of pricing, essentially, that you have to offer to these customers?
You actually started the conversation by saying AWS is customer oriented, but we are actually customer obsessed. So everything that we do, we obsess over our customers. A lot of the feedback comes from our customers. And as long as we are hearing to that feedback and innovating, we have always found that customers adopt those solutions. So coming back to your point, in India, we heard that feedback.
There are various regulatory moves made by various countries on data localization and data sovereignty. We've seen some recent moves here in India as well, where we recently had the new DPDP rules as well. What are your conversations like with the partners? Is there some sense of uncertainty or a sense of challenge that they fear on account of data localization, data sovereignty demands by the governments? And if yes, what is the solution to that?
We continue to work with, not just in India, but across the world. AWS continues to work with governments, regulatory agencies. We believe clarity around these regulations and frameworks only help the community out there adopt cloud and AI much better. And from our perspective, we have always maintained the stance that any regulatory frameworks that come in, we are going to be adhering to it and working with them.
And I know I said final question, but I'll just, I can't help but ask you, we're towards the end of 2025. As we begin 2026, what's the top of the agenda for you when you look at the India-South Asia market?
Get Marketplace adopted. So like I actually said, Marketplace was in the ask by our customers and partners for a long period of time. It took a certain degree of innovation on our side to make it, to launch it in India. And like I said, just the fact that we had 37 partners at the launch of it, listing their solutions already, gives me a tremendous amount of hope that the best of innovation that's happening is now going to be available for our Indian customers a lot faster.
Well, we wish you the very best for 2026. And thank you so much once again for hosting us here.
Hello and welcome to the special show where we take you inside VinFast's big India game plan, not just the cars you have just already seen in the market, but the larger Vietnam to India strategy the company is now accelerating. From electric SUVs to micro-mobility and even hospitals, universities and real estate, Vin Group says India is the next multi-sector frontier. We began by speaking exclusively with VinFast Asia's CEO about what the company wants to build in India. Here is that conversation. VinFast, Vietnam's homegrown EV manufacturer, is accelerating plans for India at a time when the electric mobility landscape is witnessing strong growth momentum. The company has already entered the Indian market, launching the VF6 and VF7 SUVs, and is now preparing for one of its most aggressive international expansion projects. I'm here in Vietnam and I'm going to tell you about the global and India-specific plans of the biggest automaker of Vietnam, that is VinFast. And to tell us more about that, we have a very special guest.
Hello, I'm here to assist. What can I do for you today?
And that guest is not this futuristic robot, but the Asia CEO of VinFast. Mr. Chow, thank you so much for joining us here on CNBC-TV18. It's a pleasure to meet you.
Likewise.
Let me begin by asking you, it's been some time now that VinFast has entered the Indian market. How has been the experience so far?
The experience is fantastic. We are very happy about the response of the market of India.
While the company has just begun sales in India, they have earmarked up to 16,000 crore rupees in India. This indicates their ambition to compete in India's electric vehicle market. Next, VinFast plans to introduce the 7-seater Limo Green, a family-focused electric SUV that has already seen strong success in Vietnam. The company believes this model could redefine the mid to premium EV segment in India.
Next car will be the 7-seater Limo Green, and I think that is an explosion in the market. And I believe that that will give a lot of satisfactions to the customers. And because it's 7 seaters, it's family car, but more importantly, we have learned the lessons, the good lesson of the success story of selling this model in Vietnam. So we are going to launch both in Indonesia and in India.
While premium products are a part of the brand strategy, India's price-sensitive consumer base is impossible to ignore. VinFast says its approach will be premium quality at accessible pricing.
It's a very challenging exercise in order to be able to balance the demand to make VinFast a premium car maker, but at the same time to boost sales. You can only boost sales if you sell lower segment cars, and then we try to reconcile that to demand. But I'm sure that when we sell the lower segment cars like VF5, VF3, we make sure that the quality as good as the premium car.
VinFast plans to unleash nearly all of the company's EVs in India over the next few years, making India one of its largest and most diverse investments.
We have a very ambitious plan. If you calculate 3 years, it's about 6 models is going to be launched in Indian markets. So I think that is not the full bouquet yet, but perhaps it's the half of the bouquet, because we continue to develop new models.
But the company's vision goes far beyond electric cars.
The full ecosystem with VinFast is composed of the network development, the network of network dealer, and the network of repair shops and workshops, the network of charging, the variety of models, not only 4-wheelers, but also 2-wheelers, also e-buses, but also electrical bicycles.
One important part of the ecosystem is the 2-wheeler market, a segment dominated by India's legacy players and startups like Ather and Ola.
For 2-wheelers, we realize the challenge is huge. Because of the legacy of the OEM, traditional, conventional, and very Indian. But I think that we can bring some new model, and given our strong technology, I think that we can have share with you a number of unique selling points at the moment we launch our 2-wheeler vehicles.
Why this level of commitment for India? But for VinFast, the answer is clear. The company doesn't see India as just another market, but as a central pillar in its long-term global strategy.
I believe that India stands as the key player, if not the most important, but is the top important destination because of various factors. Number one, India is a big player with the most populous country in the world, but more importantly, India is an emerging economy, and the leader of India, both at the Indian level as well as at the state level, they are very dynamic. They are very eager to invite us. They are giving us full support. So that is the reasons why we consider India as our key destination for our investment, not only for VinFast in order to build a green mobility ecosystem, but also to build the whole ecosystem of Vingroup, which is a success story in Vietnam.
Clearly, the Vietnamese electric vehicle maker has a long-term vision for the Indian automobile sector. It wants the right to win by stabilizing a full ecosystem, which includes cars, two-wheelers, buses, taxis, and charging networks.
And that's VinFast's India blueprint straight from the top leadership. A full ecosystem play, not just an EV launch calendar. But the story doesn't end there. We also went inside the company's massive factory in Vietnam to look at the vehicles VinFast believes could fit the Indian market in the coming years. These aren't announced yet, but they show where the brand may be headed. Take a look. This is Vietnamese EV giant VinFast's factory in Hai Phong. It's massive, highly automated complex with a capacity of up to 9.5 lakh vehicles annually. And it's where VinFast's flagship electric vehicles, including the VF6, VF7 and VF9 were born. CNBC-TV18 got exclusive access to some of the vehicles that could be headed to India soon. Now, VinFast has already launched the VF6 and VF7 in India, but there's one car that India really is anticipating, and that is this VF9. This is a full 5.1 meter SUV, and this is one of the most anticipated cars in Indian market from the bouquet of cars of VinFast. This is a 3-row flagship EV with a bold muscular stance, a sweeping LED signature, and a cabin built around minimalism and tech. The VF9 is powered by dual motors, comes with the 400 horsepower and delivers a range upwards of 500 kilometers, depending on the battery pack. Its highlight is space, wide seating and a panoramic sunroof. It also boasts a premium infotainment setup and ADAS-packed driving assistance. While its India launch is confirmed, VinFast says it is not in a hurry just yet.
Next car will be the 7-seater limo green, and I think that is an explosion in the market.
A compact urban electric mobility solution designed for short distance travel, shared mobility and last mile efficiency. The limo green features a minimalist exterior, smooth lines and a modern EV profile built to maximize cabin room in a compact footprint. Inside, it adopts a clean dashboard, digital instrumentation and a layout optimized for fleet use. But VinFast's ambitions don't stop at mass mobility. Which car do you think this is? Is this the Rolls-Royce or the Lamborghini? None of the above. This is the VinFast Lakhong 900 LX, and look at it, it's stunning. It is considered to be the Rolls-Royce of Vietnam, and it is not just for regular use, it is a special edition which is also used by the heads of states. This is an EV that is an armored EV, and let me go this side and show you the design language of this beautiful car. It's absolutely luxurious and also very functional as well. Let me tell you a little bit about this. This is not just a luxury EV, but a full-on mobile fortress. Built on the foundation of the VF9 platform and engineered in collaboration with global armored vehicle specialist Incas, the Lakhong 900 LX is certified to meet the stringent international VPAM VR7 standard. This means it can withstand rifle fire, armor piercing, and even blast-level attacks, a level of security typically reserved for heads of states and high-risk VIP transport. With the VF7 forming the base, the VF9 waiting on the horizon, and the limo green gearing up for the India debut in 2026, VinFast is laying out a full spectrum EV strategy for the subcontinent. One that will see it play at the entire range of segments, from premium SUVs to everyday urban mobility, and one that it hopes will give incumbent brands a run for their money in one of the world's fastest growing EV markets. That's all we have for you today in this special show. Thank you for watching.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening: the rupee recovers after breaching the psychological 90 to $1 barrier for the first time in history amidst incessant dollar buying by foreign funds. Dealers cite limited intervention by the RBI. The rupee has now fallen by almost 2% versus the US currency in the last 2 weeks. The government's chief economic advisor, Anantha Nageshwaran, says he's not losing sleep over the weakening rupee, expects a rebound next year, adding that current levels are not hurting exports or inflation. The Sensex and the Nifty end marginally in the red after a late recovery. The Nifty drops below 26,000. Mid-cap see sharper cuts today. E-commerce platform Meesho's 5,400 crore rupee IPO fully subscribed on day one. Retail portion gets booked in the first hour, but higher allotment to local funds draw the ire of some global investors who walk away from the anchor book. CNBC-TV18 News Break confirmed just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. After backlash, a U-turn by the government on Sanchar Sathi app withdraws the directive to phone makers, making it mandatory to preload the state-owned cybersecurity app on phones. India and Russia all set to bolster economic ties when President Putin arrives in New Delhi on a state visit tomorrow. India to push for increasing pharma, agri and textile exports. Prime Minister Modi and President Putin would also discuss a free trade agreement which could be signed in the future. The Kremlin calls the meeting between President Putin and US envoys Witkoff and Jared Kushner as constructive, but both sides are no closer to a resolution. President Putin accuses Europe of preventing peace, says if Europe wants a war, Russia is ready. Maruti Suzuki steps up the electric vehicle push, plans 1 lakh charging stations across India by 2030, promises several new launches as it outlines an expansive electric mobility roadmap. Amazon throws down the gauntlet to Microsoft, Google, and the entire AI ecosystem announces the next generation of chips, large language models, and AI agents at its annual Amazon Web Services Summit in Vegas. Well, the big story we're tracking this evening, and it is the currency, the rupee, breaching the psychological 90 to $1 barrier for the first time ever. Dealers cite limited intervention by the Reserve Bank and incessant dollar buying by foreign funds. The rupee has now fallen by almost 2% against the dollar in the last 2 weeks itself, and by 5% so far in 2025. However, the rupee did see marginal recovery before it closed. For trade, Lata joins us now with more on the rupee. 90.19, the dollar rupee, that's where it closed for the day, Lata. The kind of free fall that we have seen, especially in the last 2 days, Lata, what do you make of it?
Well, first up, the support for the rupee came towards end of trade, late trade, not really end of trade, the last one and a half hours, with the market giving support. That's very important. It was not because the Reserve Bank lent a horrendous amount of, sold a horrendous amount of dollars at 90.29 that the rupee went towards 90.11 after that. It was because there was an exhaustion of selling. You know, that's how usually bear markets end. But that exhaustion of selling was probably triggered because of the chief economic advisor saying that he is not losing sleep over the rupee's fall. I mean, is this not the best of times for the rupee to fall, considering that, you know, even if prices go up, we are not worried about inflation at this juncture, and that he expects a rebound very soon, probably next year. That was used as a trigger, but really there was an exhaustion of selling also, because how many times do you sell over the same news? We all know about the October trade deficit. We all know that the trade deal has not come in. We all know that there is a BOP deficit for probably 2 years in a row. The BOP number for the second quarter came on December 1st, and that triggered the accelerated selling on 2nd and 3rd of December. But now all that is priced in. So with Reserve Bank and government both saying that, okay, let the market take its course, perhaps, you know, the bears, the rupee bears came in and covered their rupee short positions, or the dollar longs were unwound. The market is now convinced that the RBI also wants a market-oriented solution to the trade deficit. Once you let the rupee cheapen, then obviously exports will improve because they're price competitive, and imports become expensive. Anything has to be multiplied by, you know, 90 rupees plus for a dollar, and that makes everything from textiles to t-shirts to you know, pharmaceuticals more expensive to import. That's the best competition you can have for the Chinese flooding. By the way, we must remember, we keep talking about the dollar rupee. The rupee to renminbi used to be about 11 up until like a year ago, and now it is 12 rupees 80 paise to buy a renminbi. So that also is a protection against you know, Chinese flooding. And finally, perhaps the view must also come to the market that a lower currency is actually a protection for the economy. It's almost like a rate cut. It gives domestic producers more breathing space. The message today is that the market has found its own level. That is why today's recovery of the rupee, albeit mild, is an important takeaway.
Well, Lata, we'll have to see if the rupee holds this level. Thanks very much for joining us. New record low for the rupee today. But let's talk about the stock markets, which also staged a recovery in the last hour of trade. The Sensex and the Nifty ending the day with marginal losses. The Nifty dropped below the 26,000 mark, but it did manage to defend the 20-day moving average, finally closing 46 points lower, 30 points lower on the Sensex. The Nifty banker just about in positive territory. The cuts were really coming in on the mid-cap side. That index down by about 600 points today. So that's where you saw the big moves. But the big newsmaker this evening, with less than 2 months left for the union budget, India Inc.'s wish list is only getting longer. Will exporters roiled by Trump's tariffs get any special attention in the upcoming budget? Will the recently notified labour code give Indian manufacturing the much-needed fillip? And what is India Inc. expecting from the RBI policy this week, and also from Russian President Putin's visit? To speak about all of that and more, we're now joined by Anant Goenka, who's just taken charge as the president of industry body FICCI. Anant, many thanks for joining us here on CNBC-TV18, and congratulations on taking over as president of FICCI. To start with, Anant, let's talk about the rupee. You know, it's great to have you on a day where we've seen the rupee move, breach that $90 mark today, Anant. You know, what's the mood within industry? As we've been arguing here that a depreciating rupee could perhaps be good as far as competitiveness is concerned, but the extreme volatile moves that we've seen specifically in the past few days, what does industry make of it?
Right. I think, as was highlighted, largely we've let market forces determine, as RBI and the government has been mentioning. To that extent, I would say exports have become more attractive. Chinese imports may become a little bit more expensive. I think large volatility is obviously something of a concern, but overall, I would say no major impact to industry. I think it's a positive from an export point of view, and I think it's more about the RBI taking a decision whether they would like to intervene or not, and I think their decision is absolutely fine.
Well, speaking of the RBI, we've got the MPC meeting coming up. Anant, what's the expectation? Is industry hoping for a rate cut? Hope, of course, is always on the table, but do you believe that a rate cut is likely this time around, given the fact that we've seen some very strong GDP numbers come in as well?
Right. I think inflation has been under a fair amount of control, better than expected numbers. Government is gearing for growth. In light of that, from our side, we would say 0.25% basis, 25 basis points cut is very welcome, and that's what industry is rooting and hoping for.
Okay, that is what industry is hoping for, another 25 basis point cut. The big development tomorrow, President Putin is going to be here in India, both sides hoping to further deepen their bilateral engagement, bilateral relationship, including economic cooperation. What's the expectation that industry has on this front?
India has always maintained its position of strategic autonomy. And to that extent, it is for us, or as industry, we are looking at strengthening our defense ties. This is something which we are already intertwined as two countries, and that is always going to continue in the longer term because of the strength between the two countries. It's a time-tested partnership that is there. We will be looking at seeing how can we supply more into Russia and vice versa. The obvious areas are engineering products, pharmaceuticals, IT, and so on. I think one concern on industry side is always going to be with respect to sanctions and that risk. But I think from an industry side, if the opportunity is there, we'd be very happy to look at Russia as a larger market to strengthen our relationship with.
You talked about sanctions, and that brings me to the issue of U.S. tariffs and the possibility of a deal with the U.S. It was the FICCI AGM where I spoke with the Commerce Secretary, and he, for the very first time, said that there are two parallel negotiations underway with the U.S. But is hope now fading for either of the two deals to go through with the U.S., one to deal with the reciprocal tariffs and the other to deal with the larger bilateral trade agreement?
I think not at all. I'm still very hopeful of a deal happening. Commerce Secretary also was fairly positive that a number of the points have been discussed. It is hopefully a matter of time, and a deal is likely to be around the corner, although you never know till last minute or till the deal is signed that it's going to happen. I think on both sides, there have been some concessions, but India has very clearly stuck on its sensitive issues, always putting the country first. So to that extent, I'm hopeful that a deal will be signed, and that will be great for whether it is the rupee and an end to the tariffs that would be very good for certain industries.
Yes, the wait continues on that front. But speaking of suspense and the wait for the budget is on. Pre-budget consultations underway, and I know that FICCI's presented its budget wish list. What are you baking in terms of expectations, the top three priorities that you believe the government must focus on, Anant?
I'd say one is Atmanirbharta. I think continued focus on investing in defense. There is a large change that is happening with respect to technology on the defense side, and we need to continue to invest on that front. We've asked for a 30% increase in capital investment on defense expenditure, a 10% increase on operating expenditure, and about a 10,000 crore outlay on DRDO-related investments. The second ask is on export promotion. There has been the export promotion mission that has come about, various corporate guarantee schemes. But RODDEP, we feel the outlay is still too small. We have recommended an increased outlay on RODDEP. The third is the critical minerals program that has come about. On that, there is a minerals tailing recovery program that we are recommending, that use of fly ash, leftovers of the mining. How do we use technology to tap critical minerals out of the tailings? So a critical minerals program is something that we are recommending. And finally, on the electronic side, we've seen great headway and progress over the years. This is a space where we are recommending India's largest IT industrial park, where you can have the entire value chain in one place, increase the value addition, have OEMs and assemblers all together in one place, much like the model that we've seen in Shenzhen or Vietnam. I think that will further propel growth of the EMS sector.
All right, well, we'll have to wait till for the 1st of February. It's a Sunday, but let's see if the budget is going to be on the 1st of February, and all will be revealed then. Anant Goenka, once again, wish you the very best of luck for your new innings, and thanks so much for joining us here on CNBC-TV18. That's the president of FICCI with his budget wish list and more. Time for us to head into a break, but up next, just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. That and more when we return. E-commerce platform Meesho's 5,000 crore rupee initial public offer was subscribed over 2 times on the first day. Retail investors showed strong interest in the offer, with their portion being subscribed 3.59 times. The quota allocated for non-institutional investors was also fully booked. The e-commerce major raised close to 2,500 crore rupees from anchor investors ahead of the IPO. But the big global story, a CNBC-TV18 News break now confirmed just months after getting relief from the Supreme Court, JSW Steel sells 50% stake in Bhushan Power to Japanese conglomerate JFE for over 15,700 crore rupees. Nigel is here with the details of the deal and why the market seemed a little disappointed when the news initially broke. Nigel.
Well, that's right. A big deal coming in from JSW Steel, with JFE going ahead and picking up close to around 50% stake in BPSL. And for an equity value of around 15,750 crores, which would mean that the total assets equity value will be roughly around 31,500 crores. You put in there a debt of roughly around 5 to around 6,000 crores odd. So the enterprise value that this deal is being done at is roughly around 37,000 crores or thereabouts. Remember, BPSL, they had a debt of around 5,000-6,000 crores odd. And also in the first half of the year, the total EBITDA that they did was roughly around 1,500 crores, which means that for the year, on an annualized basis, they could do around 3,000 crores. Valuation-wise, well, the deal appears to be done at around 12 times EV on EBITDA, which is fair. Pretty good valuation actually is what they have got. How does the holding structure change? Well, as of now, the promoter entity of JSW Steel had in their personal capacity close to around 17% stake in BPSL. And the listed entity, JSW Steel, had close to around 83%. Now, post JFE coming in there, JFE will have 50% stake in BPSL, and JSW Steel as well will have close to around 50% stake in the company. Now, going by the way the shareholding pattern is changing, out of the 15,750 crores odd of equity valuation that JFE will be putting in, well, it appears that JSW Steel will get around 10,300 crores, and the remainder could go to the promoter entity itself. Then why did the stock see some kind of selling? The street was sniffing a much higher number in the vicinity of around 45 to around 50,000 crores. And the enterprise value now is around 37,000 crores. So maybe some disappointment on the expected valuation out there. And the rationale of the deal as well is something that the street is coming to terms with. The completion is likely in the next 6 to around 9 months. So it appears it's a big boost actually coming in for JSW Steel. However, the valuations is something that the street is actually split on, which caused the stock to remain a little bit nervous.
Nigel, many thanks for joining us. The other big story, India and Russia all set to bolster economic ties as President Putin arrives in New Delhi on a state visit tomorrow. India is likely to push for increasing pharma, agri and textile exports. Prime Minister Modi and President Putin will also discuss a free trade agreement which could be signed in the future. Parikshit joins us now to take us through what is on the table. Parikshit, what can we expect?
Well, economic cooperation and having closer economic ties with Russia will be India's #1 priority during this visit. Both sides recently initiated discussions on an FTA between India and the Russia-led Eurasian Economic Union. We're not expecting any finality during this visit, but yes, the discussions between President Putin and Prime Minister Modi are likely to put those discussions on a fast track. There is a massive trade deficit when it comes to the India-Russia partnership. The FY25 trade numbers are to the tune of around $68 billion. India's exports to Russia were just about $4.8 billion. The trade is largely in Russia's favor because of India's large-scale dependency on Russian crude. So what India is going to convey during this visit is that Indian exporters must get more market access in Russia, and Russia must buy more. So be it pharmaceuticals, be it textiles, be it agriculture products or steel, we would like Russia to be a bigger buyer of Indian goods. And therefore, discussions on more local currency settlements, trade facilitation, economic cooperation, healthcare, all these MOUs or a package of agreements supporting economic cooperation are likely to be signed during this visit. A key outcome will be the MOU between India and Russia on migration and mobility of skilled professionals. We've seen a large number of Indians going to Russia for employment, a lot of them getting trapped and ending up serving the Russian army against Ukraine. So we don't want that situation to arise. We want to have avenues for legal migration from India to Russia. So that will be the highlight during the visit. In terms of the defense partnership, while it's very, very critical, there will be continuity. We'll explore cooperation in co-production, co-development. There will be a strong pitch from President Putin to sell, co-produce and further develop the Su-57 fifth-generation fighter jet. But India is going to make it very clear that we've not taken any decision on either Su-57 or F-35s, and there cannot be any discussions even at this juncture. On the oil trade, we've seen November oil imports from Russia at an all-time high of almost 1.9 million barrels per day. This is because the sanctions were coming into effect on the 21st of November, and there was front-loading. Post that, we are seeing from analyst reports that the oil imports from Russia from non-sanctioned entities is to the tune of 800,000 barrels per day. This is likely to continue till larger secondary sanctions are imposed by Russia. So the oil trade is likely to continue via the non-sanctioned entities. Overall, India and Russia would like to signal continuity of the larger strategic partnership between the two nations.
All right, Parikshit, many thanks for joining us. And do remember to tune into CNBC TV 18. Parikshit will be tracking President Putin's visit to India. And staying with the Russian president, President Putin and negotiators from the US appear to have failed to achieve a breakthrough on securing a Ukraine peace deal. Now, Putin met with President Trump's special envoys, Steve Witkoff and Jared Kushner, for nearly 5 hours. Remember, the Secretary of State, Marco Rubio, not present at any of these meetings. Russian officials have said that talks were constructive, but no compromise was reached over territorial concessions for Ukraine. Putin has accused Europe of preventing the US administration from achieving peace on Ukraine. He added that Russia is ready for war if Europe starts it. Now, the government has withdrawn its earlier directive to phone makers, which had made it mandatory to preload the Sanchar Sathi app. That's the state-owned cybersecurity app. Now, the U-turn comes days after the Telecom Ministry's order raised concerns over possible snooping or mass surveillance. Responding to the Congress MP Deepinder Huda's question in the Lok Sabha today, Telecom Minister Scindia said that even if the app has been installed, it would not be operational unless the user registers on it. But post that intervention in Parliament, the government has now decided to withdraw its directive asking for the pre-installation of the app to be made mandatory.
जब सिस्टम के अंदर प्रीलोड की रिक्वायरमेंट होगी तो डिसेबल करने के बाद भी सारे फीचर्स डिसेबल होंगे कि नहीं होंगे किसी यूजर्स को ये बात पता नहीं चलेगी। तो कहीं ना कहीं ये जो एक अधिकार है निजता का, उस पे कोई बड़ा प्रहार तो नहीं है।
क्योंकि ऐप फोन पे है, इसका मतलब नहीं है कि वो ऑटोमेटिकली ऑपरेट हो जाएगा। जब तक मैं उपभोक्ता के रूप में उसमें रजिस्टर ना करूं, तब तक वो ऑपरेट नहीं होगा। और मैं उपभोक्ता के आधार पर, जैसे मेरे फोन पर सर ढेर सारे ऐप्स होते हैं, मैं उस ऐप को भी दबा के मैं डिलीट कर सकता हूं। तो ये लोकतंत्र में पूर्ण हक और अधिकार नागरिक का है सर।
कहीं ये जो स्नूपिंग के प्रश्न उठ रहे हैं पूरे देश में, इसको लेकर सिविल राइट्स एक्टिविस्ट से, कंप्यूटर साइंस एक्सपर्ट से, उनको लेकर मंत्री महोदय क्या कुछ कहना चाहेंगे?
फीडबैक हमें मिलेगा, उस फीडबैक के आधार पर अगर उस ऑर्डर में भी हम लोगों को कोई चेंज लाना है, उसके लिए भी हम लोग तैयार हैं। ये मैं अवश्य कहना चाहता हूं कि इस ऐप के आधार पर ना स्नूपिंग संभव है, ना स्नूपिंग होगा।
Ready to act on feedback. That was the telecom minister. And as we pointed out, the government now issuing a statement saying that the pre-installation is no longer mandatory. So it has withdrawn its previous directive, making the pre-installation of the Sathi app mandatory. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. We're back in a minute with more. Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. E-commerce platform Meesho's 5,400 crore rupee IPO is fully subscribed on day one. Retail portion gets booked in the first hour, but higher allotment to local funds draw the ire of some global investors who walk away from the anchor book. Reply All, an apparel brand focused on all-day clothing, has raised 6.8 crore rupees in its first funding round led by Sparrow Capital and Antler India, with participation from Bharat Founders Fund, DevC and several D2C founders. The proceeds will be used for product development, expansion of the material and design pipeline and scaling the brand's presence across markets. Former Indian cricket captain MS Dhoni has invested in Super Health, the healthcare model built around zero wait time and fixed pricing. Super Health has launched its flagship facility in Bengaluru as part of its plan to establish 100 hospitals across India. Amazon throws down the gauntlet to Microsoft, Google and the entire AI ecosystem, announces next generation of chips, large language models and AI agents at the annual Amazon Web Services Summit in Las Vegas. Anthropic, the artificial intelligence startup backed by Google and Amazon, has hired the law firm Wilson Sonsini to prepare for an initial public offering that could take place as early as 2026, the Financial Times reported. The startup has also discussed with major investment banks about a potential IPO. Well, those were the headlines we've been tracking for you this evening. On the hot seat today is a founder addressing one of the most underserved but critical gaps in healthcare: automation in histopathology, the core of cancer diagnostics. Deep Tier healthcare automation company Morphle Labs is building next-generation robotic and imaging systems for tissue diagnostics. The venture has raised $5 million in Series A funding from Inflexor Ventures to take its physical AI platforms global. Its flagship products, Robotome, a robotic microtome, and Morpholens, a high-throughput slide scanner, claims to ease a global talent crunch in pathology and dramatically cut diagnostic turnaround times. Now, to tell us what this fundraise unlocks and how Morphle Labs plans to redefine tissue diagnostics globally, joining me now is its founder and CEO, Rohit Hiwale. Rohit, welcome to Startup Street. You describe, Morphle as building physical AI for our viewers. What does physical AI mean in the context of healthcare, and how will Morphle systems move the needle on turnaround time and diagnostic accuracy for cancer patients?
Yeah, hi. So physical AI is basically, you can think of it as intelligent software with hands.
Okay.
And right from the simple pick and place modules to, very complex, handling of really fragile material, which is a must have in a world of biology or healthcare. I think that is where the lot of juice is in terms of, going to the next level. So that's like the basics of physical AI for you. Yeah.
All right, Rohit, let's talk about your flagship products. While Robotome claims to slice biopsy blocks at twice the speed of an experienced histotechnologist, Morpholens claims it can digitize 100+ slides an hour. How do the two platforms integrate to create an end-to-end automated workflow? And what are pathologists telling you after using them in real-world labs?
So I think healthcare is one industry where there are a lot of bottlenecks in terms of, despite having the smartest doctors across places like India and US, there is a lot of backlogs in terms of, the back-end work, which feeds the doctor, So basically, there's a lot of grunt work that needs to happen before the doctor can, solve that beautiful puzzle that they like to solve and, of course, help the patients. But there's a lot of back-end, which is pulling the whole healthcare system back. And I think these two platforms combined are kind of solving that critical gap. This is like the slowest moving step in cancer diagnostics. People have weeks of wait times, and that whole wait times will actually come down to days, and even maybe 8 hours, in hours.
Sure.
So I think that's a big deal. So doctors can make the patient happy, and our job is to make the doctors happy. That's as simple as. Yeah.
All right, let's get to this funding. You're scaling manufacturing to meet rising global demand. If you could elaborate on those plans, what does the order pipeline look like in the US and Europe?
So we have a huge pre-order pipeline of, pre-orders, 100 plus customers waiting on us to deliver. This is like a very surprisingly good demand from the market, I would say, because the problem is real and the need is so urgent that there's a huge pipeline. We have deployed the first cohort of machines and the response is pretty amazing. People have already seen backlogs being cleared off, getting super consistent quality. And I think that is something people thought would not happen for next 10 years.
Sure.
At least.
So how soon will the product rollout happen?
So the real product rollouts will happen in Q2 of 2026.
Okay.
But we have the first cohort already running. It's beta testing happening at multiple labs in the US to begin with. And we have a big plans in the Europe as well.
Okay. Morphle has filed over 80 patents across robotics, optics, and imaging. And, you touched upon this earlier. With 60% of global labs reporting unfilled positions, the need for automation is urgent. So what's the core IP moat you've built that competitors can't easily replicate?
So I think I would say the core moat is the right combination of hardware and software. That's having the best minds in both the worlds and making them work together and actually taking this whole hybrid approach to the next level. That has been the core moat. And everything that we do is kind of unique because the problem we are solving is so unique. So we stopped at 80 because we ran out of money long back.
Okay.
So
all right.
But yes, I think so. Yeah, there's a lot of depth to the innovation that we are doing, I would say.
And hopefully we'll see a lot more happen in the future. But you've got 2 flagship products as of now. What are the next broken links in the diagnostics chain that you want to fix? And what might a fully automated, integrated tissue diagnostics workflow look like, let's say 5 years from now?
Yeah. So we have automated the second half of tissue diagnostic workflow. There is a first half, which feeds to the robotome, the slicing machine, right from the surgeon's biopsy, processing that biopsy, fixing it, orienting it in wax, creating this something called as tissue blocks. That creation of those tissue blocks is not automated right now, and these are again pretty difficult problems to solve, as difficult as autonomous robotic surgery. So that is the first half, which is still unsolved. We are doing the second half, which is the more juicy one to begin with, the bigger need, but the first half is still wide open.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Rohit, for joining us on Startup Street, and wish you the very best with all your growth plans.
Thank you. Thank you, Shraddha. Thank you. Bye-bye.
With that, it's time for a short break. But coming up next, Absolute is gearing up for global expansion on the sidelines of the IVCA Green Return Summit 2025. We catch up with founder and CEO Agam Khare to learn more about the company's growth plans. Stay tuned.
Well, homegrown consumer-focused VC firm Fireside Ventures has announced the final close of its fourth fund with a corpus of 2,265 crore rupees, or about $253 million, which was raised through its GIFT City Feeder Fund and India Master Fund. Now, Fireside Venture Fund 4 has secured commitments from a diversified base of Indian and global investors. Since its inception in 2017, Fireside has been the first institutional investor in more than 74% of its portfolio companies, and now backs more than 60 consumer brands. Now, with this fund, its total assets under management to date stand at around 5,300 crore rupees. But for more on the investment strategy for this fourth fund and more, joining me now is Adarsh Menon, the partner at Fireside Ventures. Adarsh, welcome to Startup Street. Thanks for your time here. You know, this fourth fund at $253 million, I believe, is your largest fund yet, and you've raised this from both global and domestic investors. How hard or how easy has it been to raise this kind of money, and what's the sense you've got from investors, especially globally, about the confidence they have in India's consumer story?
The story is very strong, Ritu, and that has helped in us actually raising this fund in pretty quick time. But it's also validation of a couple of things other than just the fundraise, right? The first thing is the vision with which Fireside was started 8 years ago, which is to build a portfolio of iconic brands and, importantly, an institution that is designed to make that success repeatable. That has gotten demonstrated in the track record of the fund so far, you know, the 8 years that we've been in business. So I think that has clearly helped in generating a lot of investor interest, both from India as well as abroad. And the second thing, and you allude to it, is the India consumption opportunity is really, really large and exciting. You know, we are very confident that over the next few years, India will become a $4 trillion consumption economy, right? That makes India the single largest, fastest growing consumer market. And that, again, obviously generates a fair amount of investor interest, and everybody wants to be part of the action.
Well, Adarsh, if you really talk about the investment thesis for this fund, I mean, where are you going to bet the money within the consumer segment, of course, which is what Fireside does? What will be the focus categories?
So we continue to be a consumer-focused fund, Ritu, because we believe that the consumer opportunity in India itself is just about, we're just about scratching the surface, right? So, you've tracked the fund for over the last 8 years. When we started, we were largely, doing India 1. Then after that, just as part of regular migration, we went to India 2. In Fund 3, we've done a few investments, which are both India 1, 2, and 3. In Fund 1, most of our portfolio were largely what were called D2C brands. Fund 2, we started investing in companies that also have an e-commerce business, that also have retail. Fund 3, actually, we've seen businesses who've also gotten built out in a very big way on quick commerce. What's also happened is over the period of the lifetime of the fund, the sectors that we've invested in, while they've all been consumer, the sector has now expanded from just pure FMCG to also vertical commerce, lifestyle, food and beverages, home, fashion. I think consumer in general is a very, very exciting space for us. And we see ourselves doubling down more and more in the consumer space itself across categories.
All right, got that. But what's in the pipeline in terms of investment? Have you already lined up some companies? And how soon before you start deploying the money? And also, what kind of returns are to be expected from this fourth fund?
So it's an ongoing process, right? The good thing is we are seeing a lot of very high quality entrepreneurs embrace entrepreneurship. A lot of them have very good pedigree from great quality institutions, great work experience, so they're very savvy in how to build businesses, attract large, large teams, run companies very well. So we are seeing high quality entrepreneurs. So the deal flow process, as it's called, is ongoing. Right, so that those thesis areas and those areas of opportunity and that pipeline is something that is ongoing now for quite some time. See, in terms of returns, if you look at our track record, Fund 1 has now been, Fund 1 is a 2018 fund, so we are now in the 7th, 8th year. We've already returned more than 3.5x of capital of Fund 1.
Fireside has been an early investor in companies like Mamaearth, Boat and whatnot. But with consumer behavior shifting so quickly now, where do you others see the next breakout categories emerging in 2026 and beyond?
So several consumer spaces, Ritu, we believe will become very, very large in terms of where they are today and where they can go to. We think the entire health and wellness space, where consumers are getting increasingly more conscious about health, wanting to take their health in their own hands, looking at health and wellness as a continuum as compared to just eating healthy, but also devices, also services. We think that space is going to become really, really large.
Well, Adarsh, even as you say, you're just scratching the surface. Your AUM is now about 5,300 crore rupees. How do you see this growing over the next few years? And how does Fireside avoid this classic VC challenge, that is more capital chasing limited high-quality consumer companies or opportunities?
Yeah, if I look at our pipeline today, it is certainly not limited. Like, see that 3-4 things which I think are coming together wonderfully well for the ecosystem. Of course, there is consumer demand and there is consumer traction. And the fact that while the numbers are very exciting in the sense, $4 trillion of consumption in the next 4-5 years, that's a very big number in itself. But to me, what is personally even more exciting is that the shape of this 4 trillion will be very different from what it is today, which means there will be a lot more Gen Z consumers, which means there will be a lot more senior consumers, which means there'll be a lot more Bharat consumers, which means there'll be a lot more online consumers. So the shape of that consumer will start looking very different. I think that makes it so exciting, which then translates into so many more opportunities for brands to get built. The second thing is, I mentioned it earlier, high quality entrepreneurs, choosing to embrace the startup journey and become entrepreneurs. And then, when we jam with them, the quality of that conversation is just so rich. Third, of course, now to build a brand digitally is so much easier than what it used to be earlier, right? Thanks to Meta, thanks to quick commerce, thanks to e-commerce, thanks to Google. I think all of that ecosystem is coming together really, really well. If you just now combine all of this put together, I would say it's still very much scratching the surface, and there's just a lot of opportunity, in the coming years, and I would say decades for Indian consumer as an overall business.
All right, Adarsh, we'll leave it at that. Thank you so much for your time here on Startup Street today. Thank you.
Well, moving on. Absolute, founded by Agam Khare, is using microbes as microfactories to create biological alternatives to chemical farm inputs, whey protein and even leather. With 12 products in market, 20 lakh farmers using them and a pipeline of 400 plus biotech solutions, the company is now preparing for global scale. On the sidelines of the IVCA Green Return Summit 2025, Agam Khare tells Aishwarya Anand what's next. Take a look.
Agam, give me a sense of what Absolute does. What does your business model look like? How many verticals are you running? Just give us a sense of what the company does.
Absolute is primarily a biotechnology company. We use microbes as microfactories to create biological solutions to very large problems that our world faces, primarily in areas of agriculture, where we make alternatives to harmful chemistry-based farm inputs that go into agriculture. So we make biofertilizers, biopesticides, biostimulants, not me-too products, but very deep R&D-driven, extremely high efficacy-based products which can meet the parity of chemistry efficacy or be better than them. Then we have a second vertical where we create novel proteins. India does not have whey protein, for instance. So we make whey protein using these microbes through route of rapid fermentation. We make other proteins which can replace sugar, which are the exact replica of taste of sugar. And then we make enzymes and proteins which can have anti-inflammatory property and can go into therapeutics or OTC. And then we have a work around materials where we use the same science to basically make alternatives to leather. And we have made alternatives to calf, ostrich, and crocodile skin.
So how many products have you shipped till now? What does that number look like?
So we just went live with our agriculture products about 2.5 years ago. So about 12 products are now live in market. One of our product, which is a DAP alternative product, a biological product, has become super hit with farmers in India. Almost 15 lakh farmers in India bought it the last year. Almost 3 times that number should be buying in this year. 20 lakh plus have already bought it this year. So that's one of the flagship product, for instance. And then there are 12 products in market on the agriculture side. Our protein products are now hitting the market. We have already got a large order volume from leading companies in India. And now we are looking to supply also in Middle East and the other parts of the world.
How many farmers are you currently working with? What kind of impact have you created on that front?
So as I said, last year about 15 lakh farmers bought our products, but we are also demonstrating at the same time to many more farmers. So we typically work with close to about 30-40 lakh farmers between that number today directly, and we run demonstrations with them. We give these biological inputs to them, but since we are already working with them, Absolute was based in the thesis of solving problems for farmers, not just selling a product. Okay. So when we go to work with them, we also engage with them on many other layers. So for instance, getting additional revenue through the carbon credits, for instance, and thereby doing agroforestry on their periphery of farms. That's one of the big things we have done so far. For instance, this year alone, we have enabled these farmers to plant more than 3 million trees, 30 lakh trees across their periphery of farms. We are going to sort of plant before March another 2 million trees. So that's one of the additional incomes that farmers who are pursuing these inputs can also pursue. It becomes sort of either a recurring revenue because these are fruit trees, so they can have recurring revenue. It also helps our input business to be sort of more stable and go at scale. Then we enable these farmers to do biochar, enhanced rock weathering, whatever helps them earn more revenue on that acreage. We give those additional facilities to those farmers.
I think the last you raised funds was in 2021? 2021? End of 2021. It was $900 million, if I am...
No, it was about $100 million.
It was about $100 million. Okay, all right. I want to understand, where did you deploy that capital? Are there plans of raising funds next year, next year? Is another round of fundraising on the cards for you?
Most of the capital, since we are an R&D company, goes into doing R&D and regulatory needs that are there in India and the rest of the world, wherever we want to launch our products. So that's the large part of capital deployment. Then some part of the capital also goes into running demonstrations to people, because only once they see, they believe, that's when they pick up the products. So that's where we have spent most of the capital of what we have raised. We probably may not raise in the near future, but as we go along and if the business needs, we will definitely look to raise more capital and solidify our presence as pioneers in this area.
So which means you essentially have enough capital in the bank right now.
That's right.
Okay. Talking about that, also help me understand, where does your revenue currently stand? Are you profitable already?
On an operating EBITDA level, we are already profitable, but because R&D takes a lot of money before it can yield enough results, therefore, on a pure PAT basis, we may not look profitable, but then by Q4, our view is that the company will turn PAT level profitable by the Q4 of this year.
What does the next 3 to 4 years look like for you?
So we have built a very large repository of these novel microbes that we have sourced from across the world. So this library we call as Nature Intelligence Platform today is about 50,000 unique species of microbes, strains of microbes. And these microbes can then be used as microfactories to create a variety of solutions. That has resulted into us having a very strong pipeline of over 110 products across range of these 3 sectors. That places us in a very strong position for future growth. Our regulatory needs for a lot of these products are already met. Some of them are very close to being met across range of countries. We have got permissions in as far as in US and about 10 states to supply our agriculture products. We have massive permissions across India, across Middle East and Southeast Asia. So we're looking to spread our wings now.
Moving on, e-commerce platform Meesho's 5,000 crore rupee initial public offering was subscribed over 2 times on the first day. Retail investors showed strong interest in the offer, with their portion being subscribed 3.85 times. The quota allocated for non-institutional investors was also fully booked. The e-commerce major raised close to 2,500 crore rupees from anchor investors ahead of the IPO. Well, the Indian IPO season has been exceptional, but for Peak 15, it has been transformational. With 3 back-to-back exits and the currency tailwind working in their favor, the firm has bagged gains that look large in rupees and even larger once converted to dollars. $3 billion, that's the pot of unrealized gains the fund is sitting on. Rachna joins us now.
What we're seeing here is not just a strong IPO market, but a rare alignment of timing and currency that has dramatically magnified Peak 15's returns. Peak 15 first backed Grow in 2018, investing up to 50 crore rupees at a time when the dollar cost only 64 to 69 rupees. When Grow listed, the firm realized 1,580 crore rupees. This was at an exchange rate of 88 rupees to the dollar. That works out to about $159 million. Early dollars in, high value dollars out. That's the underlying story here. Pine Labs shows how long this currency advantage has been building. Peak 15 invested in the company across 3 cycles. First in 2009 when the rupee was between 48 and 50 rupees. Then in 2013 when it was 54 and 58. And again in 2016 when it was at 66 to 68. At the IPO, their exit was worth 510 crore rupees. That converts to roughly $58 million at today's rates. Capital deployed in India's strongest rupee years is now being monetized in India's weakest rupee years. And that alone boosts the fund's dollar returns. Peak 15 similarly entered Meesho during 2018 and 19 when the rupee traded between 68 and 72. Their IPO cash out, which was soon, would be around 190 to 200 crore rupees. translating to about $21 to $22 million at 90 rupees to a dollar. Again, early entries when the rupee was firm, exits when the dollar buys you far more. And Wakefit would follow the same pattern soon. Peak 15 backed the company between 2019 and 21 when the dollar was around 70 and 72 rupees. Its upcoming offer for sale for 397 crore rupees comes at a time when the dollar is about 90 rupees. Put all of this together and the picture becomes clear. Peak 15 has not only timed its startup bets well, it has timed its currency cycle exceptionally well. Money invested when the rupee was strong and realized when the dollar is at its peak has turned good exits into great ones. And the numbers really underline that. Across Grow, Pine Labs, Meesho and Wakefit, Peak 15 has realized close to 2,500 crore rupees this IPO season. And that's just this quarter. We still have the IPO season ahead of us. And this is actual cash that they have booked out. On the other side, the value of what the firm still holds, the unrealized part, is now approaching $3 billion or well over 24,000 crore rupees. Taken together, these exits represent one of the strongest return curves in recent VC memory. Peak 15's combined investment in these companies sits at roughly 800 crore rupees. And against that, the firm is staring at more than 30 times in value between realized and unrealized gains. Back to you.
Well, thank you, Rachna, for those details. Appreciate you joining us. And with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.
A very special conversation as always. It is with Amit Singhal of Asian Paints, and this one comes after 2 years of disruption in the paint industry. The previous conversation that we had, and from there to a new place as well. So a lot to speak with. Amit, usually you speak only after quarterly results, but I'm glad that I got your time. And I know you're always candid on interviews, but this time around you have to promise to be even more candid. Will you?
You can expect anything from me.
Perfect. So let's start with, the last 2 years. So much that has happened. From an Asian Paints standpoint, from a consumer business standpoint, from the environment standpoint, from competition, so much has happened. What consumed you most over the last 2 years?
See, I think the best thing was that, this time was very, very exhilarating because we felt that, there were lots happening in the marketplace. There was lots happening at the competitive ends to that extent. And the market was not very great from a point of view of a demand perspective. So I think there were challenges all across in terms of what came in. And what possibly occupied my attention was that during these times, how do we really navigate the brand and really take it ahead and look at possibly playing to our strengths and really seeing that we are scoring centuries as we kind of do stuff.
The street was also fairly on the tenterhooks over the last 2 years. In the history of Asian Paints stock market performance, the last 2 years were perhaps one of the darkest when it came to returns or negative returns, etc. So at that point in time, again, like I said, what occupied your mind space more? Was it the dealers of Asian Paints which were being taken away by others? Was it, the employees of Asian Paints which were being taken away by others? Was it the consumer sentiment itself which was lower? You had also spoken about this, low correlation between consumption GDP and GDP at large. So all these factors that played out, what took your mind space the most?
See, I think it was the whole area of strategizing in terms of that if you have to deal with this environment, everything is important. It's not solely that if we take care of the dealers, that's something which is what is the end result. We had to look at in terms of from the point of view of the brand, the innovation in terms of what we bring, playing to the distribution strengths which we have, the technological strengths which we bring onto the table, and also lead the game from a point of view of executional excellence. Because this was a time when possibly, the brand can show its best in the market. And therefore, what occupied my mind was only one word: excellence everywhere.
All right. And 2 years later, as you stand, consumer sentiment is at the inflection point of improvement. Competitive intensity, while it stays, the disruptor is not the disruptor anymore, is an incumbent. And at the same time, you have a lot of your business excellence, etc., consolidated. So from where we are, how do the next 2 years look to you?
So I think, first of all, what we are looking at is really doing many things in terms of the market, which possibly is a step forward from what we have been doing to that extent. So the first of these things is that continue kind of building the brand to new heights. And in that perspective, we recently just tied up with Indian Cricket. We are the official partners, color partners for BCCI and for the Indian home cricket. And we are doing initiatives like this to kind of really see that today, whether it is a top of mind awareness or it's a share of search, Asian Paints is really the tops in terms of really continues to be the tops in terms of doing that. And in that regard, we are also looking at strategizing very differently. We think that today is the right moment in terms of looking at a regionalization of your strategy, where you can't be looking at one national strategy which kind of comes to fore. And therefore, another initiative which we have taken is regionalization, where we are saying that each state, each region has its own nuance, add the culture, the design.
But isn't that something that Asian Paints always did with so many regional ads? I remember those Pongal packs as well, which were small for just those bulls, etc. What is different this time?
No. So the regionalization place is now very different because you're looking at seeing at people's choices. You're trying to appeal to the culture of the region very, very strongly from a point of view of saying that now even our packs are regional. Okay. Now, no one has attempted that across the global arena in terms of looking at it. We have regional packs which appeal to the culture, design, and so on and so forth. We have regional colors which appeal to only that community in a very strong way to that extent in terms of what's coming in. And not only that, the whole nuance in terms of how we are seeing people see decor in those regions, we are playing to that bit because we feel that today, I think IPL has created a lot of regionalization to that extent, and people are really region proud, and we are appealing to that pride in a very strong way. So that's one very big area in terms of propelling the brand and seeing that we put the brand equity right up front and a strategy which possibly gets us right into the homes.
So what does this mean in terms of numbers? You this year have guided for mid-single digit sort of revenue growth, almost high single digit, low double digit volume growth. How long before we get to double-digit volume growth and double-digit revenue growth from an industry standpoint?
So if you look at even now, while you are seeing some shoots in terms of the demand. We are not seeing that there is belligerence, there is full exhilaration coming into the market to that extent. We feel that today the rural markets are just coming back, even the urban centers are just trying to show some spark. I feel that possibly it will take some time before we really get onto the parameter of really double digits and so on and so forth.
How long will it take?
It's very difficult to say, but I would say that possibly another 2 quarters is something we need to kind of watch out for sure in terms of what we are looking at. So therefore, right now, I think the whole peg is in terms of saying that we continue to grow higher than the market, and that's the pitch in terms of what we would take.
And you haven't been doing so for the last few quarters, and now you're confident of doing that, right?
The first 2 quarters of this year, we have grown higher than the market to that extent. And as you look at the H1, we have grown much higher than the market overall.
So you will continue to gain market share?
Yes, absolutely.
Okay, what about, you strengthened some of your internal sourcing with backward integration, also looking to diversify in the Middle East with the new capex that you've announced out there as well. So all these factors, how much will that add to your savings and how much of that will add to your international revenue as well?
So see, it's a very calculated move in terms of what we have taken from a point of view of looking at backward integration and also looking at saying that we are literally self-sufficient with respect to some of our core raw materials to that extent. And today what we have put in Fujairah in Dubai is a white cement plant of almost about 2.75 lakh tons capacity. It kind of really suffices us for possibly some of our products which we are selling in India to that extent, and it kind of gives us a lot of cost excellence which comes in to that extent, and that's been one aim. The second area has been the area of what we can do in terms of the international market. So we are marketing the product now, right now in UAE, parts of Asia, and now going to Africa in terms of looking at it to that extent. So the idea is that possibly, take that space, which is very important for us. At the same time, keep on adding to the cost excellence part in India, which is just a start. The second thing which comes in is even more in terms of what we will do as we kind of unleash in the first quarter of next year.
Which will be what?
We are looking at a new emulsion. So we have a 3,000 crore facility which is being put up at the Dahej. So we basically start that facility, and that is something which possibly in the world there are only 4 or 5 suppliers to that extent. It's the first time Asian Paints is invoking their technology, and it's a new age emulsion, environment friendly, something which really gives us a lot of cost excellence, and not only that, but some very innovative products.
You're speaking about premiumization as an important theme for you guys, but economy is still the bedrock, right? What is it that you're doing to ensure that you are leader there, you are growing there, and you are profitable there, and not losing out on earnings despite the growth?
So see, Asian Paints has always been known to create categories, okay, and we have now really approached the category of distempers also by launching a product called Neo. So it is a different category called latex in terms of what we have introduced, so that we are able to galvanize the people and upgrade them from distemper to kind of using this latex. And I think this is something which is a big step, because it's a large bucket in that economy segment in terms of what comes in. Similarly, when you look at the premium and luxury segments, we have been launching a huge number of variants so that we are able to kind of, in that pyramid, upgrade the people to the next best solution in terms of what they can get in. And not only that, from a premium to luxury, we are invoking this brand called Nilaya now. We've introduced a product called Nilaya Arc in the market, a Nilaya Natural. And these are all super luxury products where we are kind of showing to people that even in the premium category, you can get one wall with this luxurious product which kind of adorns your home to that extent. So the entire thing is in terms of looking at that there is total upgradation happening at all levels in terms of what we can do. In a sense, you can really push the pyramid upwards.
So safe from here on, post the next 2 quarters of still some wait and watch from a consumer standpoint, going forward, the difference between value and volume will narrow because of the premium thing that you're talking about. Is that a possibility?
So we have spoken of that gap being about 4 to 5%. I think that gap will remain, because
throughout?
I've always maintained, because the economy is a very, very big segment, okay? And today, if you want to, really reduce that gap to 2%, you will talk of degrowing in the economy segment to that extent. So I would say that 4 to 5% is a reasonable bet in terms of looking at maintaining that band, at the same time having a strong product mix.
And that still holds with 18 to 20% margins, because now whatever savings you will get, you will deploy it back towards building the brand, building growth.
Absolutely.
So say high single-digit sort of revenue growth, double-digit volume growth, and 18 to 20% margins is the new normal for Asian Paints?
So that's the margin guidance which we have always maintained, and I think the great part is that despite all what we have seen in the market, we have kept our head on the shoulders in terms of what we are doing. We've not kind of taken the whole route of discounting or pricing in terms of that, but we've taken the route in terms of building the brand and playing to our strengths.
What are you most proud of over the last 2 years?
I think the fact that we have been able to kind of really build the brand to a new high, and what we have been able to kind of get nuances and being very strongly related with home as a brand which no other brand is. So I would say that Asian Paints' whole attempt to kind of really get into the consumer's mind has been very, very strong, and we think we are appropriating home more than ever before.
What are you most disappointed by over the last 2 years? What is the one thing what do you regret the most over the last 2 years?
I would say that from a point of view of saying that we would have liked to grow much faster. I think that is something which possibly I regret to that extent. I think we could have possibly put more drivers in terms of looking at what we could have driven the market far more strongly. But I think given the circumstances, I would say it has been quite good in terms of what we have performed.
You yourself have your ear very close to the ground, in fact feet on street. You take over 300 flights every year, know every dealer by their name, every dealer by their family members, etc. I think it's something that is indoctrinated in Asian Paints culture. What have you noticed over the last 2 years, what Asian Paints has done versus what competition has done? What have you done to ensure that your dealerships stay while within the guardrails of the law?
So we felt that one of the big things which has held by us is the relationships. It's not only about business, it's not only about margins, it's not about profitability. It's about relationships, it's your personalization, it's your ability to kind of really be empathetic about the business in terms of what you're dealing in. And I think that's something which I have tried, that it's not only me, the face of Asian Paints, but my entire leadership and my people who believe in that relationship very, very strongly. And that is something which I think is the trump card which Asian Paints hold.
One of the things, if I looked at pure business strategy, if a disruptor had to come and take some share from the incumbents, the obvious thing to do, given the long history that incumbents would have, is say that this is the paint of the old and we are the guys who are the paints of the young. And that's understandably some of the peers who've done that, right? How do you navigate or how do you mitigate that strategy?
See, at the end of it, the brands, the whole area of legacy and trust is a very big thing. There can be new disruptors, but if a new disruptor doesn't have a story in terms of why the new brand is a disruptor, it fades out very, very fast.
And you think they don't?
I don't think so. Okay. So I feel that today, the very fact that we came up with a campaign which is warranty, okay, which was just speaking about that every second home in India has been painted by Asian Paints, and that's a legacy you have. And what we brought in possibly along with that was saying that we are appealing to every generation, be it a Gen Z, in terms of what they kind of look at to that extent. So it's not about being just old. It is about being what things which you are putting into the market as a strength, because you have the strength to do it, as well as you have the thought process in terms of bringing about the change.
And it's not just them, right? It's not just the disruptor. It's also the other incumbents, because everyone who's entering the industry right now, they respect you. Obviously, they say that we want to aim at being the number 2 player in the country. But when everyone is looking at the number 2 place, the number 2 also wants to ensure that they are number 2, and the number 3 also wants to ensure that they are not ceding any ground. So that on the whole becomes like a big pressure cooker situation for the industry. Have you faced that as well?
I think this pressure has always been there. If I look back last 2 decades, it's been always there. Just that today the number of players who are coming and trying to take a dig at it is much more to that extent. And I think that's something which is good, because it also, as a leader, keeps us on toes in terms of thinking what is the differential thing in terms of what you are kind of really talking of. And that's why I keep on saying that, we will keep on creating trends. People have to make case studies out of it.
For me personally, one of the things which is a perpetual disappointment from an Asian Paint standpoint is the non-paints home decor business.
Sure.
It's definitely not gone down the way analysts expected, perhaps not gone down the way you expected it as well. Some of the bolt-on acquisitions that were made did not go down well. They were perhaps strategic missteps, so to say. Some of the targets that you've given haven't been met. And for a company the size of Asian Paints, any new foray, one would have imagined, would be big, bold, and something not very different from what others would do in the paint industry.
Yeah.
So what was the problem there?
So I feel that, the way we anticipated the market, we were here not fighting any organized competition. We were fighting unorganized sector. And what we didn't realize in the unorganized sector is that the flexibility of pricing, the flexibility of the way they are able to kind of regionalize the product, I think was something which was very, very high. So I think it has taken us some time. We have put about 70 beautiful home stores across the country. The stores are doing well, but when you compare to the size of what we do in coatings, obviously the size is very, very small in terms of what's happening. And what you say is right. Some of the acquisitions which we did, we kind of grew them in the first 2-3 years, but then we were not able to sustain that kind of a buoyancy in terms of what happened to that extent. But as we see it, I think it's an integral part of our strategy, because we feel that if you own homes, okay, one of the big things which Asian Paints does is that as part of Har Ghar, you can't just own surfaces, you have to own spaces. And today decor gives us that big rope in terms of looking at owning spaces. And we feel that that's a very big differentiator for us, because if you were to kind of put all the brands today, okay, only one brand today appropriates home, and that is Asian Paints. And that is where possibly the decor strategy is still very, very relevant to us in terms of where it stands. Yes, we have a task in terms of how we need to kind of put it into shape and get it back rolling to that extent, but we are committed to it.
And how long will that commitment last, and at what point will you believe that, okay, we've put enough resources, mind space, and ideas behind it, but maybe it's just time to pull the plug?
So we are giving ourselves another 2 years in terms of looking at really getting behind it in terms of what we want to achieve, what we want to do to that extent, and really seeing that we can bring excellence in those categories, which is what was Asian Paints' style of businesses.
And what would the end of those 2 years look like for you to call it a success in terms of numbers?
So we are looking at a certain contribution which that decor piece which kind of gives us,
which
and we are looking at something like about a 7 to 8% contribution to our overall business in terms of what will be there to that extent. And that is something which possibly would be an indication that we are on a right trajectory.
And in coatings itself, what is your aspiration? Because right now, obviously a large part comes in from repainting, then there is a certain part which comes in from the new buildings which are announced, and thereafter there is this new TAM which is opened up, which is government-led infra.
Yeah.
Do you have an ideal mix here?
So see, when you look at today, I think the trend which we are seeing is that the whole area of the industrial and the B2B space is changing quite a bit, and that is really expanding, given the fact that you're talking of private capex and you're talking of government investment, which is coming in a very big way, which I believe will continue to that extent. And therefore, one of the big focus which we are taking is basically the B2B and the industrial business, in terms of where our contributions are relatively less as compared to possibly some of the competition in terms of what is there. So that's the new piece in terms of the growth trajectory, in terms of what we are taking in a very big way to that extent. Apart from the fact that the retail excellence will continue in terms of what we are doing to that extent, and that would kind of really see that it kind of firmly pegs us amongst the top 5 global players in the world.
So if I had to look at Asian Paints 3 years from now, what according to you would the revenue mix be? How much comes in from decorative? How much comes in from B2B? In decorative, how much comes in from, you know, retail decorative, and how much comes in from, say, government infra or all the housing projects, etc.? How much comes in from home decor and how much comes in from international?
See, roughly, if you look at it, basically the whole coatings landscape, overall, when we say from a point of view of a decorative, that will still lie in a band of about 78 to 80% in terms of as I see it. And out of that, possibly about a 20% contribution would come in from the B2B business to that extent. When you look at the industrial business, I think that will continue to kind of go on to a realm of something like about 8 to 10%, and global would be another 10% to that extent.
All right. And, you know, you will still be 18 to 20% margins at that point.
That's what we are kind of dwelling at very strongly.
When we were looking at disruption in the industry, when we were looking at everyone's strength in the industry, there was brand, there was obviously capacity, there was distribution, and then there was something known as tinting machines. Now, everyone has practically everything, and there is no particular differentiator. So what then would now be the next leg of differentiation or leadership for the paint industry?
So first of all, I think the differentiation lies in terms of, you know, your entire engine in terms of how it works. I think the whole thing of your executional excellence is a very, very big differentiator in terms of what you are able to do to that extent. And therefore, that is something which is going to continue, where we are going to invest in a very big way. We are investing in technology at a very big level. We have today almost about 160 patents in terms of what we have got. And that's a very big area of focus in terms of saying that we will have products which have no matches in the market to that extent, which will always keep us ahead to that extent. Second, we are getting onto the bandwagon of looking at today catching on AI very big time, because that is something which possibly gives us a huge mantle in terms of seeing how we are looking at our consumer segmentation, how are we looking at the consumer.
Can you give me a use case for AI?
How we are looking at the homes. For example, today, a person who uses our painting service, you know, tomorrow I could use AI just to know the preferences that customer has. And the moment I launch a new product, I can really carve the entire house in the new product and offer it to him rather than just a mailer in terms of saying I have a new product. So I think it can really look at hyper segmentation and hyper personalization, which would basically come in from AI in a very big way to that extent. And not only that, we are leveraging that in our manufacturing piece in terms of saying how we can basically do a cost optimization which comes in terms of predictability, which can be far more stronger in terms of coming. And the last area is the forecasting accuracy, which I think can give us a huge kind of elevation from the point of view of looking that you've got the right product at the right place at the right time in a much better way in terms of what we are handling it today.
All right, let's wrap it up with some fiery questions. Okay?
Yes, for sure.
Let's go. 50,000 crore revenue on Asian Paints by when?
Okay. Definitely for the next 4 years.
In the next 4 years. Amit Singhal stays in Asian Paints for the next 5-6 years at least?
I think from my mindset, eternally.
Eternally. Wonderful. What do you think you would want to leave Asian Paints as?
So first of all, I'm not thinking of retirement at all to that extent. I feel that what I leave behind is the passion, the legacy, and really saying that the brand continues to kind of galvanize and propel itself into a new pavilion.
Services will be how much of your revenue going forward?
So services today, as we see the beautiful home painting service, we spoke about it last time as well. It continues to be the world's largest painting service in terms of what we have culminated. And we see that going forward, we would like that at least 10 to 12% is something which our services continue to contribute.
And one piece of advice that you would like to give some of your competitors?
I would say that the advice is that when you kind of operate in the market, okay, operate with a certain value, a certain ethic, and look at possibly differentiating yourselves far more strongly rather than being me too in terms of the market.
And to the investors, what will you say, who've been sitting on 2 years of losses?
I think the investors will see that this is a brand which they will have to watch out for, because there are lots of things which are coming.